what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for the, if they invest for the right reasons, just keep at it.
Payrolls 2 hours away. Your equity market set up as follows on the S&P 500, on the NASDAQ. I think we have a countdown clock. It's there, Tom. Yeah, it's on screen.
200,
Great, that's helpful.
14, 13,
just in case you forget.
12.
On the NASDAQ, positive by 0.5%. You can thank Amazon for that move, because Apple's down in the pre-market. We'll get to those two movers in a moment. In the bond market, off the back of this 3-day losing streak in the equity market, it's been 5 days of it in the bond market. Yields up, 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 up. Up. Is that 5 or 4? Anyway, yields up by a basis point this morning to 4.1859 on a 10-year, on a 2-year up by 4 basis points to 4.92. Tom, this has come all at the long end, pretty much almost exclusively. We're higher by something like 5 basis points at the front end of the curve, but higher by more than 20 on a 10-year this week.
10-year real yield's increased. I mean, the real yield has gone from a 150 to a 181. I mean, there's some interesting gyrations here, but John, you're correct that all of this is out past 10 years. The 2 years, what, 1 beep, 2 beeps, whatever.
Hardly anything.
Hardly anything. And of course, it all spins around what the Fed does in the 3-month, the 2-year space as well.
The supply story from the Treasury earlier this week. We'll talk a little bit more on that a little bit later. Let's finish on foreign exchange. A rare piece of decent data out of Germany. It's an upside surprise on factory orders. It's backwards looking. It's a few months old, but we'll take it in Germany right now, won't we? The euro against the dollar, 109.45. That currency pair just about unchanged. Under surveillance this morning, counting down to the payrolls report at 8:30 Eastern Time. 200K, the median estimate in our survey for non-farm payrolls. A range of views on the street. Citi at the high end at 290. JP Morgan looking for something like 175. The range, Tom, is actually pretty tight. I think it's 150 separating the low and the high for the broader survey that we conduct here at Bloomberg.
McKee didn't whisper to me the whisper number as well, but I agree with Lisa. This is about wage numbers. And I mean, the bottom line is if you do have this new sticky inflation, if we're not going to get to 3.5 or at 4 or whatever, a 4% real wage, 4% nominal wage growth doesn't get it done.
Yeah, and Lisa's right to talk about this. This story right here. The United Auto Workers Union asking for a 40% pay rise over the next 4 years from Detroit's automakers. This according to our reporting here at Bloomberg. The request coming as contract discussions with GM, Ford, Stellantis are all underway. The current labour contract, Lisa, that pact expiring next month.
They called it an audacious list of demands, the UAW themselves. And they were talking about how they wanted a 40% raise because that's what the executive had gotten. And if the chief executive officer could get a 40% raise, they could. And just to put this into hourly numbers, the average wage or the top wage is about $32 per hour. There have been 3% increases since 2019. It would jack it up to $47.14. So that's kind of where we're at with how much of a gain this would be.
Two quick observations here. One is take $29 million, the Mary Barra compensation that Greg Villiers writes about this morning, and compare that to $67,000 a year at $32 per hour. That's 435 to 1. That's foundationally different from Mr. Sloan's GM or the GM of my ute. I mean, this is a huge difference in equity and cash compensation to executives versus any kind of union number. And the other thing I look at here is just it's the return of labor power of the interview that Lisa, we did. I can't remember if I did it with John or Lisa with the Teamsters. And I'm sorry, this is Teamsters influenced here. This is the knock-on effect. Forget about this Hollywood stuff. This is for real. I mean, the history is people used to get shot at, John, in America over this stuff in Michigan.
In Europe as well. It
Yeah.
used to be quite a violent thing. Some terrible stories about that. I think the Hollywood story is pretty real as well, Tom, by the way. This one's real too. BA, British Airways, 24,000 employees getting a pay rise, TK, over in the UK. 13.1% that pay rise. So just another deal for you. This is over an 18-month period. There's going to be a bonus, a one-off payment of £1,000 in the mix as well.
Yeah, but the bottom line there is I can't get a seat back from the Atlantic on my Avios points. That's the reality.
Don't get me started on Avios.
It's useless.
I've got things to say about useless
It's just
Avios
completely.
points.
The thing is,
Totally
they can
agree.
get you to Europe.
There's
but
inflation
they can't
in
get you
points.
home.
You try and get an upgrade Bramo with BA points, and it's like, yeah, those seats aren't available.
Okay. Yeah.
Every single flight you try and do that with.
My completely uneducated take, just in general on points, use them now because there's serious inflation and they're worth a lot less later on. So every month they go
she's
on,
like,
they
don't cry
lose
for
it
me,
because they're basically
Argentina.
trying to ramp it in. Anyway, carry on.
I've got things to say.
I know.
You've got things to say. Got things to say on Amazon and Apple. Amazon shares up in a pre-market. Nice move in early trading for Amazon going into the opening bell. It's a beat and a race from them. The concerns you had about cloud revenue growth at Microsoft, you don't seem to have over at Amazon. That stock is up by 9%. Let's sit on Apple just for a beat. The good news there ain't much, that's for sure. Third straight quarter of declining sales, slowing demand for phones, computers, tablets, TK, take your pick. This line from KeyBank, and I'd love to get Dan Ives' thoughts on this, and we'll talk to Tom Forte about it later as well. KeyBank raising this concern, worries that the US upgrade cycle is coming to a halt, that upgrade rates are at all-time lows, and likely to result in weak revenue here in the United States. That was the bullish thesis, Tom.
Yep.
Upgrades, ready to go, and let's focus on the upgrade rate now.
Every 12 months like clockwork, slow June, slow summer, September, back to school.
It's dead, then a
back
new one
to
comes
holiday
out.
season, new product. Will they show up? We don't know if they'll show up. Sell Apple. I mean, that's the way it always is.
Selling it this morning. Stock's down, TK, by, let's call it 1.9% this morning.
1.9% after going up 400% since February or March. Right now, we're going to advance forward on this jobs report. Sarah House has been wonderful, senior economist at Wells Fargo, and joins us this morning. Beneath the headline data at 8:30, what's the first thing you will look for?
Right. So I think, obviously we'll be keeping a close eye on those headlines, not just the hiring, but also what's happening with labor force participation. But I'm going to be looking at some of the, less known sides of things that maybe are potentially showing that we're starting to see some cracks in the foundation of the labor market. So for example, permanent job losers. So those have increased about 20% over the past year, about 300,000 workers, which doesn't sound like a lot, but that's on par with what we saw in between late 2006 and summer of 2007 before things really started to unravel in the jobs market.
Are we beyond the pandemic? I mean, can you study this without the prism of going back to late 2019, early 2020? Are we beyond COVID?
No, I think we're still seeing some lingering effects of the pandemic on the jobs market. So everything from the rate of hiring to the labor supply. There's still some industries like leisure and hospitality, like government, that have scope for catch up. So those industries still don't have employment back to where it was in 2019. And so I think that's going to help bolster payroll growth still over the next few months, even as we have seen demand for workers come down. And I think, we're still very much seeing the effects of the pandemic when it comes to the wage dynamics as well.
Sarah, I want to ask about what's happening in the bond market, not directly on treasuries. I know that's not your seat, but yields are up again this morning. And it's not about the data this week for many people. It's about treasury supply. From your standpoint, is fiscal policy in conflict with monetary policy at the moment in America?
Well, I think we are starting to see some of the effects of the fiscal support that we saw over the past few years. It's waning. So yes, you still have some support in terms of like the infrastructure money flowing through the economy, but I think that rate of change it is beginning to work more in concert with monetary policy, but not as aggressively certainly as what we're seeing in the monetary policy sphere.
What's behind that additional supply? Tax receipts are down. What's going on exactly? There are people asking a question as to whether this is stealth easing coming out of Treasury. What is it?
Well, I think it might also be in part of just trying to rebuild the cash balance in the Treasury General account following the debt ceiling. So I think that could be part of it.
Although a lot of people are speculating that it's unlikely that the U.S. government's going to get their fiscal ducks in a row, considering the fact that there is no appetite on the campaign trail. At what point does this become a material risk to the economy if yields remain at the levels that they are?
Yeah, so I think where you'll really start to see it and see some more focus is what happens in terms of that net interest expense. So it's something we really haven't had to think about for years and years, even with these ballooning deficits, given the low rate environment. But of course, with where rates are today and where they're likely to stay, that's going to become an increasing problem. And so where that starts to play out is how it squeezes out other types of more productive spending in the economy.
Which brings us back to the labor market and how long it can continue to sustain some of this spending, which has fueled gains even as some of the higher rates were supposed to end up crimping growth. What are you seeing on the services side, especially after the ISM services yesterday that showed the headline number softening just a touch, but the component of how much people are paid actually rose unexpectedly? It doesn't seem to be going in the right direction.
Right, so I still think we're seeing a lot of inflationary pressures coming from the labor market. I think you're starting to see it cool down, but ultimately when you're looking at across range of wage and compensation measures, you're still seeing compensation growth north of 4%. And while we did get some stronger productivity numbers yesterday, even with some improvement in the recent trend, that's just not going to get back to 2% inflation on a sustained basis. So it's going to get us closer as we start to see those wage gains come down, but right now we're still seeing that inflationary pressure from the labor market remains too strong to be consistent with the Fed's 2% goal.
Sarah, we've heard from a number of different people in the past couple of weeks that they think the Fed is going to move to an explicit or implicit, we're not sure, 3% target or 2.5% target instead of the 2% target, that they're going to say it's not worth putting a dent in this labor market and bringing those wages down in order to get to the 2% target. Do you agree with them?
So I think over the medium term, so let's call it another year or two, I think that's broadly right. So I think the Fed can live with 2.5% to certainly 2.25% inflation after all the rigmarole we've been put through in the past few years. But I think, for the long-term target, I don't think that changes. Right. And so I think where you end up with is policy is going to be on net a little bit more restrictive, maybe a little bit above that long-run estimate to, I think, once you get past the worst of the recession fears, that you still get some downward pressure to get back to 2% over time.
Sarah, to the heritage of Wells Fargo and the idea of Jay Bryson's work and the great John Sylvia, you've always had a unique take on the American labor economy. Are we reunionizing? Is there something going on here besides just news on one union, news on that union? Are we reunionizing?
I wouldn't quite go that far to say that we're reunionizing, but I think what we have seen is a reflection of the still incredibly tight jobs market and all this union activity that we've seen, both in terms of some pretty heated negotiations, as well as a pickup in actual strikes and increasing number of workers actually out of work because of these work stoppages. But it's also, of course, a reflection of just the extraordinary inflation environment we've seen. So if you look at the employment cost numbers, so union compensation has lagged that of non-union as a lot of these contracts were made before we saw inflation really shoot higher. And so I think to some extent this is a little bit more catch-up rather than a signal that we're about to get another leg higher in terms of wage growth. But it does suggest that it's going to keep those wage pressures elevated and again make it hard to get back to 2% inflation anytime soon on a sustained basis.
Hey Sarah, thank you. Ahead of payrolls, Sarah House there of Wells Fargo. The median estimate at the moment, 200K. TK, remembering the 70s when union membership, the rate of private sector workers was something like close to a quarter. It's come down dramatically since then. I've asked the question a few times over the last couple of years. Can you imagine how much worse the inflation problem might be if union membership now was consistent with union membership back in the 1970s, the pass-through from headline inflation into wages would have been far more dramatic than we've seen.
Very European-like. And the big difference here is whereas Europe right now, and particularly whereas Germany here, the Guild heritage and all that, versus America, what you do in America, John, is you take out public service unions and then look at the private sector, and that's where it's atomized. That's the word they use. And the answer to my question to Sarah is the idea of is there an ebb and flow here? And I think it's worth watching. What gets my attention is everybody goes, oh, no, it couldn't possibly be reunionizing. And that's when my radar comes up.
We're certainly hearing more and more about it every other day at the moment. Coming up shortly,
the control room
on Apple,
they're
on Amazon. Yeah, we can do 2 conversations at once if you want. Let me just do the tease.
Okay.
Tom Forte, D.A. Davidson, on tech earnings. They're unionizing.
They are.
Is that happening?
Yeah, they got 15 people.
Who's leading the union?
I know, there's 15 people.
I'll get them together. I could do that.
You're going to be the leader?
Yeah. I think that's sort of very on brand.
You're like, look, if you're going to do it, I'm going to lead it.
Full communism in a control room. It's very on brand.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1, so it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City.
In London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
People are employed, they have money, they're spending money, and the Fed is trying to slow down the economy, and it looks like we're reaching a pretty good equilibrium. I think there's always been this battle between the consumer and the Fed, and the consumer has won the battle back a bit, but they got to be careful of overwinning it now. And now the risk really goes to over-tightening and slowing down the consumer too much, and then we would have a recession.
It's one of my favorite things about Brian Moynihan of Bank of America. He refers to the work from his research team.
He does.
When he talks about the economy, he's talking about what Mike Gapin is writing about at BFA.
Mentioned Constance yesterday.
Huge respect for that.
With David Weston, and I totally agree. He's one of the few people that really stands out. I think, Moynihan's going to be, he was here for the Ethan Harris interview. He was over there off camera, and, I think Brian's going to fall apart with Ethan going out the door.
Retiring.
Retiring, yeah.
What a generation of economists that have learned under him. It's kind of amazing. You go through it name by name, and they're all in different places now, but quite a legacy that Ethan Harris is leaving behind on Wall Street.
And Bill Dudley was the same way.
Yeah.
At Goldman Sachs.
Still around, and hopefully we can catch up with Ethan now and again as well. Let's touch base with the price action. Equities right now on the S&P 500. Equity futures are just about positive by 0.3%. 2 names I want to look at. Amazon, Apple. Amazon up in the pre-market by 8.9%. Apple a little bit lower by 1.8%. Amazon doing the heavy lifting for the NASDAQ this morning, TK, with a tidy rally in early trading.
It's a tidy rally as that. Let's go to Apple first here, and the whole idea of OMG, they're down 1.84%. and somebody that absolutely nailed this. I mean, Dan Ives comes on, and let's be honest, he's dressed up like Fruit Loops. I mean, we were talking about Fruit Loops earlier.
I love
the Fruit Loops.
You can tell Dan that yourself.
He's got the Fruit Loops, the turquoise shirt going, and he's the Uber bull on Apple. There's others out there more measured, and one of them is Thomas Forte, senior research analyst at D.A. Davidson. He's got a neutral. He's measured. He sees the optimism. But John, you were talking about this off camera here when we weren't talking about, does Barbie have legs 3 weeks in? And the basic idea here is the Apple mystery is, are you going to go from the iPhone 10 and finally spring up to the iPhone 15? I don't,
For any kids listening, Barbie still has legs.
Okay.
I just want to, just confirm that. Just confirm that.
Oh, my God.
Tom Forte joins us now. Tom, it's good to catch up. Catching up yesterday was really revealing as well. Some insightful comments you made on Apple where you essentially said, and you've written about this, you think maybe the stock had gone too far. We're down this morning by 1.8%. You're aware of the bullish thesis, Tom. There's this upgrade cycle. Lots of people sitting on old phones. They're all going to upgrade and buy new ones. Where is the upgrade rate now going into the new launch of new products in a month or so?
So the most concerning statistic from Tim Cook on the call yesterday was that consumers, more than half, are already paying for their Apple product on an installment basis. So I think the low-hanging fruit's been picked to the extent that that was the opportunity for Apple to get you to go from buying your iPhone or having your iPhone essentially fully subsidized by the carrier to now having the consumer pay for it on an installment basis, often with no interest. I also am concerned that the carriers are going to subsidize the 15 to a lesser degree than the 14 or 13. Yes, they want more consumers on their 5G networks where they've invested billions, but their times are tough too right now. So the comments on the iPhone are concerning, and I think that's what's weighing the stock.
Tom, away from your neutral call and to go to the Apple fanboys and all that, the bottom line is it's an ugly June, ugly July. It happens every year. We have to wait for September. Somebody with a black turtleneck walks out on stage and tells us the second coming of Apple, and OMG, the stock goes up. Why is that going to be different this time?
It's going to be different this time because I think that they just told us that the September quarter, where they're going to tell us about this new wonderful iPhone, is going to have negative revenue growth. And that while the iPhone will have an improvement from the negative 2.4% it did in the June quarter, it'll likely be negative as well. So yes, they'll be touting every new feature on the iPhone, but the comments they made about the financial impact are pretty disappointing.
The Open Prayer Services picks it up and crosses. How far out do you go where services catches up and advances and overcomes iPhone dynamics? Is it a 3-year lookout? Is it out 10 years? How far out is that magic point where services become really important?
So the math suggests it's probably more like 5 years when you think of the relative growth rate of services to everything else. But if you look at the quarter, hardware was down, iPhones were down, iPads were down, laptops were down, services was up. That's great news. And I do believe over the long term, Apple as a service is a real possibility. You pay $200 a month, you get the latest and greatest iPhone, you probably get Apple TV and other things, and then you're not thinking about the fact that you're essentially paying $2,000 for that new iPhone. You're just thinking about the $200 a month and getting the latest and greatest iPhone. I think that that's the opportunity long term, but mathematically, I think it's more than 5 years out before services is more than half revenue.
So, Tom, you did decrease your price target for Apple, but you increased your price target for Amazon after they delivered much better than expected results. And suddenly everyone's heralding Andy Jassy as the hero of Wall Street. How long can this be the case for him to keep cutting and keep beating on the top and bottom lines across the board?
My best answer right now is that this is 12 months. So they just had their good June quarter, their good outlook for the September quarter. They'll have a good December quarter and a good March quarter. I am very concerned that at some point reality sets in. And to the extent that these cost cuts are making them less customer-centric, that's going to slow the flywheel, price, convenience, selection. So I think the next 12 months, they're good. Day one of the next year, I'm concerned.
Some people might argue that the cloud business is going to take over all. It has done the heavy lifting for all the profitability of this company, and it showed signs of picking back up. There will be questions about whether it's gaining market share versus Microsoft's Azure. How long can that really be the main flag bearer for the company? I mean, is that enough to really offset what you see down the line on the customer service side, in the sort of retail side of things?
The answer is not long enough. So we're cheering a 12.2% growth rate compared to a 15.8% growth rate when they reported the March quarter, though it is better than the 10.8 they suggested in the month of April. That's the slowest growth rate since AWS was launched in 2006. Andy Jassy's bragging about double-digit growth as if it's not going to be sustained. So a lack of double-digit growth for one of their most important profit centers is hugely problematic, especially given the current state of their e-commerce business. Amazon collectively needs something like $3.4 billion for an incremental basis point or a percentage point of revenue growth. They're going to need advertising. They're going to need video. They're going to need healthcare. They're going to need something else to come in to take the baton from AWS over the long term.
And Tom, can you describe how service on the e-commerce side has deteriorated over the last year?
Yes. So the best example is anecdotal. So I had a defective smoke alarm that I purchased on Amazon. Not that long ago, they would say, we're sorry it's defective. We'll send you a replacement. Put the old one on your porch and UPS will pick it up for free. Now they want $7.99 for UPS to pick it up. Or they want me to go to Whole Foods, wait in line at Whole Foods to return it. So that to me is one example. What's going to happen is I'm going to start thinking more about going to Target. I'm going to think more about going to Walmart, to Costco, to other retailers. And I think that's hugely concerning for Amazon, something I'm monitoring closely.
It's anecdotal, but I hear the same thing from so many people. Tom Forday of D.A. Davidson, great call on Apple going into the earnings just yesterday. TK, I see the same thing too. I've got a conspiracy theory about Whole Foods shopping too. They always say the water's not available, but it is. And I know the water's available.
What are you talking about?
You order the water with
Lisa,
your food. You get Whole Foods
enter
delivered.
2023.
And they turn around every Friday morning. Let's see if it happens again when I get home. And they say the water, the bottled water's not available. And I've always wondered, is it the weight? Are they just pretending because it's the weight?
No, I got my sparkling
Same thing.
water.
Happens every single week.
I love the detail.
I got my sparkling water yesterday. Yesterday.
Don't dehydrate.
You know what the problem is?
It's a
Ready?
problem.
It's like plastics in The Graduate. Ready? Bananas. I've given up ordering bananas.
Are they
from
saying
Whole
they're
Foods
saying they're not there?
No, they come, but they're not like if I pick them. They're like they're just you can't do fruit because they don't pick the right fruit. I mean, I'm getting it.
This is good. This is important. I think we just get it all out there, TK.
This is like what Tom Forty. This is why 40's so
I'm agreeing
good.
with Tom.
It's anecdotal stuff. It's not CFA blather. Bananas.
Bottled water.
Excuse the cough, folks.
Same thing.
Sorry.
I know what everyone's going to say. Drink out of tap. Get one of those disposable
you're going to get
things.
lots of people.
I love it. You know what I learned with Whole Foods? This is important. In Whole Foods, when you get down to where you deliver, you put don't substitute. So they can't sneak things in there they want to get rid of.
Raised with an Italian father who refused to drink tap water because he came from a place where you couldn't. So we were raised just drinking bottled water. It's just what we did.
True story.
Cultural.
One of the offspring is in Europe. He said the tap water is not very good. He's excited to come back to New York City for the tap water. Tap water is awesome here. It's very good.
He's excited to come back from Europe for tap water.
It's good tap water. It's really good.
That's what he's excited. Oh my
That's one of them. Yeah, it's.
I'm gonna have a word with him. Sarah Hunt of Alpine Saxon Woods up next.
Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's just not a surprise that we're pulling back here.
There are signs of weakness in the economy coming through.
Investors are stepping back and saying, we're going to wait to see how far yields rise.
What you want to see is inflation slow credibly and sustainably.
Until the recession does materialize, we can expect high rates for a period of time.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on Payrolls Friday, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. TK back in a seat especially. The jobs number 90 minutes away. We're looking for 200K in our survey, Tom. And this bond market, softer again. Yields up through the whole of this week.
A little under the weather. Decided to come in for the Super Bowl 13 times a year. We have the actual Super Bowl and Jobs Day. And Jobs Day's, you know, it's a big deal, and it's a big deal within the backdrop of what bonds have wrought over the last week. The bond movements are really not game-changing, but they give you something in the summer to talk about to get to Q4 of this year.
Hasn't been a quiet August so far, has it?
Not at all.
Yields up every single day this week, Monday through Thursday and Friday. Yields up here, Lisa, by a basis point. The 10-year, 4.18.
I'm glad you pointed to the 10-year, and that's the reason why I'm actually really curious to see whether the jobs data moves the needle at all for the 10-year. Basically, at a certain point, this is not about the Fed. This is about the Treasury issuing more debt. This is about the Bank of Japan maybe moving away from something that's underpinned the valuations in so many of the developed market worlds, particularly the U.S. So here's the question. At what point does Fed lose control over the narrative and get the sense in the market that they're not going to respond to any strength, that if it comes in, you get this sort of deterioration, you get a feeling longer term, there's still going to be inflation.
I do not agree that it's this macro stuff. The macro stuff is tangible. It deserves our focus. Look what Fitch did. We all woke up with Fitch and said, OMG, we're a banana republic. But the bottom line is this is about
like
inflation
Canada.
sticky. And Michael Gapin, when he wasn't, when Michael Gapin wasn't advising Brian Moynihan on what to say in the economy, he put out a great chart. It was a fan distribution of the inflation outcomes that are there. And what's really happened here in the beginning of August is, OMG, we're not going to go to 2%. It may be 3.x or 4.x, stickiness is the real debate into this jobs report.
I've waited 3 days to take that dig at Canada. Apple in the pre-market, negative by 2%. It's nothing personal. Amazon positive by close to 9%. Apple just about in line with expectations, a bit softer on iPhone sales. But to look at Amazon here, Amazon up by close to 9%. There were concerns about cloud revenue growth going forward from here over at Microsoft. Lisa, you did not see that at Amazon overnight.
On any level, what you saw is job cuts, yay, and increased profits, yay. Everyone's piling in. The question is, as we were talking to Tom Forte, how long can it last? And at what point can people keep projecting out this type of growth at a time where there are some headwinds and there's a lot of competition? I think that's important, especially in light of what we keep hearing, which is the consumer can't keep this up forever. They've managed to, much longer than people thought, but they can't keep this up forever. That's what everybody's saying.
That stock just about holding up this equity market at the moment on the NASDAQ, given its weighting. On the S&P 500 here, Lisa, equity futures positive by, let's call it 0.2%.
What we're looking at today, obviously 8:30 a.m., the change in U.S. non-farm payrolls for July, the unemployment rate. John went through that. 200,000 is the expected number. What I'm watching is the average hourly wages. How much do they continue to climb? How much does it decelerate from some of the increase that we've seen recently? If we get down to 4.2%, here is the key question for the Fed. Is that enough to sustainably say, okay, we're happy with this, we're still going to remain on hold or even cut rates in the near future? Today on the oil front, as oil prices continue to climb, Saudi Arabia and Russia are holding an online review of their market conditions, and the OPEC plus nations will weigh in. How long can we see an increase in oil prices before it becomes the main story? Because it has been 6 straight weeks of oil gains, and it seems to be gaining some feeling of momentum from what Saudi Arabia did yesterday in terms of maintaining production cuts. And Saturday, we get the word from Warren Buffett. Berkshire Hathaway reports earnings. Very curious to see what he has to say about the industrial production complex in the U.S., given that he is so heavily invested in them. And yes, of course, Apple.
Is this the Omaha thing? Have you been to the Omaha thing?
No, never been.
Is this weekend? Are we going to do that? He plays the ukulele and.
Oh, that's tomorrow.
Yeah,
the
that's
get together.
Well, it's tomorrow's the earnings. No, it's not the get together. We already had the annual get together, but the earnings are
He's
tomorrow.
never invited me out.
Yeah. We covered the full cult and how you felt about it.
The full cult. You like that? Going full cult in Omaha. Bramo, they were your words, not mine. Sarah Hunt joins us now, Chief Market Strategist at Alpine Saxon Woods. Sarah, good morning to you.
Good morning.
We've had these tech earnings now, and I wonder, from your perspective, do the tech earnings justify the double-digit gains we've seen so far year to date in this equity market?
I think so far they may have. The question is going to be about what is coming next, right? So it's all about the outlook right now. So it's very good that Amazon had good numbers. If you look back at the way Amazon has performed versus Microsoft or Apple, it was not performing as well. So it did need to do something, relatively speaking. And it's not a huge surprise that Apple is having a little bit of a give back on unit sales on some of the hardware, because you had, just like everything else, huge extra sales during the pandemic. The thing for Apple is that gives them a bigger installed base. That whole services revenue story becomes more and more important, and they're adding that. So I think that that's good news. The question really is going to be what's going to happen going forward, and the expectations for next year are some pretty serious growth, and I think that's where it's going to be a little bit tricky.
Lisa and me are in the same camp on this, because every time you get these earnings from these tech players, we look for this kind of macro signal. Before we get into that with Apple, can you tell me if the iPhone is a staple or a discretionary item? Because when you start to see slowdown there, is there a broader economic signal that I can take away?
So I think because of the pandemic, that's a more difficult question to answer right now. In a normal environment where you hadn't had everybody staying at home and people saying, you know what, every kid needs an iPad because they can't share anymore because they're home all day. I think that changed the math of that. So I don't know that you can have a huge read into that, except that people possibly overbought or they ordered quickly because they were afraid that they weren't going to get something. I had to wait for my iPad. Everybody wanted one, right? So now you are going to wait for the upgrade cycle. But the fact that they're seeing a lot of switching is positive for that upgrade cycle. So I'm not sure that that's a huge macro takeaway, especially given how so many of the pandemic stocks had a much stronger slowdown post-pandemic. That's not a huge surprise that you should see some of those units coming in.
Mr. Buffet, as 40% of his Berkshire Hathaway is Apple, and that's been a growth proposition going back 7 years, 2016, where Apple's just built and built and built. Carry that over to our listeners and viewers. Do we really lighten up on tech here, or do we just assume that they keep growing as Mr. Buffett has enjoyed seeing Apple grow?
I think from the longer term, they keep growing. I mean, this was the argument at the beginning of this year, right? Which was last year, the tech stocks got hit very hard. And one of the things that we've talked about historically is that some of those things become staples. Is your iPhone a discretionary item, or is it something that you have to pretty much have with you when you leave the house? Does it feel like I can't live without my phone? It sort of does. So I'm not sure whether or not that falls into now a consumer staple as opposed to a discretionary item. But I think that the question is, can I keep seeing better performance out of these stocks than the rest of the market? And I'm not sure going into next year how much of the earnings growth is going to come the way people expect it. So, and I'm not sure if that's only about technology or about the entire market, because I think that there are some concerns there.
We're having this conversation at a time when yields are rising to the highest levels since November, but really kind of pushing up against some of the highest levels that we've seen in a long time. And I'm wondering how much that is placed in the equity market.
So I think that this is one of the things that we've also been saying all along, which is that it's hard for me to believe that the Fed is going to cut as fast as people expect them to. So we sort of expected rates to stay a little bit higher for longer. The question really is, how high do they stay? Because the question about cutting rates so quickly, right? We're still at a point where we're not at 2%. I'm not sure we get there that quickly. And everyone's talked about how difficult that last 1 percentage point or 1.5 percentage points of inflation may be. You may see inflation start to rise because oil prices are on the move and food prices are higher. So I think that it's going to be difficult to see rates coming down in that way that they did in the last 15 years, that every time there was a scare, rates came down very, very far. There was an article on Bloomberg about how the stock market can continue to rise even though rates are going higher because multiples can continue to expand. And I think it's just going to be, you're not seeing that trade-off between tech and rates the way you did last year. Every time rates went up, tech went down. You're not seeing that right now because tech has come through with good earnings, even in higher rates. And they've got so much cash, they're now earning money on some of that cash. So that whole idea that tech is going to be in trouble because rates are going higher is a little bit difficult on the very mega tech side to see. So I think that's going to depend on how we see next year, but I think rates are going to be higher than people want them to be for a little bit longer than people expect.
Surely it matters why they're higher. If they're higher because the data's been better, then you can make the argument that it should be good for risk assets. If yields are higher because the Treasury is issuing more and potentially crowding out the bond market and yields are up for that reason, isn't that a little bit worse for risk assets?
Oh, absolutely. And I think that you used a great phrase earlier, which is Fitch just turned the volume up on something that was already there. Nobody was paying attention to the fact that Treasury was talking about a big issuance until you had that combination of, oh, here's the big issuance, and oh, by the way, we have an issue. The expense for the U.S. government is much higher as well. They did not term out their debt like households did and like corporations did. That's going to be, excuse me, a big issue going forward. So the question, I don't disagree that higher rates, because the backdrop is not so good, because you've got more risk because I'm issuing so much debt, is not as good as higher rates because things are better and we want to continue to slow things down. I'm not sure how that plays out, but I don't think rates are going to come down to the extent that people want them to as fast as they do. And I think that's just going to be tricky for equities as well.
It's tradition. You know how we finish interviews together. We talk about energy. It's turning around. Energy's up. Saudis are pulling back and saying they might do that for a whole lot longer. We've seen some of the capital returns coming out of some of the energy players. I imagine you're feeling a little bit more comfortable about the call over the last couple of weeks. Can you walk us through why?
Well, there was a lot more supply coming in than I think anybody expected. Between us continuing to release from the SPR through this year, which we did, not buying anything back, which we had talked about doing, and other countries releasing oil, as well as so much Russian oil on the market that people didn't expect quite the level to be there, I think that kept prices lower for longer. And then you've got this back and forth between, if there's going to be a recession, demand is going to go down. Right now, that shift into it's going to be a softer, it's a soft landing and not a recession helps a little bit, but demand has picked up, and the supply hasn't picked up commensurately. And I think that you're starting to see with Norwegian natural gas, right? So that it picks up LNG. The entire complex is picking up. We thought that it was overdone, but with energy, it's very difficult. Those swings are big and they last longer than you think they should. And yes, we're feeling more comfortable, but we've sort of stuck through it. So we took some pain along the way as well.
Do you want to take a jobs guess this morning before you go? Do you want to pick a number? Any number. Whatever you fancy. Go
197.
On. There we go. Beautiful. Just short of consensus.
Can you get down to the 197.5, 197.4?
Sarah, thank you. Sarah Hunt, good to see you. And Van Pine Saxon Woods. If you're just joining the programme, welcome to the programme. On payrolls Friday, in the survey, the estimate at the moment, 200k. Equity futures on the S&P 500 higher this morning by 0.1%. 0.14%. Lisa, in the commodity market, need to talk about crude, 81.79 on WTI, and Brent in and around 85 this morning.
Just adding to this feeling that maybe the actual physical crude market is not enough to really keep supplying demand at this level was yesterday Saudi Arabia coming out and saying they were going to continue the 1 million barrel per day cut in September. So this is what they're doing. And then meanwhile, Russia, which had been oversupplying the market, is basically, there are signs that now it's making good on the promises that it had made OPEC Plus to not supply as much. You put this together with the fact that nobody stopped traveling, as you can see from the airline tickets, and it leads to kind of a bullish proposition.
I agree with the bullish proposition, and I agree that every research article from 18 months ago talked about demand analysis. Serhan just talked about it, I think, very nicely. John, I went to copper, and of course, since I haven't been here for a couple days, I did look at LME copper.
Ooh.
Just, because it is real copper. If you look at London LME copper, LMCADSO3, China has the symbol memorized. And the bottom line is we've had a copper recovery off of summer of last year. And that's about this global demand. And this is an undercurrent that's there, which is how Jeff Curry and others get to an elevated Brent crude price.
I do actually have that memorized. You're right.
I
on
know.
The LME.
I know. First time I said, this guy needs to get a life,
Look at Chicago.
HG1.
Yeah.
Simple. HG1.
Okay. Thanks for that. Just on flying, story of the week, I think. Elsewhere, sort of off the radar. Domestic, not great. Not great, Lisa, not great.
Cutting prices, and you're starting to see this, and that's something people are not talking about, but I want them not to talk about it because I want to keep enjoying the fact that they're cutting prices. Just
cutting prices. It's a secret. They're still really high. Nadia Lovell of UBS in the next hour on Payrolls Friday. The payrolls report, the estimate, 200K.
Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. The Fed is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, today on Bloomberg Television and Radio.
This was never supposed to happen in America. This is the persecution of the person that's leading by very, very substantial numbers in the Republican primary and leading Biden by a lot. So if you can't beat him, you persecute him or you prosecute him. We can't let this happen in America.
That was the former President Donald Trump after appearing in court in Washington, D.C. Wendy Benjaminson of Bloomberg News coming up very shortly, so look out for that conversation. I just want to work our way through the price action going into payrolls about an hour and 13 minutes away, with equity futures at the moment on the S&P 500 positive after a 3-day losing streak on the S&P. The thankful news came from the likes of Amazon. Their stock is up in a pre-market by, let's call it 8% this morning, 8.5% off the back of a beat and a raise. The disappointing news came from Apple, if you can call it that. We're down about 2.3% this morning, just falling short of estimates, and that stock just a little weaker in the last 10 minutes or so. We talked about the airlines and what's happening in America and abroad. If you're international, great, and you've heard that from some of the big players, the likes of United, the likes of Delta, this earnings season. If you are domestic, you are not hearing the same thing from JetBlue, which had to cut its outlook, from Southwest. In our story, and we've done a great write-up on this here at Bloomberg, so I encourage you to check it out if you can on the terminal or on Bloomberg.com. This quote from an analyst over at JP Morgan in the investment bank, Lisa: if you cater to premium, if you can't bank on loyalty, and if you don't fly internationally, if you don't cater to premium, this year's third quarter is likely to disappoint. And JetBlue, Southwest in the mix on that front in all the wrong ways.
It raises a lot of questions. If people's desire to travel and get out in the world has ended, or are we looking at something that is possibly more sustainable? People pulling back on discretionary spending, families, the other people who don't necessarily have the incomes that the higher bracket does. And I think that that's really going to be one of the key macro questions.
I looked at the Atlanta GDP now number, which moves. It could go up, could go down. Don't put it in stone. But, John, it's like a 3.6, 3.8% statistic. It's like a boom economy statistic. Now, that's going to amend. But I just have trouble with this worry about the American economy when we're clearly 2.x%, if dare I say 3.2 or whatever percent. I mean, this is it. All of the airlines, it's a solid economy.
Yeah, don't be confused, Tom. I'm not saying it's not. I'm just trying to lobby for lower ticket prices from airlines. That's all. That's all this segment was about.
That was
Tom.
that?
That was the last 2 minutes. That's all it was.
Okay,
things are bad.
thanks.
Cut your prices.
That's
That was it, Tom. That's all.
Okay.
Nothing else.
Wendy Benjamin was taking notes on this. She joins us now from Bloomberg News in Washington. Truly a political animal. We're thrilled she could join us this morning. Wendy, Professor Schiller earlier, I want to talk to you about the Republican Party that's listening to the former president and saying, what now? Let me focus on a gentleman from Florida who's not the governor. He's got 4 children. He's got bills to pay. His name is Marco Rubio. Really interesting childhood. He's been a senator since 2011. What does a Republican like Rubio make of this moment for the former president? What do those Rubio-like Republicans do?
Well, right now they are standing firmly behind Donald Trump. Even the people who want to wrest the Republican presidential nomination from him are saying like supportive things. I'll pardon him when I become president. This is a politically motivated thing. What about Hunter Biden? And I saw a poll yesterday, I think from CNN, 70%, 69% of Republicans, not primary voters, all Republicans think that Joe Biden was not legitimately elected. That's the backdrop for this trial.
Wendy, you and I remember the day when California registered Republicans clicked 29%. And there was this whole uproar, and people like you went mental and said, oh my God, the Republicans are extinct. How small is the Republican Party right now? We have to remind ourselves that President Trump got X million more votes the second time around than the first time around. But how small is the, to use an amateur phrase, the MAGA party part of the party? Is it 15% of America? Is it 18? What's that number?
I would have to guess, but I would think that the MAGA part of the party is about 30%. That is the part of the party that will vote for Donald Trump if, as he said, he shot someone on Fifth Avenue. That is the heart of the Trump support. But then you have the next level institutional Republicans who are so afraid of losing that 30% that they continue to support Trump. And now you're up to a majority of the Republican Party.
This is critical, Lisa. The math here is really applicable. If the Republicans are 50% of the public and is 30% of the party, as Wendy says, that's 15% of the country is supporting President Trump.
Which is a reason why people think that if Trump is elected as the nominee for the Republican Party, that it will be a shoo-in for Biden to become president or not, right? And that's sort of the key question, right, is how close of a race this would be. Reuters Ipsos put out a poll yesterday where they said nearly half of Republicans say they would not vote for former President Trump if he were convicted of a felony. 52% wouldn't vote for him if he were in prison on Election Day. All of these types of numbers point to people caring, even within the Republican Party, to some degree, maybe not in the same kind of mass as in the general population. At what point does Republican leadership take notice of this and start to push in other directions?
Not yet. I mean, what that poll also says is that 48% would vote for him if he were in prison. I mean, that shows the depth of the support he has against a president who, while normal in the political, sense of things, is deeply unpopular right now for all the economic reasons you guys talk about, for all of the, other things going on, for these suspicions about his son, which may or may not be true. Trump will be running against a president that people are not enthusiastic about seeing reelected. And I think that we should definitely not, as President Obama said the other day, underestimate the power of Trump.
Wendy, thank you. It's wonderful to wake up early with Wendy Benjaminson.
It is.
I think Anne-Marie is at risk of losing her seat. AMH. This is why you don't take days off in this business.
You don't. Look at me.
You don't.
3 days
just
off.
Just in case.
They're like, checking me in at Social Security saying, see ya.
I'm only saying this because I know Anne-Marie's watching this morning. And good morning, AMH. Thank you.
She's not with us today?
She's away for a week. I don't know what she's doing up early. She's off for a week. She's on vacation. So we get the privilege of catching up with Wendy over the next few days into next week. So looking forward to that.
David Weston's in Aspen.
I think that's work, Tom. I'm not sure that's vacation. Is that a vacation?
AMH is in Vail,
Is she in Vail?
I don't know. Rocky Mountain High.
Oh.
Sure she went back to Norway, too.
The fjords. Good, Tom. Great. Okay. Sarah Wolf from Morgan Stanley coming up very shortly. You know what would have happened? I'd go to speak and then he'd start talking. Anyway, Sarah Wolf from Morgan Stanley is coming up very shortly. Sarah recently has written about tax receipts and the Treasury and all that good stuff. She's also written about what's happening with student loan repayments and what could happen to the US economy later this year. So hopefully we can start the conversation there. But Tom, you're in charge of that in about 5 minutes.
It's great. With Ellen Zentner, with Ellen Zentner, this is a big deal. They're looking at a lot of the different themes that are out there wrapped around the conventional economic analysis.
Let's work through the price action. Equities at the moment positive by 0.15% on the S&P. I know a lot of you reaching for the bond market first thing in the morning to see what's happening. Yields are up again for a fifth consecutive session on a 10-year Treasury yield higher by a single basis point of 418.59. So new highs for 2023 on a 10-year yield. If you want the post-pandemic cycle high, that was back in October. So this level is the highest since November, I believe. Back in October, we went through 4.3% on a 10-year maturity. But it's how we're doing it this time that I think is intriguing.
Dead on.
It's off the back of Treasury supply, not just better economic data and the threat of a Federal Reserve going harder. And Lisa, you made this point, and I'm with you. Yes, yields are up at the front end today by 4 basis points, but through Thursday, they were only higher by a single basis point. This curve was steeper, and the move we've seen all this week has been at the very long end of the curve, 10s and 30s. It has not been at the front end.
Which is the reason why the conversation shifts to what risk premium the U.S. needs to have embedded in it because of fiscal risk, and also whether the Fed will truly bring inflation down to 2%.
The jobs report 1 hour away. In our survey, the estimate 200K. Live from New York City. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
August is never quiet. You want it to be quiet, and then it's not quiet. Equities right now on the S&P 500, just about positive, rolling over in the last, let's call it hour or so. We're positive by 0.1% on the S&P. On the NASDAQ 100, up by 1/10 of 1% also. We'll talk about some single names in a moment. Amazon doing well, Apple not so much. In the bond market, 2-year, 10-year, 30-year. Let's cut up this yield curve and just go to the 10-year maturity. That 10-year, every single day this week, Monday, Tuesday, Wednesday, Thursday, now add Friday, yields higher by a single basis point this morning to 418, getting closer to 420 and up by more than 20 basis points on the week so far. It's been quite a lift in this bond market. I want to turn to foreign exchange and just finish on the euro just briefly. A rare piece of good news out of Germany. Factory orders much, much better than expected. Factory orders can be really volatile out of Germany, and it's a few months old, but we'll take it, won't we, based on what the data's been in Germany over the last 9 months or so. The euro against the dollar, 109.42, negative there by 0.06%. Under surveillance this morning, counting down to the jobs report in about an hour from now, 8:30 a.m. Eastern time. The estimate looks like this in our survey, 200K. A range of views on the street, anywhere from 290 over at Citi, JP Morgan at the low end at 175, and Morgan Stanley, who we'll talk to briefly in just a moment, 190. Bramo, all of that still to come.
And a lot of people are going to be focusing on the underpinnings, the wage factor, how much people are actually starting to lose some of that power that we're seeing in some of the wage negotiations that we were talking about earlier this morning. That said, what I'm curious about, what if the market doesn't respond? What if the market is looking at this and they're saying, we can't really draw any serious conclusions. We're going to go back to the Treasury story. We're going to go back to the tech story and bypass this altogether. And I think that's going to be sort of the tail that we're going to see.
I would link it into GDP and the huge wrong guess of 2023, which is doom and gloom on recession. And the idea here of a vibrancy of some kind of GDP, a vibrancy of pretty darn good jobs growth, not one, granted, if we get a 3-month moving average of 170, I'll change my tune. We haven't got it yet. And I looked on the break, I looked at the ECI, which is wages and benefits. Oh, doom and gloom. It's rolled over ever so slightly, but on a trend basis, it's miles, John, from quote-unquote normal.
Lisa mentioned two themes there, labour power and tech earnings. Let's deal with labour power first. This story here, just to bring you an update, the United Auto Workers Union asking for a 40% pay rise over the next 4 years from the automakers out of Detroit. This according to our reporting here at Bloomberg. The request coming as contract discussions continue with GM, Ford and Stellantis. The Labour Pact, the current deal, expires next month. We've cut this one close on a few occasions with various negotiations, Lisa, including that one with UPS more recently. You wonder how far these guys are willing to go.
And you wonder if the UPS negotiations embolden the union to really go after other companies. We talked about Amazon with the union head, but I'm wondering how much they're going to start going after everyone, because at this point there is a shortage of workers. So does this highlight why there can be a stickiness to wage pressures that we hadn't experienced, and a lot of people have been saying will eventually roll over?
If you're at Amazon, you're sitting there thinking this morning, I want a slice of this, a slice of this. The stock is up by something like 8% this morning, call it 9% now. The stock is higher after the company reported better results, a beat and a raise. The e-commerce business doing okay. It's all about cloud, though. Cloud revenue growth over at Microsoft, disappointing. The outlook did anyway. Didn't see that at Amazon. That stock is up by 9%. Apple is lower by 2.5% this morning. And TK, I'm with you. We always beat up on this company about the upgrade cycle. The upgrade rate's not there. Then we get a new phone and everyone goes and buys it. And everyone's going to ask the same question again this quarter, Tom. Is it different this time? Is it different this time?
Yeah, they're going to do it. I mean, I stood on Fifth Avenue with Matt Miller and Larry Haverty, the giant Larry Haverty, on Apple, and they were going to die like 8 years ago. I can't remember, the exact time ago, but it's the same thing. We'll see, and we'll move it. Can I also tell you what's moving the needle on GDP?
Do whatever you like.
Taylor. And I don't mean
Taylor
James.
Swift.
Yeah, Taylor. Taylor just rocked $100,000 bonus checks to each of her truck drivers. It's like $50 million in total bonuses to the ERA staff. It's so, we've had some mistakes this morning because our control room, like there's 30 people in there, and they're all on the computer trying to get Indianapolis November of 2024 tickets. Taylor's
more than a year away.
She's doing that Taylor Swift is single-handedly going to move the American jobs market, and she extends the tour out to Indianapolis November 2 of 24.
Wasn't there a Scandinavian country that tried to blame price pressure on Taylor Swift tickets?
Exactly.
That was a thing, wasn't it? I didn't make that up. I'm pretty sure I saw that.
And Beyonce. Beyonce
was
also
Beyonce or Taylor Swift?
That was Taylor Swift, but there was another country that was talking about Beyonce tickets causing a surge
Beyonce
in inflation.
MetLife, I know that's a big deal. It's been discussed at home. Yeah.
We're getting a nod from our guest alongside us. It's a big deal.
Okay, it's a big
Done the research over at Morgan Stanley, TK.
We'll migrate off that to Sarah Wolf, senior economist in charge of Taylor Swift economics at Morgan Stanley, and joins us this morning. Where is GDP? I mean, the joke here is Miss Swift, with all of her abilities, with Jack Antonoff and the rest, is moving the needle on GDP. Forget about that. Yeah. We've been so wrong about GDP. Is this a 3% GDP America?
I don't think it's a 3% GDP America. We're tracking closer to 1.5% for the third quarter. But I think what's really interesting, where we're seeing the strength in GDP, because consumer spending's coming down, equipment investment's coming down, housing's been weak. Where has the strength been? Structures, investment, and manufacturing activity. What does that tie into? Onshoring, nearshoring, a lot of what's happening with the infrastructure bill. So I think that's really interesting, because typically structures are a very interest-sensitive component of the economy. They were up 94% in the second quarter.
I know Lisa wants to get to the jobs report, and she's right. Countdown 54 minutes, 6 seconds here on the official surveillance countdown clock. I want to talk to you about the new Biden stimulus, which is this manufacturing. Does Morgan Stanley look at our manufacturing oomph as nothing more than a federal stimulus?
So what's really interesting is if you track the outlays to government agencies that would be beneficiaries from the infrastructure bill, it actually doesn't look like outlays have ramped up quite yet. What does that mean? What's driving the manufacturing activity right now? Could be the subsidies that are going out, but I think it's private businesses getting ahead of it as well and taking advantage. All this means that there's probably more tailwinds ahead of us for manufacturing. It's going to contribute to growth. It's going to contribute to jobs. We took up our GDP forecast about 90 basis points just a week and a half ago to reflect the stronger investment in structures and state and local investment activity.
How would we describe this then? Is this a stealth stimulus coming out of Washington, D.C., working in conflict with the Federal Reserve? What's happening?
I don't think it's necessarily working in conflict. We don't think the capital deepening is necessarily going to be very inflationary. And if you look at these other interest-sensitive components of the economy, as I mentioned, consumption, equipment investment, housing, all of that is responding to higher interest rates. And we do think in the back half of the year, third quarter and fourth quarter, growth still will fall below potential finally, even with stronger manufacturing activity.
So given all of these longer-term horizons to understand where we are in the economic cycle, where does today's jobs report fit in?
So I will say that, the jobs report seems to be getting a little bit less attention than it typically does. I think it's because we have 2 jobs reports and 2 inflation reports between July and September, so there's a bit more data. You could see, I saw you guys posted the range of estimates ahead of time, and it's pretty wide. I think that there's a couple of things that we're looking at in the jobs report. The fundamentals, are we still seeing that slowing in the services side of the economy? That's reflecting that the shortages are being filled, weaker services spending. And then there's a lot of technical quirks to look for in the Friday, in today's payroll data, because there's weird seasonalities that could cause really big swings on private and public.
You say that there are two reports before the Fed's meeting, and so a lot of people are de-emphasizing what we're going to get and say they're going to try to look through the noise and just put it into their models. However, we do get Jackson Hole in between now and then, and a lot of people are wondering whether Jay Powell, I know John wants to know whether he's going to show up, but I'm wondering whether he's going to actually speak to some sort of acceptance of a higher inflation or an acceptance that they want the labor market to remain strong in a way that their 2022 pain-laden speech didn't really give. Are you looking for some sort of signal of a shift in thesis by the Fed?
I do think that we're going to start to see at Jackson Hole and going into the September meeting a shift away from the tightening bias towards a more neutral bias. I don't think Powell's necessarily going to go that extra mile and say that he's okay with higher inflation because they still have a target to hit. They're still quite a ways away from that. I think he will acknowledge that they've made more progress. He already said in July the risks are much more balanced of doing too much versus doing too little. So that's already a bit of a shift away from the tightening bias. But I don't think he's outright going to say anything about changing their target to 3%, for example.
Based on where we are now, I think he should skip it.
Why?
I just think he should skip it. He's got nothing to say. He still needs another CPI report after the next one we get next week. Still needs another payrolls report after the one we get this morning. I know we all want it. We want to hear from the chairman of the Fed. But if I was him, I'd consider skipping it.
So does he cut it down to 4 minutes?
And say what?
I don't know.
He had something to say last time around. Kept it really concise. Had a message to deliver. I don't think he's got one right now. Did that sound like a man who wants to deliver a speech? Didn't look like he wanted to be in a news conference last week.
John,
maybe he'll have something to say.
Like what?
Yeah, but maybe he'll say, we're going to accept 3% inflation. Right. That's it.
Okay, well, that would be pretty big.
That would be massive.
Here's the way it works. He cuts it down to 4 minutes. Then we all greet in the Pioneer Grill, have chip beef on toast, and Zettner shows up and starts fly fishing in Jackson Lake.
That's simple. That sounds like a nice get-together.
It's like, that's what Jay wants. Trust me, that's what Chairman Powell wants.
We're going based on recent scheduling, but I'm just saying from his perspective, I don't see that he's got anything to say right now. Didn't hear much in the news conference last week. Did you hear much in the news conference last week? Sarah, does that sound like a man who wants to go over to Wyoming and deliver a speech anytime soon?
Well, I think the trends matter. So we're only getting one inflation, one jobs report before August, but the trends are moving in the right direction. So I think there's something to say on the progress, and I think there's something to say on the fact that the staff's no longer forecasting a recession. He feels more confident that we're moving in the right direction.
Your forecast is a sub 2% GDP right now, forward.
1.3% for the year.
That's terrible. That's like on edge of, a lot of people would say that's a national recession for a lot of people as well. How do you have an Atlanta GDP now number that's just so great?
Well, they're doing a bit more of a nowcasting method, so we could get into accounting versus nowcasting. But if you're actually pulling in the data as it's coming in,
you're sub 2%.
We're sub 2%.
Yes.
Sarah, thank you. This was great. It's good to see you. Sarah Wolf of Morgan Stanley. Didn't get to Sarah on a ton of things I wanted to talk about.
Yeah, well, she can come on for an hour.
Student loan repayments later this year. We can do that again another time.
Yeah.
If you're the chairman of the Federal Reserve, I'm with you. If he goes up there in late August to Jackson Hole, Wyoming, and says something emphatic about all this progress we've made and how he thinks as his base case we can get a soft landing, and he really doubles down on that view, that's huge. But as a policymaker, rule number one, do no harm. And if you know there's a debate right now, also on the committee, that inflation may reaccelerate later this year, do you really want to go out there with conviction at the end of August and make some call about being done? I wouldn't do that.
Does somebody have to ask him? You said last year that you needed to get inflation down quickly in order not to have expectations become entrenched. Is getting to 2025 quickly before we get down to 2% inflation? Just saying.
I got questions too. And Chairman Powell, if you actually want to sit down with someone
that would be good.
In the financial media, that would be great. But I know you love 60 Minutes and non-interviews, so it's not going to happen anytime soon. Equity futures right now on the S&P 500. You loved that, didn't you? Welcome to the show. Welcome to the program. We're positive here by 0.07%. Jeff Rosenberg's going to join us later from BlackRock at 8:30 Eastern Time. Payrolls, Tom, just around the corner.
Payrolls are around the corner, but far more is this bond dynamic. And again, I'm going to go to looking at 10, 15 spreads as I did this morning under the USYC code, John. And the key one to talk to Mr. Rosenberg about is just bill versus note. 3-month T-bill dynamic versus the belief in the 10-year. No, that takes out the belly of the curve. It takes out the 2-year yield, which we quote a lot. But that's the spread to me that's really moved.
Need to talk about these tech earnings as well. Apple is still lower in the pre-market by 2.4%. Nadia Lovell of UBS coming up, Lisa, in about 17 minutes' time. Looking forward to that conversation.
Very much so, especially as we parse out the importance of data in this newly data-dependent world. And I keep saying this. Okay, in this newly dependent world, are we talking about the data this week? No. No one's talking about it. We've gotten data points. No one cares.
Said, yeah.
And this is fascinating to me. And at one point, you could just shrug it off and say, well, it's because the Fed's going to get other data. No, that's not been the story. People are saying, we're going to stick to our guns, come up with our thesis, and oh yeah, because the Fed's moving to a neutral stance, that's basically tacit acknowledgement that inflation's going to remain higher for longer. That is the story of the week, in addition to the BOJ and the financing and all that stuff.
You know the interview that I really want to see? Mike McKee, Chairman Powell, a special on Bloomberg TV.
Yeah.
Just 30 minutes.
Soft lighting. It could take
Soft
60
lighting,
minutes.
yeah, whatever. You know, you can be in charge of the lighting. But I want to see that, and we've been starved of real interviews with the Fed chairman. My view, futures just about unchanged. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Amazon collectively needs something like $3.4 billion for an incremental basis point or a percentage point of revenue growth. They're going to need advertising. They're going to need video. They're going to need healthcare. They're going to need something else to come in to take the baton from AWS over the long term.
Amazon in the pre-market up by 8.6%. That stock doing nicely on the S&P 500. Equity futures unchanged just in the last second, just rolling over to unchanged going into payrolls. 43 minutes away in about 20 seconds, TK. Yields unchanged on a 10-year also, 4.1818, just a little lift for a fifth consecutive session.
Yeah, churn of the market and all that. This was a really good conversation with Sarah Wolf from Morgan Stanley. This was a really, really smart conversation. And the word that's out there sort of in the summer is ambiguity, which we can look at different ways. But the ambiguous nature of this jobs report, it can't be understated. I mean, it's a big deal.
We're still talking about 200K.
Yeah.
200K. Which is a pretty solid number.
To review that, to review this is important. The pros pre-crisis, even pre-07, would say 150, sub 150 was a pretty moldy number. And I actually saw run rates under 100,000 at one point. We're nowhere near that at 200,000. I take the 3 months moving average of non-farm payrolls is the statistic I look at.
Things have slowed down. They wanted
Yeah.
to make some progress on job openings. Lisa, job openings lowest since 21, something like that. 2021. They've come in, quits rates come down, so that would imply we've taken some heat out of this labour market. But 3.6%, ask an economist, we ask them all the time, is that consistent with getting inflation down to 2? And the answer you get is no, it's not. And I hear that on repeat.
The problem is inflation has to be coming down right now. This is just a fact. Everyone knew that it would. And this is where everyone was talking about the last mile, getting it down to that 2%. And where is the willingness to do that? And that's really where the conversation needs to be. How do we understand this data in terms of pace? Is it enough for the Fed to have full conviction they're going to get to where they want to be?
Futures, Tom, just about unchanged. Amazon, just to turn to tech just briefly again. Amazon up by 8.5% this morning.
I like how you call it tech as well. Right now, Poonam Goyal and the non-techie part of Amazon, which is the cardboard boxes that are outside our door each and every day. Senior U.S. retailing analyst for Bloomberg Intelligence that barely describes the granularity that she looks at, whether it's Target, this, or Home Depot, et cetera, and the rest. Poonam, just as simple. With this earnings report, is it a victory lap for Amazon that they salvaged the cardboard box part of the business ex-COVID?
It absolutely is. You know, the results were impressive. The growth was strong. And not only was the growth strong, but they were able to drive better margin from lower fulfillment costs and offering more speed. So I think all around, you know, what they've proven is that they can get scale, they can get same-day delivery and save costs while doing it.
The amount of cardboard boxes, can you take that out to a terminal value out 3 years or 5 years? Combine cardboard boxes with a Prime program. How far out do you go when you extrapolate that business out?
You know, the online business today for Amazon, the total GMV is over $600 billion, more than actually $650 billion. And we see that going to $1 trillion in 2026. So there is plenty of opportunity for Amazon to continue to ship those cardboards, as you call them, and really drive meaningful gains to its marketplace. Now, that will be driven largely by 3P sellers. So we do expect the growth in 3P to outpace 1P as more businesses, more sellers look to Amazon to really capture share from their 200 million plus Prime members to drive their businesses higher, and in turn will drive the Amazon marketplace revenues higher.
So that's the good side. The bad side is Apple, at least right now, when it comes to a market performance where it seems to be on set to lose its $3 trillion valuation. Yes, you have this question around iPhone sales and the larger smartphone cycle. But on the flip side, services. They actually had a record number of subscribers to their Apple subscription services. Tim Cook name-checked Lionel Messi, saying thank you for all of those signups. How much can that really fuel future earnings in a way that has real tailwinds that people are underappreciating?
Yeah, so I think services is a big part of Apple's story. But I think, you know, when people talk about the iPhone business and that slowed, I think we really need to go back and look at the next quarter, right, when the iPhone launch comes out. Because iPhone 15, we believe, will be a big driver to iPhone sales again. And it may be a different story next quarter than this quarter.
So you think that it's going to be rebounding. What is the sense that you have in terms of the why behind the drivers of the slowdown in the smartphone cycle? Is it that people basically just want to keep with what they have, that the upgrades aren't enough to really prod them to move toward that? Or is it something that we've talked on the show before, John's brought this up, about the sort of pay-as-you-go type of model, that there is there's less appetite to really give people that credit to just pay in installments?
I think it's a combination. I think, you know, there haven't been as much of meaningful upgrades to recent iPhones, but I do think that the 15, we're expecting a sizable change that will draw more users to really upgrade their phones. But also you have to think about the consumer environment, right? Discretionary spending has slowed this year, and continue to hear that even from Amazon, where the focus is on value. So that could be part of the story as well.
How is retail in general doing, Poonam? Step back here. We speak to economists and all that, but you've got your thumb here. Brian Moynihan talking to our David Weston about the strength of the American consumer. Play economists now. What do you think?
I think the consumer still has the appetite to spend. We're seeing that as they make trade-offs for its experiences. They're still traveling, but they are mindful in how they're buying goods and where they're buying goods. We're seeing companies like Amazon do well because they have the value, the convenience proposition. But then we had companies like Revolve report where they're citing the higher end customer is now slowing too, and they are making trade downs. So it's really a mixed bag across retail. It sounds to us like there is money in consumers' pocketbooks, but they're making trade-offs. But that's been a story that we've had for quite some time now.
Does back to school matter anymore? Does back to school matter for Amazon? It must matter for Apple because everybody's got to go out and refresh the earpod thingies. But does back to school matter anymore, Poonam?
It absolutely matters. It's the second largest selling season of the year, just behind holiday. And for Amazon, it matters too because Amazon talked a lot about going back to basics, right? The basics inventory, really expanding that and having to focus on value. So they do want to see those purchases come in, whether it's clothing for back to school or supplies or electronics. Those are all key areas that Amazon participates in today. And the share that they'll grab for back to school will be an indicator on holiday sales as we move into the third and fourth quarter.
Stock is up by close to 9%. Poonam, thank you. Poonam Gore there of Bloomberg Intelligence. The retail side doing okay. AWS, the cloud side of the company, doing better than what we heard from Microsoft, all about the outlook there. So it was a beat and a raise. The stock is higher. Let's just talk about pricing over at Amazon. Tom Forte was talking about this service. I think for a lot of us, and I'll talk about myself because why not? For me, it's about convenience. It's not about price with Amazon anymore, at least in my experience. And Tom Forte was talking about the same thing, that service isn't great. Price elsewhere, you can find better prices. I think you just have that app on your phone. You know they've got this great logistics setup across the country. You know you can get it literally tomorrow. I talked about buying a book. I watched Gladiator, and then I'm buying Marcus Aurelius's whatever. The book comes the following morning.
Exactly.
Meditations, isn't it called Meditations? Something
Sensitive
like that, yeah.
guy.
Came the following morning, Bramo.
Are you reading in English or are you reading in
Arrived
Greek?
on Sunday, bang, no, translation.
So, thank you.
Well, but this is the question, and Tom Forte brought this up. There are competitors that have seen what Amazon does, and they've built up their own networks, and I'm thinking of Walmart. And at what point does that become competitive with Amazon in a new way because of a lack of customer service, because of the lack of efficiency and the lack of convenience of the return policy?
I'm going to go to the short-termism of the market, and particularly of financial television and radio. And the answer is pros like Anurag Rana, Mandeep Singh, and others. What they do is they look at the addressable market, the potential market of whatever you're talking about. In case after case after case, the addressable markets seem to be much larger than the cautious crew, the fear crew of 18 months out. If you look at 3 years or 5 years, where's the cloud? 3 years or 5 years out, where's Apple services? 3 years or 5 years out, how many cardboard boxes are going to be in the doorway in front of the walk-up John at home? I'm sorry, we're at COVID level. The cardboard boxes I see now
How many boxes you see?
are at COVID level. You know,
But where are they from? That's the question. Are they all Amazon?
No, that's a really good question.
That's the point.
That's the
Many are
conversation
from
we're having,
Chewy.
Tom.
No, I know.
Highly anecdotal and personal, this conversation, isn't it? It's like, got the analyst to talk about the actual
I don't
stocks.
see a lot of Walmart.
It's just like, let me
Seriously.
tell you about what I'm feeling right now about Amazon.
But I don't see a lot of Walmart boxes. Now that you mention it.
Haven't upgraded it for years. No intention of doing so.
You will. There'll be
Anything else?
Unless the iPhone 15 starts singing and dancing somehow, some AI robot, I don't know.
Then you'd buy it? Absolutely not.
Probably not.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsbee, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
I think the Fed was fighting yesterday's war on inflation. Inflation is softening.
Now the market is thinking, okay, maybe we cannot completely discount the risk of another Fed interest rate hike.
Financial conditions are indeed tightening.
The Fed overall has been remarkably good at taming inflation.
So from our point of view, this is a correction as opposed to an end of the run.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This hour, the payrolls report in the United States of America, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. TK back in a seat together with Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P just about positive on the S&P 500. 30 minutes away from that jobs report. TK, the estimate, 200,000.
I had to come in for jobs day. I got the plague a little bit, getting over it. Thanks for the messages, folks. Things are,
Thanks for sharing it too.
Good,
we appreciate that.
It's I got the IV going here. I got the Tang IV going here. So, it's good. I got the,
is that working?
The drip. The Tang drip is
spiked
with anything? Working out well. Yeah. Come on, John. Don't give away the trade secrets. Guess what? This is an important jobs report, and what's important about it is it's a 2-part jobs report. This month's next month. John, as I said, I take the 3-month moving average. It's the first thing I'll do when Mike McKee gives us the statistics. It's a trend here. It'll be really interesting to see. What do we do if we break 200,000?
I've missed you, Tom. The estimate 200,000, the previous number 209. Just to look at unemployment just briefly, that is expected to come in line with the previous month at 3.6%. And then we'll turn to average hourly earnings. Lisa, wage growth, a focus too.
The expectation will be that the average hourly earnings will come down on an annualized basis to 4.2% from 4.4%, which sounds like making progress. This is good. Here is the question. Tom said this is an important jobs report. Is it? All of the data that's supposed to be increased data dependency, nobody cares. Why? Because things are supposed to be going in the right direction. Of course they are, unless they're incredibly aberrant, unless there's something completely out of the norm. Will anybody respond to them? And this is my question. Are people just shrugging it off and saying, we have to wait and see, it's too soon, we need the trend lines, just like the Fed? So everyone's just basically going with their convictions.
Sarah Wolf of Morgan Stanley made the point, I think we all agree with her. The issue that we have now between the last Fed meeting and the next one is you have 2 of these and 2 more CPI prints as well. I'd go a step further. I think those 2 CPI prints probably carry a little bit more weight than what you're getting out of the labour market at the moment, because the conversation has shifted. Can you achieve that soft landing? That basically means, can you keep the labour market where it is without doing much, without changing too much, and seeing unemployment go too high, and get that inflationary progress we've seen? And if you get that over the next 2 CPI prints, then perhaps this Fed can talk about backing away.
They're going to play lip service to a dual mandate, but there's no dual mandate. It's all about inflation. I mean, it's just as simple as that. And I go back to the Michael Gapin chart at Bank of America here, and this sticky. I mean, we're not saying sticky now because we're getting used to 4%. But the answer is, since I was away on my 3-day sabbatical here, I mean, the answer is I'm looking at 4.93, 4.18, 4.28 on the 2s, 10s, 30s matrix. That's new. That's different. That's wow.
The 10-year up by more than 20 basis points on the week so far. Up today for a 5th consecutive session. Let's work through the price action just briefly. Equities advancing just by 0.1%. Yields higher just by a single basis point, almost. 418. 18 TK in the bond market right now. Just to turn to foreign exchange, the euro also negative by a 0.1% at 109.39. So a touch of dollar strength going into payrolls. 26 minutes away. Joining us now, I'm pleased to say, Nadia Lovell, senior US equity strategist over at UBS Global Wealth Management. Nadia, wonderful to catch up with you going into the payrolls report. 26 minutes away, Nadia. We do this countdown, getting closer to payrolls. Let me start with this question here. You said the hiking cycle ended last week. That's the house view. Now, Nadia, are you saying that this jobs report won't change a thing in 20 minutes?
Yeah, we think that the Fed ended last week. Of course, we are all on data watch, and so that's going to increase the volatility in estimates as well as the market. Chairman Powell gave us a playbook last week in terms of the 2 CPI and the 2 job reports being important. But we expect that the job numbers to come in under 200. We are also expecting to see progress in terms of wage growth. We already saw that in ECI last week in terms of annualized 4%, and still a little bit more room to go to get to 3.5%. That's more consistent with the Fed's 2% target. For next week, for CPI, we're looking for CPI headline to increase to about 3.2%. A lot of that is base effect, but on a month-over-month basis, we're looking for about 20 basis points. So we think that we are on that path to get to lower inflation by the end of the year. We're looking for headline to come down about 3% and core to come to about 3.7%. So we do think that that will give the Fed enough room to stop here. At the very least, we know that Chairman Powell did say that September could be live meeting, but we think that the bar is higher for a raise even in September.
Really unfair of me to ask, but what kind of jobs number today would reintroduce the risk that you're wrong?
I think if you see a job number, I think if you see a job number closer to 300,000, then we could be wrong. Or if you see a job number that suggests that the labor market is rolling over, that could lead to a faster cut by the time we get to year end.
I mean, this is great. Jack was so delicate about that.
I almost laughed this one. That came across as far more aggressive than I intended it to.
Yeah.
What I really meant, can we go again? Can we rewind the tape?
3, 2, 1, go.
Nadia, what kind of jobs number would reintroduce the risk that the Federal Reserve has to hike interest rates again? TK, that's what I wanted to ask.
This was good.
This is going really well.
Let's save the interview right now.
Okay.
Ms. Lovell, if I can, if we get a shock off whatever the trend rate is, whatever the vector rate is, let me go to the shock number under 200,000. Where would the shock number be given standard of error, 1 over square root of 150 million or whatever the statistic is? What would be the shock statistic that would make everybody wake up at 8:31 a.m.?
I I think in terms of like, if you do see the job market slows to 100,000, then we have seen a lot of growth optimism priced into the market. Then there would be concern about what does that mean for corporate earnings? What does that mean for the economy? Are we heading towards a recession and this soft landing narrative that is taking hold? It would call that into question.
And Lisa, what's so important here is that's that 100,000 statistic, 105, 110, who's counting, versus what David Kelly at JP Morgan was talking about, which is when do we get to a negative non-farm payroll statistic? Am I right that nobody's calling for that today?
Nobody's calling for a negative payroll statistic, and the data does not suggest that, anecdotal or otherwise. And there's a real key question, unless it's a shocker, Nadia, why anyone will care, why everyone won't just shrug it off and say, we'll plug it into our data set and we'll see how it goes, which really raises this paradox. In this newly data-dependent Fed paradigm, where suddenly they're not giving any forward guidance, does the data still matter, or is it just basically people keeping on with their convictions going forward unless there is some massive surprise?
I think that's fair, absolutely, in terms of like the positioning in the market. Again, it points to a soft landing. And so I think that if you don't have a surprise on either side, then this market is probably a range-bound market, because in our view, like the actual optimism from the growth side of soft landing hasn't really caught up with the corporate earnings yet. So we have seen, obviously, valuation extended quite a bit. And so we do think that that makes the market a little bit more vulnerable to any sort of shocks or disappointment. I mean, we saw that play out a little bit earlier this week with the Fitch downgrade, and then the Treasury, the large new issuance in the Treasury market that really triggered a backup in yields, and that bear steepening causing some angst in the market. So we think at some point that the baton has to be passed to earnings, and the outlook for that remains somewhat subdued. In our expectations, we're looking for sort of mid-single-digit growth over the next 12 months. And so we think that this market is probably capped as a result of the earnings outlook. And so we're looking for more of a range-bound market with some oscillation, but in sort of a 10% band. So we do think volatility will pick up near term.
That said, a strange thing happened on the way to higher rates. And we were talking about this earlier, that when you have tech companies that were supposed to be so interest rate sensitive, they oddly have a lot of cash, and they can put that cash in T-bills, and they can actually make money off that cash. It actually ends up being a benefit to them that was unexpected in a way that has boosted their valuations. At what point do you say, you know what, stocks can do better, and they can actually increase even on multiples, even if earnings do have a couple of quarters of sogginess, but then pick back up?
Well, Lisa, I mean, you're at a valuation multiple of 19.5 times. And so you already have that optimism priced into the market. So it has to be the earnings have to pick up to justify these high valuations. It's the hope that some of these companies grow into that valuation multiple. I mean, even in tech, you saw some disappointment in the earnings outlook, and companies are being punished with that. You've seen that play out today in the market. I mean, reality is it shouldn't be too surprising that the largest smartphone company, is seeing some weakness when semis have been pointing to continued weakness within smartphone and PC now throughout the earnings season. And the IT budget environment still remains pretty challenging. So we do think that the two has to meet at some point, and we're starting to see that play out throughout the earnings season. I mean, when you look at the market, it's really flat over the last 3 weeks since the start of the earnings season.
Nadia, just before you go, favorite sector right now, what is it?
Energy.
Is it really? Do you like the rally you've seen recently then?
We upgraded energy in June, and since then, energy has been the #1 performing sector, and we still think there's more to go. We do think that oil prices are going to get to $90 in the next few months and overshoot to the upside. I mean, we're looking for a 2 million barrel a day deficit in this market, and that could increase if Saudi Arabia continues to implement these cuts.
Early June, that's a great call. Nadia, thank you. Yep. Wonderful to catch up as well. Nadia Lovell there of UBS Global Wealth Management. That's when we started to see that broadening out of this rally time in this equity market.
Number one thing I'm watching in energy is demand side. And Jeff Curry had a note on this a number of weeks ago. Others as well. JP Morgan has a foundational view. There'll be EM demand that will support oil. Yeah, it's been rough the last year. Ed Morris at Citigroup looks like a genius. But the bottom line is everybody's focused on supply.
Well, Saudi and announcement yesterday.
The three of us should be in Vienna next OPEC meeting. I get it. Forget about it. It's about demand.
Is Manus going to host us?
Yeah, Manus will host us. Can I do a surveillance correction?
Of course,
very
please
important.
do, yeah.
I got to do it now at 8:11 before the jobs report. You don't want to do it at
18 minutes
8:27.
away. Yeah.
You mentioned the book you were reading there.
Yeah.
And I said, Greek or English. And Lindsay, thank you, Lindsay, for emailing in. Lindsay.
Latin.
Latin. She said, you're out of your mind, Tom. It's Latin. It's Latin, not
so
Greek.
Aggressive.
Yeah.
I was never smart enough to study Latin.
Yeah.
Did you study Latin?
No, I feel the lesser for it. The Offspring did. I was very impressed.
You feel lesser for it?
I wish that I had Latin at gunpoint.
That would be quite on brand for you, yeah.
Yeah.
You probably
and
need to sing Latin.
I had ice hockey. It's difference.
True. At football. If you're just tuning in, welcome to the program. The S&P 500 positive here by 0.1%. The jobs report, 18 minutes away, a little bit less than that now, looking for a number of 200K. That's the median estimate in our survey, 200,000, basically in line with the previous number of 209. Always looking out for revisions. The unemployment rate expected to come in at 3.6%, the previous number, 3.6%. Then you turn to wage growth, month over month, looking for 0.3, year over year, looking for 4.2. Just a touch softer than what we got, Lisa, last month out.
You know what, I kind of make the analogy here with this jobs report for people in the market? It's kind of like going to the doctor and getting a blood test, and you go down the list and you sort of like check off normal, normal, normal. And as long as something isn't abnormal, you keep going and you just keep going along with your life. That's almost like what this data point really is. It's sort of, as long as it's within the range everyone is expecting, they check it off the list and they keep on going with their day. It's not going to materially shift with just some sort of subtle upside surprise or downside surprise. It's not going to shift the market all that much.
You need some vitamin D.
Exactly, like just,
or vitamin.
Vitamin. I mean, it's very.
Vitamin,
it's okay. You can.
No, I'm on board.
Okay.
Vitamin.
Really?
Totally.
What about
Why not?
aluminum?
Do you know the whisper number published on the Bloomberg? John, I didn't know. The whisper number is 223,000. Mike McKee taught me how to look this up.
Isn't that basically in line with the median estimate in the survey?
Well, the survey's 200, and the whisper's 223. I did not know that. To me, that's
just a touch higher.
That's a touch. 23,000?
Yeah, I mean,
10%?
It's kind of.
Is that going to really move the needle? Oh, the Fed's going to go 50.
No. Jeff Rosenberg of BlackRock coming up shortly after the number. 8:30 Eastern time. It is 16 minutes away.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Given that private payroll slowed to an expansion, a low of 149,000 last month, and jobless claims have stayed very low, the possibility of a stronger report is there. I think that what we really need to see is whether or not the slowdown is intact and whether or not the gains that we've seen in the labor force can persist while we have a slowdown.
The jobs report moments away. That's Steve Whiting there, the Citi Global Wealth Chief Investment Strategist and Chief Economist. The number we're looking for, we've repeated it repeatedly, 200,000, the median estimate in our survey. That number drops at 8:30 Eastern Time. Going into it, the scores in the market look like this on the S&P 500. 3-day losing streak through Thursday into Friday. We're positive by 0.06%. Yields higher for a fifth consecutive session. Yields up by a basis point or two to 419.20. Just short of 420 on a 10-year. Highs of the year, Tom, up by more than 20 basis points on the week so far.
On the week so far, it's a changed landscape. And just to sit on this for a moment, John, the 30-year here, 4.28% gets you out to a new 7.3x% bank rate 30-year mortgage. And I'm sorry, there's a point where this is not glide path. It's not smooth. There's a point, you can use the cliche you want, kink in the curve, jump condition, whatever. There's a point where this really clicks into a higher rate. I'm not sure we're there yet. But out there somewhere, if we keep nudging up like this, is oops.
We felt like that, though, Tom, for the best part of 12 months, haven't we? And
We've been rationalizing it. Yeah, we keep pushing it out.
Sure.
I just wonder when that'll be. On this Jobs Day, 12 minutes to go here, we dive in as we usually do. Jeffrey Rosenberg scheduled to join us here in a bit. Right now, former governor of the Federal Reserve System, truly our arch financial economist, Randy Krosner, joins us from the Booth School in Chicago. Randy, I want to go to the algebraic equation of the GDP that underpins our labor economy. And there's a lot of focus right now on the I, the investment across America. Is investment across America creating jobs right now? And is that investment nothing more than government stimulus?
That's really the key to the long-term growth and long-term job growth is investment, because without investment, without the capital goods and technology for people to work with, you're not going to have high employment, you're not going to have productivity growth, you're not going to have overall economic growth. So that's crucial. Obviously, as the hurdle rates get higher and higher, as the Fed raises rates, and also as inflation comes down, and so that the real rate, that is the inflation, goes up, that may put a little bit of a crimp in investment going forward.
I want you to look at almost a societal view with the leadership of the late Gary Becker Friedman at the University of Chicago. What is the 3-month moving average non-farm payroll statistic where you can say there's a societal angst? Is it 170? Is it under 100,000? What's the statistic that begins to signify labor pain?
Yeah, I think it's not just that piece. It's a combination of things. It's labor force participation, and we've seen for prime workers that move up, but for older workers and younger workers, still not quite where it was before. And it's not just about the job, but how much you're making when you have that job. Are you able to afford to put food on the table for your family? You could be working really hard, but if your real wage is going down, that is your inflation-adjusted wage is going down, it doesn't matter whether there are more jobs if they're not paying enough. So you really have to make sure that you get the balance right. You've got jobs that are generating real wage growth, and that there are enough jobs that people can, that households can afford to put their families, deal with their families well.
So we were talking earlier, Randy, and Tom brought this up about the dual mandate of the Federal Reserve. And it seemed like for a while there, certainly during Jackson Hole last year, there was one mandate, and it was getting inflation lower. Now we're looking at truly what could be a dual mandate, where suddenly they're saying, we have the possibility of a soft landing and we don't want to kill it. How important is that to them to preserve this kind of strength that we continue to see as long as inflation keeps coming down, even if not 2%?
So I think you're exactly right. I mean, they have gotten this gift. I don't think anyone a year ago at the Fed or really anyone else thought that, we've got this perfect way of doing things. We can have this immaculate disinflation with the inflation rate coming down significantly without the unemployment rate going up. That's not what our traditional models would say. We seem to be moving in that direction. I still don't think we're, I'd say, 100% sure of that, but there's more evidence of that. And the Fed would like to preserve that for sure. As I said before, the ideal is to have continued job growth at a sustainable level with good real wage growth. And we're starting to see real wage growth. Inflation rate has come down very significantly. Wage growth is still is now above that. that is going to have to probably come down a little bit to make sure that we don't have inflation persist. But we're getting into a better situation than we were before.
Given the fact that there is this emphasis on trying to get the sort of the hope of the soft landing, how much are you looking for some sort of tacit admission by the Fed that it is not important to get inflation down to 2% in the near term over the next few years?
Oh, they're not going to suggest that in any way, because I think their view is that in the both in the intermediate and longer run, that if you have high inflation, you're not going to have people have good, strong wage growth. You're not going to have a strong economy, and that's ultimately what they want. And so I think they're going to continue to say our key mission, our priority right now is to make sure that we get towards our target. Then the question will be, once they get close enough, what they said they will sort of maybe start to pivot once they see that inflation is on a sustainable path to its 2% goal, sustained and sustainable. That's not a well-defined concept. We'll see how that plays out over the next year.
Randy, stay close. The jobs report is 7 minutes away. I just want to bring in Mike McKee. This is what we'll do. We'll break the jobs report in about 6 or 7 minutes' time. After that, we'll get to Mike McKee. We'll speak to Randy. Jeff Rosenberg of BlackRock coming up shortly as well. Mike, great to have you with us. For you, what's the big focus today going into this report?
Well, I think we're going to be looking at three things. The overall job creation level, it's not so much the number, but the direction. Is it slowing? Unemployment, does it rise at all? Because the Fed just mathematically is going to have to raise their target, or actually lower their target for unemployment at the end of the year. And then average hourly earnings, does it continue the movement down towards a sustainable level? If you get that, then the Fed is going to be relatively happy about the number today.
You get the feeling that next week's CPI report is a little bit more important than this jobs report that people are expecting to come in a few minutes' time, Mike?
I think so. In the terms of momentum, do we still see progress on inflation? I know Sarah Wolf was telling you earlier, and I agreed with her, that there are 2 jobs reports, 2 CPI reports. You get a PCE report. So you get a little bit less attention on the number today and the number next week. But when we get to September, then there's going to be laser focus on it, because that's really going to be determinative. They want to see a trend, not just a data point.
Are you worried about lifeguards? Is this a good data point,
I can swim,
or are there lots of nuances here?
Well, I thought you were going somewhere else with that, because there is a shortage of lifeguards out there, because you can't find people to work. And a lot of cities are reporting they can't open their municipal swimming pools because there aren't enough people to work.
Is that a thing?
As lifeguards.
Yeah. Wow.
But I think at this point, we're looking at a still tight labor market. And the question is, does that continue to produce inflation, or do we get that Goldilocks scenario that gives us a soft landing?
So much of this hiring has been in the services sector. How much do you expect that to continue to demonstrate that type of increase, that type of acceleration at a time when the ISM that we got yesterday was more subdued?
Well, you can't say never, given the way that the economy has developed over the last 2 years, but you have to think services are going to continue. Everything is telling us, even the ISM number yesterday is telling us that services are still hiring and still looking for people, whereas manufacturing, there are a lot of mixed messages out there about whether we're going to see a decline in manufacturing jobs, because we've seen a lot of slowing in manufacturing, but then we see all this construction work going on. It's really hard to tell, but the odds are we're going to see a gain in services today and maybe a decline in manufacturing.
Just quickly, any Fed speak after this we need to pay attention to?
Surprisingly, you should ask. Yes, David Weston is going to be talking with Austin Goolsbee today, the Chicago Fed president, in the 10 o'clock hour, and then we'll be talking with Raphael Bostic later today. So you want Fed reaction? We got it for you.
That's why I did it, Mike, just to tee you up.
Thank you.
The jobs report coming up next, with equity futures on the S&P 500 just about positive. The number we're looking for, if you're just tuning in, just for you, for everyone else, I'm sorry I'm doing this again. 200,000 is your median estimate in our survey. That number on repeat this morning. 200K. That's the number we're looking for. The jobs report is up next.
This was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Your jobs report seconds away. The bond market, bond investors, they want a vacation after this week. Wall Street wants this number to be a total snooze. We'll see if it is. Your equity market on the S&P 500 positive by 0.2%. Yields higher for a fifth consecutive day by a basis point on a 10-year, 418.38. The jobs report, the estimate, 200K, the number with Mike McKee. Good morning, Mike.
Good morning, John. It's a snoozer. All right, everybody, turn off your alarms. 187,000. That's a bit of a surprise because it comes in lower than anticipated and certainly down from the prior month's initial read. I'm waiting for the revisions to drop. Private payrolls up 172. That is down from the forecast of 180. It was only 149 last time, but interesting because the ADP number was so strong, and this compares with that. 49,000 jobs less in the revisions over the last 2 months. So that's going to be a shortage of jobs that will help the narrative that the labor market is slowing down. Unemployment, though, 3.5%. Falls from 3.6%. I'm going to guess that has to do with the labor force. We'll take a look. Average hourly earnings come in strong, 0.4 more than anticipated, leaves the year-over-year number at 4.4%. And average weekly hours drop by 1/10. So that is maybe a sign the economy is slowing a little bit. Labor force participation unchanged at 62.6, and the U6 number, the underemployment rate, 6.7%. The prior month of July was revised down to 185 from 209. So that's going to be the weakest in some time. And the change in private payrolls revised down to 128 from 149.
So in the market right now, Mike, I would say there's a bit of a tug of war. A competition between a downside surprise on payrolls put together with a reduction in hours worked, competing with still hot wage growth, which comes in just a little bit hotter than expected at 0.4. So this is how the equity market responds to it. I think initially to that downside surprise in the payrolls report on the headline number, equities up by 0.25% on the S&P 500. Yields fade at the front end. So the 2-year was a bit higher by 3 or 4 basis points through this morning, now up by only 1 basis point to 4.89. And the dollar a touch weaker against a stronger euro dollar 109.69, positive by 0.2%. Mike, can you frame that a little bit more for us? It's a downside surprise on payrolls, but wages come in a little hotter and unemployment drops to 3.5%.
Yeah, this is why the Fed is going to hold off and not look at one data point, because we've seen some numbers that suggest that maybe the labor market is getting a little bit looser, but then you look at the unemployment rate and you're looking at a problem for the Fed, because if that's what's driving up wages or keeping them higher, then they're not going to make the progress they want to make. They're looking at this as the labor market loosens, it's easier to find workers, and then we don't have to pay them as much. But it doesn't look like much has changed over the last month.
I look here, Mike, and it gets me back to Q4 of 2019. If I take out the gyrations of 2020, all the COVID emotion that was there. All of a sudden, with the revision, 209, I believe, is a revision, and then a sub 200 number, we're getting a feel like pre-COVID. Do you look at this as the first pre-COVID jobs report equivalency?
Yeah, that's an interesting point, Tom, because pre-COVID, we were still, 187,000 jobs is still a strong report. We would have said this is a strong report if we were looking at it in July of 2019. Because of the pandemic distortions, everything got blown up. So now we think, oh, this is the weakest since the pandemic, the weakest first print, but it's still reasonably strong.
So well said, Mike McKee. Your equity market faced just a little bit. The knee-jerk reaction off the back of the payrolls report, worth looking at, of course, but you never know how the session's going to end after this. The equity market just elevated by 0.1% on the S&P. We're going to continue the conversation in the next hour on Bloomberg TV, so look out for this. Rick Reeder of BlackRock, Mohammed Al-Erin will be joining us as well. Mike Collins of PGIM, alongside Anastasia Amoroso of iCapital, and we'll do a bit of Apple in the mix as well with Angelo Zeno of CFRA TK. All of that still to come.
March 8th, the 5% of two-year yield up now 2 basis points, 4.90%. And you wonder here if we get to visit 5% here with the mix, the jumble that we see here. Randall Krosner is with us, the former governor of the Federal Reserve System, and Jeff Rosenberg as well from BlackRock. Governor Krosner, if I can go to you right now, I was talking to Mike McKee about how we allude back to pre-COVID. Are we beyond COVID? Is this a jobs report now that really begins to feel like Q4 of 2019?
I think that's right. And exactly as Mike had said, this is still a pretty strong report. If you put it into the bigger picture context of how much job growth we've had, you still have an unemployment rate that is, at or near its 50-year lows. And I think the hawks and the Fed are really going to focus in on the wage growth. And that's going to be the real concern for them, because the thing that's going to make inflation persist and be difficult to bring down in a sustainable way will be employment costs. And I think that's going to be the thing they will focus on, and they're going to argue the labor market is still strong. We're going to need to move more. Of course, you're going to have the Doves who will take the other side. But I think there's enough here for the hawks will say we got to be vigilant. But as you've all said, a lot more data to come out in the next couple of months.
How many hawks are there left? In other words, is that going to be sort of the relegated members in the corner while everybody else says, but we are seeing the number come down, and that's a good thing?
Well, I think everyone wants to see overall inflation come down, and that is good. And everyone wants to see good real wage growth. But I think that the key challenge is that now, as the inflation rate has come down substantially, wage growth is still persisting at the rate that it was. And unless we get a real boon in productivity, and we did get a good productivity number last week, unless we see that persist, it's going to be hard to make all the pieces fit together that the Fed can feel comfortable if they're coming down to 2%. But maybe ChatGPT and AI is going to allow us to have this incredible productivity boom, allow real wages to be growing, and we can bring inflation down. That's the true Goldilocks scenario.
We say goodbye when Professor Krosner mentions AI. Randall Krosner, thank you so much for joining us each and every Jobs Day. Greatly appreciate that this morning. We continue with Jeffrey Rosenberg, Portfolio Manager, Systematic Multi-Strategy Fund at BlackRock. I don't know which way this is going to cut. Jeff, we talked to Steve Major of HSBC at Bloomberg today, and there's this whole idea of, okay, we've had this move, now which way does it cut? Are you betting here on a direction in the yield market, particularly off a quiescent jobs report?
Yeah, Tom, I think when you look at this report, there are some mixed comments, as Jonathan was just talking about, between the wages. But the headline is really a story of gradual labor market normalization. And gradual labor market normalization basically continues the market expectation that the hike of the last meeting was the last hike. And that's the big change in the yield market outlook, is that we're seeing the effects of normalization in the labor market. Yes, wages will follow, maybe not. That remains the uncertainty. But you look at the ECI report, you look at some of the other broader reports, what do they show you? They show a gradual slowing in wage inflation. And so that feeds into this narrative that the Fed can be done, they can wait. And so for the yield outlook, it's really about the shape of the curve. What we saw this week, the steepening, and I think that remains to be the message. That's our main focus in terms of our position.
In your broad mandate, which spread gives you the most information right now? Which comparison of two yields gives you the most information?
You can look at lots of different measures. We tend to like the five-year forward. It's a nice measure. It captures both the level and the shape of the curve, and it's moving. And we've seen a significant move this week, and for good reason. The back end of the curve is definitely a bit more challenged when you look at historic levels of five-year forward. If you look at, I think you're showing here we look at the 2s10 spread. And I think that's really where the market pricing is a little bit vulnerable. When we look at all of the information that we saw come out this week, and away from kind of the monetary policy focus, it's really about fiscal policy. We had the refunding announcement, and you see very, very compressed term premium, both in real and inflationary space. And that's, I think, the vulnerability that we're looking at.
Jeff, I have to go back to something that you're saying, that what people are assuming is the Fed is done. They're not going to raise rates more. And that's what you're seeing today, where there's a little bit of a move at the front end. But really the move that you're seeing is at the 10-year yield once again reaching 4.2%, the highest levels going back to November. This is the key question. Is the Fed going to take their foot off the brake at a time when we're still seeing wages go up? Is that basically the assumption of markets now looking at a Fed comfortable with 3% inflation over a longer period of time and not needing to get down to 2% so quickly?
Well, it's a really good question, Lisa. What does taking the foot off the brake mean? Does it mean not doing another hike that they signaled last meeting, 2 meetings ago? Or does it mean just simply leaving rates unchanged? Or does it mean, as the bond market is anticipating, that they move to cutting interest rates? And I think as we progress this debate, we're going to increasingly talk not about the next Fed hike, but how much inflation decline, if we continue to see that decline, how much inflation decline do you need to see before the Fed has to start cutting rates? Because as inflation declines and the Fed stays pat, real interest rates, the real Fed funds rate, which is the transmission mechanism for monetary policy, that begins to actually increase. So how much actual breaking does the Fed tolerate, not by their action, but by further declines in interest rates? And that's going to be the metric that Powell is really telling you about in the press conference from last week. That was really the story, is that as inflation comes down, their policy gets tighter. And how willing are they going to be to see that tightening in policy? Again, this is all predicated on this expectation that we'll continue to see further declines in inflation. And obviously, if that changes, the whole story changes. But that is kind of the natural breaking that occurs without the Fed having to do anything.
Just quickly here, Jeff, it seems like there's been a narrative shift over the past couple of weeks where higher for longer is more acceptable, as well as a soft landing type of scenario. How much are you leaning into this and adjusting your expectation of yields being higher for longer, but also risk assets continuing to chug along in the meantime?
Yeah, I mean, part of the problem with adjusting too much is that the market pricing for so many risky assets is already there. So when you look at, is there a lot of opportunity in credit markets, for example, for the soft landing being realized? You see that you're pricing in many cases mid-expansion type levels for expectations. You look at the high yield bond market, for example, it has been on a tightening tear. It has never really reflected the same degree of recession fears and recession probabilities that you see, say, the consensus economics profession now, moving away from, pushing down recession probabilities. You never really had that priced into the credit markets, this huge disconnect between, the sleuths, the credit indications in the surveys and what's priced in the market. So there is an opportunity. It's really about carry rather than price appreciation, because a lot of that price appreciation already happened off of the November lows of last year.
Jeff Rosenberg, thank you so much with BlackRock this morning. Greatly appreciated. Here off a jobs report. Lisa, are you with me here that we got a bid to the market? I mean, we want to go down. I see some red on the screen, and then we come back with a little bit. It's a fractional lift, but within the snooze fest, it's genuine.
What I would say is I want to build on what John was talking about, the tug of war between the headline rate that was below expectation and then the wage number that came in stronger than expected. And what I feel right now in markets is the wages is actually winning out. It is dragging down an index that initially popped, and it is pushing up yields, particularly in the 10-year space. And to me, this is the theme. You have still that inflationary pressure, even if on a headline number, you're seeing that normalization.
And we haven't talked enough about this. I'm going to look at the real yield here at 1.80%, 1.81%, which is a long way a higher statistic there than what we saw 2-3 weeks ago as well. Diving into the data, I'm looking over here, folks. It's like in fourth grade when you look over at the smart guy and say, what's he looking at? It's like 18 columns with 75 rows of data. What's the number on that screen, Mike McKee, that matters?
As long as I can still read that tiny print.
I can't read it.
I'm not old yet. The numbers that matter, of course, today is the unemployment rate and the hourly earnings numbers. And the unemployment rate comes about because we had 268,000 additional workers in the household survey, and they counted negative 116,000 that lost employment during the month. So a big difference there that puts the unemployment rate down to 3.5%. When you look through the overall list of jobs, the two things stand out. One is that the changes are small. For most categories, they're either plus 100 or plus 1,000 or down 1,000 or something like that, as opposed to gaining 10s and 20s.
Anything on lifeguards?
I don't see lifeguards in there, but that's probably under amusement parks, and we can look at that. But the other thing is that the biggest job-losing category is management of companies and enterprises. And this has been a story that companies are holding on to their lower-skilled laborers because they're afraid they can't find them anymore, and they've been right-sizing or rationalizing their expenses by getting rid of layers of management. And so we do seem to be seeing a little of that in there.
Mike McKee, he'll interpret this through the 9 o'clock hour on radio and television as well. Right now, on this jobs day, with all that we see in the market, futures up, fractionally up as well. Without question, the conversation of the day on having the courage to be in this market, given the sum of all our fears. Edward Yardeni joins us, president of Yardeni Research. I can't say enough about his prescience, once again, across many decades in October of last year. Reaffirm, Ed Yardeni, how a bull acts and moves forward, given the many fears that are out there.
Well, I've been thinking that we've been in a recession since early last year, as we've discussed before. It's just been a rolling recession. Now I think we're in a rolling recovery, and I think increasingly the markets obviously have discounted that, and the so-called Godot recession still hasn't shown up. It may show up at some point. But with regards to the market, my year-end target for the S&P 500 was 4,600. We got there a few days ago. So I'm thinking I'm not going to raise my target of 4,600. I'm going to keep it there. I think it's going to turn out that the expectations at the beginning of the year was that we would have a pretty lousy first half of the year and a good second half of the year for the market. I think it's going to be the reverse of that. I think we've clearly had a very good first half. And I think the second half is just going to be challenging. I don't think it's going to be a big downer. I think it's going to be kind of sideways. September's coming, and that obviously could create some problems. But by year end, I think we'll be at 4,600, which is where we were a few days ago.
How much are you buying in to this idea that we're going to see higher rates for longer, particularly in duration, in 10-year notes, in 30-year notes?
Well, I've thought that on short-term rates that the Fed was pretty clear what they wanted to do, and I took them at their word. I know there's always skepticism and the feeling that the Fed isn't going to get it right, but they've been saying they wanted to get the short-term rate up to a restrictive level. I think they're there at 5.25%. I don't think they have to do any more. I think they're just going to leave it there. What is interesting is my friends, the bond vigilantes, seem to be saddling up. And I thought we'd hold around 4%, but here we are back at the November high of 4.2%. So it's looking a little dicey on the bond side. And I think suddenly we have to take into consideration that while the Fitch rating agencies downgraded the U.S. government debt was sort of the event that focused everybody back on the deficit, the fact of the matter is we've all known that the deficit is a problem. We've known that fiscal policy is profligate. It's just the market cares about it now. So if the market cares about it, I've got to care about it.
At a certain point, Ed, when does the higher rate structure at the long end, at the 10-year, at the 30-year end, not on the short end, threaten your bull thesis?
Well, I think that it already has done its damage in the one area where the rolling recession has hit, and that's in housing. But even there, as we've seen of late, the housing market's holding up pretty well, at least in terms of prices, and there really is a shortage. The real issue is the consumer. Will higher long-term rates knock down the consumer? And I don't think that's necessarily the case at this point. The consumer obviously depends on a certain amount of consumer debt. But the key is employment, the key is wages. And while employment weakens somewhat, it can always be revised one way or the other. We know that the wage number at 4.4% well exceeded well, let's make it 0.4 because we're doing month to month. So 0.4, we know that it exceeded the CPI. And so real wages are increasing, and consumers have a lot of wealth in their houses. The baby boomers have a lot of wealth. They're retiring and spending it. So all in all, I'm not quite sure how a increase in the bond yield knocks the consumer down, unless we just get some sort of banking crisis event again as a result of that.
Just quickly then, Ed, how much are you thinking that the Fed has still gone enough, even if we are seeing this sticky inflation and wage pressures?
Well, it looks sticky, but I think the productivity numbers are starting to come through. Yesterday, we had a remarkable increase in productivity of 3.5%. It was so remarkable that even a bull like myself didn't quite believe it, because it also indicated that employment was flat, which wasn't really the case, as we know, based on the monthly data. But I think productivity is going to make a comeback, and we may very well see wages rising faster than prices.
Ed, long ago and far away, on a Friday evening, Lou Rukeyser would sit there with you on the couch, and he'd say, what's it look like long term? Modern day long term is 9 months. Maybe it's a year, Ed Yardeni. For the mere mortals watching and listening, where long term is 3 years or 5 years, frame out the growth you see in revenue of our equities. It seems to be pretty darn good, like 6%, 4%, whatever. Give us a Yardeni 3-year perspective.
Well, I actually like to do decade perspectives, and this decade, I think, started out with all sorts of problems. At the very beginning of the decade, before the pandemic hit, I started talking about a possibility of the roaring 2020s with productivity making a big comeback, and that looked absolutely delusional there for the past couple of years. But it's looking like it might be a reasonable way to think about the rest of the decade, not just AI, but robotics, automation, lots of technologies there that are going to boost productivity. So I think from a revenues perspective, revenues tend to increase along with nominal GDP. If we get a productivity boost here, there's no particular reason why revenues can grow 5 to 8%.
Should we fear the concentration of 7, 8, 9, 10 mega names? The mega names have reported 2 of them in the last 24 hours. How should we interpret the durability of what we see from these names?
Well, first and foremost, I personally try not to get too emotional about the markets. I mean, it's easy to say and hard to do, and I do go on the same roller coaster as everybody else. But if you try to control your emotions, you just have to deal with the facts. And the fact is, we've got, I call them the mega cap 8. We got 8 companies that account for 27% of the market cap of the S&P 500. And they're great companies, as Amazon demonstrated with its latest earnings report. And I think they're going to continue to have an outsized impact on the market capitalization of the market, which means we have to accept that the PE is higher because their PE is higher.
Ed Yardeni, thank you so much. On a Friday morning, Mr. Yardeni, Yardeni Research there, and he reconfirms 4,600 SPX right now, 4,537. So, Lisa, I guess Yardeni's saying, sell in August or take a nap in August and come back in January is, well, Lisa, I look at the bond market here. I want to reframe this because I don't think we've talked enough about it today. I got a real yield. I've had 3 days of the plague. I think when I left, the real yield was 1.54%. Now it's 1.78%. To me, the real story is the real yield, the 10-year inflation-adjusted yield is up where all of our guests say is a tension point. Now what? What if it exceeds beyond that?
Especially because it comes at a time where there's concern about the fiscal profile of a nation paying higher interest rates and seeing the debt deficit increase. And it's raised some real questions. And then you put in an employment report, and I understand why Eddie Yardeni just wants to go to sleep, because how do you parse it through and figure out which narrative thread is the most important to pay attention?
Exactly. Which narrative is most important?
It's like battle of the narratives.
Well, that's always the case, though. But to your really important point, you got to weight a narrative that is your belief in your retirement plan. Or, not this babble that we do all day, but like, what's my narrative that matters? And I mean, that's the key thing right now.
I can't answer the question. Ira Jersey can. Ira Jersey, chief U.S. rate strategist for Bloomberg Intelligence, who's probably listening to us and throwing up his hands and saying, guys, it's all about Japan. I don't know. Ira, what's driving the market right now? Because you are seeing some pretty mixed reactions on the heels of that labor market report.
Yeah, I think that the bond market sell-off this week kind of set everyone up for an okay report that we received this morning. The way that I read the employment report was more mixed because even though wages are growing, hours worked was a little bit lower, and you have had a bit of a moderation in the amount of job growth, and also the mix of jobs continues to be skewed toward the lower end of the wage spectrum. So with losses in information technology, for example, but you had increased employment elsewhere. For the market and to Tom's real yield point, most of this move this week, and we have seen a pretty decent sized move, has been in real yields, not in inflation expectations. So the market is more worried about how much supply there's going to be. We have bigger auctions next week, plus some of the global interest rate moves that are being done by the Bank of Japan, ending yield curve control, European central banks continuing to be somewhat hawkish. So it's a mix of all of those things that I think has just brought the real yield up to even more restrictive levels than where they were a couple of weeks ago.
Can it stay? And I guess that's really the key question, especially right now we're looking at a 2-year basically flat on the day. You're looking at 10-year yields lower now on the day. Try to come up with a narrative and it will be rendered obsolete within the hour. Ira, how much are we looking at the possibility that these higher rates could really stay for a longer period of time, given what Eddie Yardeni was talking about, an increase in productivity, giving higher wages, and a fully employed labor force?
Well, that's actually one of the things that we're looking at right now, Lisa, and we'll talk about this more next week in some of our research, is what happens if the Federal Reserve stays on hold, not just for the next 6 months, but for the next 18 months, because that will shift the yield curve to actually, interestingly, you'll see some more bear steepening of the yield curve, still an inverted curve, but just less inverted than it is right now, and signaling that, the Federal Reserve can stay on hold. Look, the way that I view it, the Federal Reserve has 2 mandates, and until one or both of them is completely out of whack, they're going to stay on hold, near current levels. So you're talking about needing job losses as one necessary condition, and the other one is for inflation to continue to come down modestly, which presumably it would if we saw job losses. So I think until those 2 conditions are met, the Fed's going to be on hold, and that might be another year and a half. We're talking about the problem with a soft landing is that the Fed is just going to be on hold forever.
Very quickly here, on the real yield, which will really be my focus of study over the weekend and into next week, to be quite honest here, I got a 1.78, 1.80 all of a sudden. I'm at a range where most of our guests say that's it. That's it in 2006 was 2.05%. What are the ramifications if we get real yield convexity into next year, which lifts it up above 2%?
Well, if you get it significantly above 2% in 10-year yields, and I think that's just going to be end up being a sign that the market is not convinced that the federal government can reduce the size of the deficit anytime soon. A big reason that we've had this move in real yields, I think, is the supply pressures. We're getting a lot more supply next week. You're talking about $3 billion more in 10 years, $2 billion more in 30 years. The market needs to have a reason to purchase that amount of duration. And some of it is structural, right? You still have insurance companies and pensions. But on the other side, how do you get investors who are looking for price return to get back into the market when it seems like the policies are just going to remain pretty restrictive for a while?
Ira Jersey, thank you so much. Greatly appreciate it with Bloomberg Intelligence there on the real yield. Katie Greifeld this afternoon, I believe, with the real yield will be the scheduled to see. What's your observation here, Lisa? I don't really know what to make. I mean, I get it's August. It's asleep right now. We're not asleep. We're going to continue here. John's going to have El Arian on. We're going to have a really sprightly radio discussion as well. But what do you make of this?
I think that other people are just as confused as you are, and you can see that in the oscillations of the market. I think you nailed it. I think that's exactly it. No one knows exactly what to make of this because it kind of paints conflicting pictures of a labor market adjusting to a new normal, maybe at a time when everyone's just following their gut.
My answer, corporations will adapt to 4% X yields. They will adapt and adjust as they did in 2005, for that matter in 1995 as well. This has been a joy. In the 10 o'clock hour, speaking of joy, the gentleman from Milton Academy, Austin Goolsbee of the Chicago Fed. Good morning.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Your equity market just about positive by a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up. Soft jobs gains offset by strong wage growth. Amazon results deliver a beat and a raise as Apple drops on worries over a slowdown. We begin with the big issue, Jobs Day in America.
We all continue to watch both the inflation number as well as the jobs data.
The jobs report, payrolls.
It is a huge focus.
We're very data dependent.
Watch those wage growth figures.
Wage growth really is, there's an obvious direct transmission into that price sort of spiral.
The Fed has kind of told us they'd like to see wage growth fall.
That, of course, is significant for the Fed.
We're in a period where economic data has been strengthened.
We've seen a lot of resilience in the labor market.
Remarkably resilient.
We've also seen a lot of air being let out.
It's difficult to say that the jobs market is anything but buoyant.
The U.S. economy continues to power through.
We do query whether the payrolls numbers are telling the real story.
There are many holes in this data.
There's still risks out there.
The Fed has to obviously consider everything in aggregate.
Let's consider that now. All-star lineup this morning, two of them with us at the moment. Mohammed Al-Aaron of Queen's College, Cambridge, alongside BlackRock's Rick Reader. Gents, wonderful as always to catch up with you on Payrolls Friday. Mohammed, you've had 30 minutes to chew over this. Your initial reaction to it?
It's a job report that has something for everybody. If you're in the softer landing camp, you will take comfort from a payroll gain of 187,000 below the 200,000 forecast and lower hourly worked. If you're in the harder landing, you will worry about the 4.4% wage increase driven by 0.4 month on month, and you'll also worry about the low unemployment rate. So, John, we can debate this one for a very long time. I doubt that we will get to a firm conclusion one way or the other. The marketplace favors at the margin the softer landing interpretation as of now.
Well, we have 25 minutes to debate it today. Rick Reader, what camp are you in?
So, listen. I think you've got a solid economy. You continue to have almost 200,000 jobs, and you have a good economy. That is, but at the margin, it's moderating. You've got an economy that's slowing somewhat. You look at this number. You look at the hours worked coming down a bit. You look at the 3-month moving average versus a 6-month versus 12 months coming down a bit. By the way, you look at temporary hiring coming off. So it's an economy that's in good shape, but that is moderating. And I'm in the soft landing. In fact, I'm in the no landing camp. In that, I think the economy's in pretty good shape. But at the margin, this is indicative of an economy that is slowing down. Same thing you've seen in the earnings this quarter.
Well, Rick, you went there. I've got to jump in. What's the difference between a soft landing and a no landing? What's the difference between the two?
So I mean, we talked about last month. I think the economy is incredibly resilient. By the way, look at this number: 100,000 jobs, healthcare and education out of the 187. They're not cyclical. We have a
really put it in the bottom, some people reacted to the Fitch downgrade. Then put on top of that what's happening in Japan in particular, and what is turning out to be a very muddled middle exit from yield curve control. And that explains not only the sharp move up in yields, but also what's been happening to the curve.
So, Rick, from your perspective, what was the dominant factor behind this week's move?
So, I'd say everything that Mohammed said is right. I think the other one that's in there, I think the interpretation of the economy is in decent shape, and maybe we say stickier inflation is significant. Jonathan, I think there's a really big deal. When we talk about in your show for many months now, I joke about, I like the front end of the curve, I like commercial paper. You look at this year, the ag is up 50 basis points. But the back end's down 90. And you wonder, what is the long end doing for you? You've got an inverted curve. You're in a year where you want to clip coupon. You've got bills at 5.5. You've got, clip coupon, get carry. Is the long bond a hedge? I don't know. If inflation is higher, that's going to hurt the risk markets. So I think, if there's not a pension fund life insurance bid for it, which is, generally your bid for the long end of the curve, why, what is the value in an inverted curve with stickier inflation? What is the value of the long end? And I think people have gotten, look at this month alone, the total return of the long end of the index is down almost 4%. If you think about what is my long duration risk that I want to take? Do I want 30-year treasuries or I want equities? And gosh, I think long duration is becoming, long interest rate exposure is becoming questionable as value.
So, Rick, this begs the question, the obvious question: if 420 doesn't get it done for you, does 450? Does 5%? At what point? How far does that have to go before it is actually competitive and draws attention from people like you?
So, first thing I would say is, credit. If you buy some long-dated credit where you're getting some spread, that gets you to yield levels that are reasonable. That being said, I still rather hold the front to the belly, where you're getting, the curve is going to steepen. When the economy slows, or as it is moderating, the curve's going to steepen. So, a bit of credit in the back end makes sense. But listen, I think there's going to be a point in time where the economy starts to moderate, and the Fed, you start to interpret that the Fed can start to cut rates, and there'll be a grab for interest rate exposure. So, gosh, is it around these levels? It really is what the forward trajectory of rate is going to be from here. And once you get the sense that the Fed will start moving rates lower, and we're not there yet, then you want to grab some long interest rate exposure. But I just don't think we're at that point yet.
With that in mind then, Mohammed, how much higher can these yields go at the longer end of the curve?
They can go higher. I suspect that we may well see 425 to 430 on the 10-year. Beyond that, it's going to get a lot harder. But they can go higher. John, the short end, as Rick said, is attractive. People are noticing bank CDs at 5% for a 2-year maturity. People are thinking, you know what, that's not bad. And they're not looking well beyond that. So I completely agree with what Rick said. It's hard to convince people to go towards the long end if you don't believe there's a hard landing coming, and the narrative has moved firmly away from that. And also, in addition to that, if you can get something attractive that just pays you to wait. And this notion of paying you to wait is a completely different paradigm than what we had when during the era of QE and floored interest rates.
Well, let's think through the dynamics that you guys are describing. We've got central banks backing away, the BOJ tweaking yield curve control. I'm still confused as to what the goal actually is over at the Bank of Japan out of Tokyo. And Rick, the anchors that we've had around the neck of the global bond market for the last 10 years, up and away. Germany, gone, done. They're talking about QT in Europe, never mind QE. Over in Japan, yield curve control, those tweaks starting to come through. Rick, we haven't had accidents really in a material way post-pandemic in this bond market, the long end, in the way that some people might thought maybe we would, based on these central banks pulling away. The cycle high, the post-pandemic cycle high on a 10-year, I believe was October, Rick. It was 430. Do you think we can actually get through those kind of levels again later this year, based on what you're expecting?
So, there's the one governor on rates moving significantly higher is if you believe, which I do, that inflation is moderating, that the real rates are starting to expand. And then, people look at that, as you get to, a couple of percent of real rate, gosh, then, you start to get appealing. So, but do I think you can push back a bit more in the long end of the curve? Yeah, think so. Listen, we think the next, we're going to get a CPI report. We think that's going to be a soft report again, probably buoyed by the same thing as last month, lower used car prices. So, listen, I think rates can move a bit higher in the back end, but I don't think they're going that much higher. And I think Mohammed said it earlier. I think the equity market has gotten to a place where you can absorb this sort of these sort of higher rates, and they'll probably be with us for a period of time. So I don't really see an accident. I do think we still have a challenge around commercial real estate. I do think we have a challenge around small banks in the country, but I don't think there's a big structural problem as long as the housing market, which is in pretty good shape, stays firm.
But Rick, to be clear, you still like stocks here?
I do. I mean, if you said, again, it goes to the point of I've got long-durated risks that I can take. I don't want to take it in the back end of the Treasury curve. I think equities, and, are we shifting our equity exposure a bit? There are a lot of businesses that actually trade at low multiples. We talk about autos, talk about airlines, home builders, parts of the energy sector that trade at pretty low multiples. European banks trade the low price to book. There are enough stocks that have, we could debate, semis, but there's enough equities that get you low multiples that as long as you believe the economy is moderating but in decent shape and the central banks are off the tightening boil, they're okay, to hold here. Particularly alongside, I've got carry in the portfolio that gives you a lot of ballast for what is a pretty stable portfolio today.
Gents, let's keep doing this. I love this. My favorite day of the month. Rick Reader, Mohammed Al-Erin, Post Payrolls. Enjoy it. Have a great weekend, guys. Appreciate it. Post Payrolls, Mohammed Al-Erin there and Rick Reader responding to that jobs number. Just a slight downside surprise on the headline number. Equities right now positive by 0.4% on the S&P. Coming up the morning calls and later, Michael Collins of PGIM, Anastasia Amoroso of iCapital, joining us around the opening bell on what's happened in this labour market, and joining us on tech and Apple specifically, Angelo Zeno of CFRA. All of that still to come. Your opening bell, 7 minutes away.
I don't think we can replicate Tesla unique because when they founded and their personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
5 minutes away from the opening bell. Equities just a little bit firmer by a third of 1% on the S&P 500. That's the price action. Let's get some morning calls. Rosenblatt downgrading Apple to neutral. The analyst seeing third quarter results highlighting a slowdown phase. Morgan Stanley raising its Amazon price target 175 from 150. The analyst citing strong results and guidance across the company's retail and AWS units. And finally, TD Cowen downgrading Moderna to market perform. The analyst saying near-term catalysts remain tight. Coming up, more on the latest payrolls report with PGIM's Mike Collins and Anastasia Amoroso of iCapital, plus Apple earnings with Angelo Zeno of CFRA. Your opening bell just around the corner.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 seconds away from the opening bow this morning. Good morning. Final trading day of the week, getting you towards the weekend. Equity futures positive here by 0.4%. This is how the stage is set going into the weekend before Friday's session. 3-day losing streak on the S&P, and so far, before this, on course for the biggest weekly drop going back to March. There's your opening bell. Switch on the board. The pain, the catalyst for it. In the bond market through much of the week, yields higher every single day through Thursday, and then we pull back this morning by 4 basis points. 413.70 on a 10-year, pulling back from new highs for 2023 on a 10-year yield. This morning, yields lower off the back of that job market report. The labour market report, really a tug of war between a downside surprise on payrolls and then hotter wage growth than expected on the other side of things as well. We'll debate that in just a moment. Off the back of it, the euro showing some strength, or I should say the dollar showing some weakness. 110.22. Euro dollar positive by 0.7%, and we had a bit more weight to that crude rally more recently. $81 and about 80 cents on WTI, higher here by 0.4%. About 40 seconds into the session, positive by 1/3 of 1% on the S&P. On the NASDAQ, up by a touch more. One stock to watch at the open, DraftKings. Second quarter sales beating expectations as the company raises its full-year guidance. The CEO saying this: DraftKings produced outstanding results. We grew revenue at an impressive year-over-year rate and maintained our focus on operational efficiency. Abby has more. Hey, Abby.
Hey, John, and the stock is reflecting those results. It is surging up at this point 14.5%, the best day since early May. May, the highest level since November of 2021. So specifically, they actually put up a surprise profit. They also beat revenue by about 15%. Analysts on the street very positive, thinking that this is going to be a bit of a turnaround for the company, that this online betting and fantasy sports betting company, that they have moved in the positive direction, positive EBITDA for the first time, and that the gambling, the momentum should continue, and especially ahead of the key NFL season. This stock, John, on the year into today, up 163%, sort of one of these stealth rallies in a name that had been beaten down last year, but right now, again, absolutely surging, up 15% on these strong results.
Hardly talked about it. What a move on the year and on the session, so far at least. Abby, thank you. Different story for Block, very different story. The company's gross profit growth forecast falling short for investors. The co-founder, Jack Dorsey, saying this: leaders across our company are now looking at the true full cost of their businesses, leading us to pull back on our pace of hiring and to focus more on performance management. Katie has more. Hey, Katie.
Hey, John. Well, it's rough out there. Block shares currently down over 9%, even though on several measures, this was a beat and a raise quarter. If you go into the numbers, gross profit soared 27% to $1.87 billion. That's above the average estimate of about $1.8 billion as both the Cash App and the Square businesses delivered. Block also boosted its full-year adjusted profit to $1.5 billion. That projection is up from $1.36 billion, and that's all good news, but it's that guide that you mentioned that's showing up in the shares today. The guide for July's gross profit growth came in at 21% year over year. That's actually slightly above Wall Street's consensus, but as Jefferies analyst Trevor Williams phrased it, that figure likely below buy-side expectations. And you can see that in the stock this morning, now down 10% as trading gets underway, higher by just 6 or 7% on the year, John.
Brutal stuff. Thanks for that, Katie. That stock getting hit hard around the opening bell about 3 minutes into the session. I want to turn to tech, the two big names. Amazon giving a positive sales outlook while Apple faces a big sales slowdown. The CEO, Tim Cook, saying, quote, "We continue to manage deliberately and innovate relentlessly, and we're driven by the sense of possibility those efforts inspire." Ed Ludlow, almost poetic from Tim Cook there.
Yeah, almost poetic, but it doesn't hide the fact that Apple is not immune to the macro environment, John. What we got was a story where the smartphone market in the US is not strong. There were bright spots, and the numbers are mixed going into the rest of the year. So, ultimately, Apple beat on fiscal third quarter revenue, the quarter ending in June, coming in overall at $81.8 billion, slightly ahead of expectations. But in the fiscal third quarter just gone, iPhone revenue was softer than expected. What it means, all told, is that this is the third consecutive quarter where Apple has experienced year-on-year declines, going back to 2016 for 3 consecutive quarters. The commentary from Luca Maestri, the CFO, is that going into the fiscal fourth quarter, ending in September, they expect iPhone and services to accelerate, but other business lines like iPad and Mac to decline double digits going into that fiscal fourth quarter. The question is if Apple sees an overall sales decline year on year in the next quarter or the current period, 4 consecutive quarters of year-on-year declines, you have to go back 20 years for that level of sales decline in this company. So there's a lot happening here. Bright spots included Greater China, which overall has returned to growth. India had a record month in the month of June, and the opening of retail stores there has had a quicker than expected impact. Services revenue overall passing $21 billion for the first time, but the narrative from the street is that services has had momentum anyway. Complete contradiction with Amazon, up 9%, going towards 10%. That puts it on an intraday basis for its biggest jump since November. Amazon, the story, a beat across the park. Overall top-line growth 12%, 4% on the .com business, but they're getting better at making money on the more profitable elements of Amazon.com, namely advertising and selling services to independent merchants. Then you look at AWS, the cash cow, the bright spot. It continued to grow. And even though we'd had that guidance from the prior quarter that going into April, AWS growth had decelerated 500 basis points, what ended up happening in the quarter was it stabilized. And they stopped short of saying there's a rebound in cloud, but they talked about customers putting an end to their cost optimization. In other words, customers stopped playing it so safe. So really strong beat, but the story is Andy Jassy having real cost discipline, and that's showing up now on the bottom line as well.
Two different stories, two very different stories. Amazon up by 9% right now, Apple down by 2.7. Ed, we'll talk more about this, but the South Side captured this almost perfectly. You just go through some of the revised calls this morning, looking at, say, Amazon, price targets hiked, Morgan Stanley, Piper Sandler, Citi, Evercore, taking their price target from 150 to 190. We're only at 140 right now. Apple, can I just lean on this one, this quote that came from KeyBank, Ed, and get your thoughts on this? Analyst worries that the US upgrade cycle is coming to a halt. The upgrade rates are at all-time lows and likely to result in weak revenue in the United States. Now, Ed, what do you think that means going into a new product launch in the next month for this quarter?
Well, those are exactly the two factors that were addressed. In the quarter just gone, there was no substantive product launch, which didn't drive an upgrade cycle in any of the product categories. What we're waiting on is the iPhone 15. The expectation, according to Mark Gurman's reporting, as it comes in this quarter. The bigger picture commentary when asked about the macro environment is Tim Cook said we have an uneven macro situation, but the smartphone market in particular is weak in the United States. That is partly an inflation and consumer issue, and it is partly an upgrade cycle issue. And as you know, during earnings, Apple does not talk about products that are not yet released. But that is what the expectation is. And again, I go back to it, John, but for me, you always get the key detail, not necessarily from Tim Cook, but Luca Maestri, the CFO. And he gives very small but specific guidance that going into the fiscal fourth, iPhone accelerates again. And a big part of that, we think, is going to be the release of the iPhone 15.
Interesting. Ed, stay close. We'll come back to you on that. The broader market right now, a lift here, a pickup, about 7 or 8 minutes into the session, up by 0.6% on the S&P, on the NASDAQ, up by 1 full percentage point. Turning back to today's jobs report, Mohammed Al-Aaron on this program a little bit earlier. Take a listen.
It's a job report that has something for everybody. If you're in the softer landing camp, you will take comfort from a payroll gain of 187,000 below the 200,000 forecast and lower hourly worked. If you're in the harder landing, you will worry about the 4.4% wage increase driven by 0.4 month on month, and you'll also worry about the low unemployment rate.
Joining us now to discuss two of the very best, iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, you've said it before, this Fed might be on hold, it might be almost done. Do you think this data this morning backs that up?
I think it does. I think this is an in-line payrolls report, in line with market consensus, but also in line with Fed wishes. I mean, if you zoom out, if you look at the labor market data, we continue to trend down in terms of job creation, and yet we continue to see the unemployment rate that is still holding on around 3.5%. So that's really the best case scenario for the Fed, is gradual rebalancing of the labor market. By the way, job openings continue to come down as well. Labor participation rate continues to go up and is above pre-pandemic levels for prime age workers. So I think that's all that the Fed really wants to see. And of course, yes, there's a 4.4% wage growth number, but look, 4.2, 4.4, I think they're close enough. So I think the Fed is going to take that in addition to the inflation data that is showing a disinflationary trend, and we'll say this is in line with what we want to see, and therefore we may have to pause here.
Mike Collins, would you agree with that assessment?
Yeah, it feels like the soft landing camp is definitely winning out here, Jonathan. In fact, after today's move lower in rates across the intermediate part of the curve, the markets have effectively taken out the probability of any more Fed rate hikes. So our view is the Fed is done. The funds rate is restrictive enough. It's going to continue to get more restrictive as inflation falls, that passive tightening everybody's talking about as the real rate continues to go higher. But what's priced in for next year is still 100 basis points of rate cuts. So that's really the big question.
So, Mike, with that in mind, and I know you and the team have been thinking about this, within fixed income, am I playing for income, capital returns, total returns? What am I doing?
Yeah, as you know, we've really been short duration, Jonathan, in our strategy. That is kind of betting that the 5 and 10-year yields were too low relative to the funds rate, right? When the 10-year was at 3.5 a couple of months ago, and the funds rate is pushing against 5.5, that's too big of a gap. And as that rolls up the curve, you actually get paid to be short. But now we've had a huge move. The markets feel like they're more fairly priced, with the 10-year, at 4 1/8 today, the 20-year pushing against 4.5 the other day. That feels fair value to cheap to us. So we're covering that in and certainly advising our clients to add duration here. You are clipping a coupon. You're clipping a bigger coupon every day. It's a great yield the bond market is offering you. And you do now finally have the potential for some upside in price if you kind of continue to get a moderation in growth.
Anastasia, that's the fixed income side of things. On the equity side, I've said it a few times already this year. It's worth saying again. You've had a great year on the equity market, much more constructive than most coming into the year, and you remained constructive. Now you're looking for that broadening out. Are there reasons to believe that can continue after it started around June this year?
Yes, for sure. I think the biggest reason is economic growth. I mean, if you look at, for example, the Atlanta Fed GDP now number they came out, the nowcast for the third quarter is running at 3.9% GDP growth. I mean, that is better than the first two quarters. It is an acceleration versus the deceleration that the consensus was expecting. So, to the extent that that holds, that certainly bodes well for companies. It bodes well for the earnings upgrade cycle, and it should bode well for the stocks. So, we've obviously seen, and speaking of, what kind of stocks benefit the most, I mean, if you look at the performance this week, financials, for example, didn't sell off nearly as much as technology and some of the other sectors. And part of that reason is we've seen this, re-steepening of the yield curve, which of course is positive for financials, but so is a soft landing. And so is, the lack of major defaults. And so is, the potential for yields to maybe go down from these levels. So I would say, Jonathan, for sure, there's a broadening out that is justified. And I like that it's actually being led partially by financials.
Mike, Anastasia mentioned the move in the bond market. I want to finish there with you, Mike. That lift in yields, that steepening in the curve, gone back and forth with a range of guests on this through the week. Just what was the dominant factor behind that move, Mike? And the reason I think we've got to diagnose it is you've got to work out whether it is sustainable, it continues, and whether the factor behind it this week is something we have to live with through the rest of this year. Was it the data, Mike? Was it the supply? Was it the downgrade? A lot of people say it wasn't the downgrade. Is it the BOJ? What is it, Mike?
Yeah, I don't believe it's the credit downgrade of the U.S. Treasuries and agency mortgage-backed securities. I think it's a lot of things. The data continues to be resilient, but the positioning was offsides, right? I think the market, investors generally had gotten really long duration. I mean, it seems like the consensus had shifted to really long. We were taking the other side of that. So I think that positioning alongside pretty resilient data and a Fed that really seems like they are going to be stalwart, that they're going to hold that funds rate at a higher level for longer. That's what happened in the curve this week.
The yields this morning speak to that too at the front end. In fact, through most of this week, the front end's not done much at all. We're down by 7 basis points this morning on a 2-year at about 481. Anastasia, Mike, love doing this with you as well. Post payrolls to get an update from you both on fixed income and equity alike. About 14 minutes into the session, your equity market on the S&P 500 just about positive here by 0.5%. Coming up, Amazon impresses, Apple disappoints.
The results reflect the fact that the environment is challenging. Consumers face pressure from general interest rates, higher inflation, and so there are a lot of cross currents that Apple, like all other companies, cannot outrun.
We'll head back to the West Coast and catch up with Ed Ludlow. Plus, up next, CFRA's Angelo Zeno.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg. Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsbee, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend.
Needs something like $3.4 billion for an incremental basis point or a percentage point of revenue growth. They're going to need advertising. They're going to need video. They're going to need healthcare. They're going to need something else to come in to take the baton from AWS over the long term.
Tom Forte at D.A. Davidson weighing in on Amazon, the company delivering better than expected results, reporting a spike in sales for its cloud computing arm, AWC. Different story for Apple, AWS rather. Different story for Apple, of course, dropping below its historic $3 trillion market valuation as it faces its longest sales slump in decades. Ed, back with us for a little bit more. Hey, Ed.
Yeah, so the guide from Apple is that going into the fiscal fourth quarter, it will be much of the same. If they maintain that growth rate and we do get a fourth consecutive quarter of year-on-year declines, it's the longest streak of sales declines for Apple going back 20 years or more. The big point is there is an admission from executives that there is a slowdown in the smartphone market here in the US. Bright spots in India and China were interesting. Also, we haven't talked about the impact of foreign currency. And there was a real emphasis from both Cook and Luca Maestri, the CFO, that on a constant currency basis, sales would have grown. But it just reminds us, John, Apple is a truly global business. And if you have the bright spots in markets like India and China and elsewhere, then you have to factor in the FX headwinds. And actually, sequentially going into the fiscal fourth, they did guide that that would be on an ongoing basis a headwind.
Ed, thank you, mate, for the update. CFRA's Angelo Zeno maintains a buy rating on this stock, 220 price target. I'm pleased to say that Angelo joins us right now. Angelo, let's go through this together, and thanks for being with us, by the way. Reasons to be constructive. Can you go through them for us this morning?
Yeah, listen, I think the biggest reason to be constructive, or kind of the biggest positive takeaway from this earnings call, was the services side of things. And I think most bulls would point to that. You saw 8% growth on the services side. The expectation, at least on our end, was for about 6% growth. And, it's actually finally an acceleration from what you've seen the last 3 quarters where services growth has decelerated. And actually, Apple indicated that you're going to see further acceleration as you go into that September quarter. So that's a change of pace to what you're seeing on the hardware side of things, and essentially all across the hardware side, specifically on the iPhones, where we saw a 2% decline on a year-over-year basis. And, I do think that really indicates the health of Apple in some respects, where you're seeing positive and accelerating services growth amid a decline on the iPhone side of things. Almost kind of tells you that they continue to do see switcher rates continue to improve and that installed base continue to grow, and that's really helping the services side of things. So I think longer term, the health of Apple remains very good. But as far as kind of what they're having to navigate through right now in terms of some of the challenges on the hardware side of things, that's something that they've been doing here for the last couple of quarters, and they're going to need to continue to contend with, at least in the near term.
Can we build on that just in the near term, Angelo? Upgrade rates. This has been the bullish thesis for a while. You've got this big base that need to upgrade. They're going to come and buy a new phone. What's happening with upgrade rates, and how do you think that's going to change in this quarter when we get a new product launch?
Yeah, I mean, listen, I think you did have a slight acceleration in terms of the upgrade rates when you had the 5G launch. Actually, what you're looking at here in terms of the iPhone 14 cycle is replacement cycles have extended after kind of two very good years in terms of the 12 and the 13. But the 14 has actually held up very well because average selling prices have actually largely offset a lot of the unit declines. And that's largely due to the fact that consumers are willing to pay more for those higher priced devices given the change in strategy Apple has made with this cycle in terms of essentially putting all the key upgrades on kind of the pro devices. Now, as we kind of look forward, in terms of the 15, we're not looking for much in terms of an acceleration in terms of those replacement cycles. But that said, the comparisons get super easy as you kind of start going into the December quarter. Most people will recall some of the COVID-related headwinds a year ago, so they start lapping that. There's actually been some challenges in the U.S. market in terms of iPhones in the last 2 to 3 quarters. They'll start lapping that as well. So I think you start seeing some easier comparisons where they should be able to see a return to growth in the iPhone 15 cycle, but nothing kind of major that we anticipate until a foldable launch finally comes to fruition.
Can we just drill down on ASP just quickly? The average selling price of a phone. Angelo, there was a hope this year that if unit sales growth was stable, that they'd be able to do something with the average selling price of the phones they sell. Based on what we've learned in this quarter, do you think they can?
In terms of what? Increasing selling prices?
Putting prices up, yeah.
Yeah, I mean, listen, I think there's the potential that they can do that on the pro side of things, and it might be something that they look to do on the next cycle. But to be honest with you, given some of the challenges that we're seeing kind of specifically in the U.S. market, I'd kind of be hard-pressed to really see them really increase prices on my end of things. I mean, we'll kind of see what happens here, with the iPhone 15 cycle, but I'm not necessarily kind of embedding that within our forecast.
Angelo, thank you, sir, for the update. Angelo Zeno there, constructive on the longer-term opportunities, near-term challenges could linger. For the stock, we're down by close to 3% at the moment. About 23 minutes into the session, positive here by 0.4% on the S&P. Up next, your trading diary.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
a snapback from a 3-day losing streak on the S&P, up by a third of 1% here. That's the price action. Let's get to the trading diary. Fed speak picking up Monday, Bostic and Bowman. Earnings picking up Tuesday with UPS, Rivian and more. Then Disney reports on Wednesday. Thursday, we'll get US CPI, plus another round of jobless claims. We'll round out the week on Friday with PPI and UMich consumer sentiment, and certainly hoping for a quieter week in the bond market than the week we got this week. Looking ahead to CPI, that's your big print next week. From me, that does it for me, and thank you for choosing Bloomberg TV. Have a wonderful weekend if you can. This was the countdown to the open. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, August 4th. Here are the top market stories we are following for you at this hour. Payrolls puzzle. July jobs come in late at 187,000, the lowest since December 2020. But with the unemployment rate down to 3.5% and wages coming in hot, what's going on in this labor market? And what will the Fed think? We'll get insight into how the data impacts the monetary policy path as Chicago Fed President Austin Goolsbee joins us live for an exclusive interview from Aspen. And bite out of Apple. The company's market value is set to drop below $3 trillion with concerns over its sales outlook. Amazon, though, soars as its revenue grows and spending slows. From Washington, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is on assignment. Welcome to Bloomberg Markets. Guy, happy Friday and happy Jobs Day to you.
I'm not sure I'm that happy about what has happened here today because I'm really struggling to understand the market reaction, what the data actually tells us, does it change anything? I think, so Kaylee, you've got to take a step back. This week has been about a massive move in the bond market. Why are we seeing a bid coming back into the bond market today? Is it because of the payroll number, or is it simply because everybody's been selling all week? And that, I think, is really critical. And then you look at the wage data you highlighted in the headlines. Does that wage data tell us that the Fed's going to struggle to get down to 2% anytime soon? And if so, shouldn't the bond market be on offer on that, yet it's bid? So I think the context and the positioning coming into the number really matters. I'm not sure our understanding has taken any big leaps forward today in terms of the evolution of this economy and what is happening with the labor market.
Yeah, you make a really good point, Guy. 2 Fridays ago, the 10-year yield was at 383, I believe. So even though we have a 5 basis point, 6 basis point drop today, we're still at 411. We are still substantially above where we were just about 10 sessions ago. So it really does create quite a puzzle, because the market at this point seems like it's clinging on to the fact that you saw a disappointment in payrolls today and those downward revisions for the 2 months prior rather than the wage figure. But I wonder if the wage figure is the one the Fed will choose to cling to.
Absolutely, and the Fed has talked about wages, and also just fold in the positioning story. We've been selling all week. Is this just an opportunity to buy what maybe are slightly better levels? Anyway, the wage story, I think, is absolutely front and center. Kaylee came up with this one. I think it's a great question. Let me just bring it up onto the screen so everybody can see its beauty. If wages keep growing, will yields keep going? Which direction yields keep going in maybe is an open question. Bloomberg's Mike McKee, Ira Jersey, join us now. Ira, what do you think? In theory, a hot wage number would imply that the Fed is going to struggle to get inflation down to target anytime soon. Is that too simplistic? If wages keep going, should yields go higher?
Yeah, I think that is correct, and it's not so much that yields go higher because the Fed's going to tighten a lot more. It's more that we could start pricing out even more of the cuts that are priced in for the second half of 2024. So let's say that the Federal Reserve was going to stay on hold until the end of 2024 and maybe into 2025. That means that a lot of instruments, 2-year yields, 5-year yields in particular, would probably have to sell off a little bit from here, and we'd see an uninversion of that yield curve at least a little bit. Now, that doesn't mean the long end would have to move very much, so you could still have 10-year yield 4% plus or minus 25 basis points, which is probably where we're going to end up for a little while. But it's that front end of the curve that you can wind up seeing some of that uninversion just because of the lack of Fed market reaction to going forward.
Yeah, well, you definitely are seeing greater movement at the front end today. The 2-year yield down 9 basis points. We're back down at 479. And Mike, just to think about what it means for the Fed, if we continue to see a deterioration on the payrolls figure, but wage growth stays hot, that's what they'll fixate on, right? Even if we start to see quote unquote cracks in the labor market, theoretically, if what people are getting paid is climbing, that's inflationary and they're trying to fight it, right?
Well, there's a theory that it's not inflationary, that wages follow inflation rather than lead inflation. And I think the Fed will look at this and say that it didn't go up again. It stayed where it was. And if we continue to see the labor market weaken, then we are likely to see the wage levels start to go down. Also, if you look at the composition of the raises that people got, a lot of it was in construction, a big jump in construction because there are shortages of workers there. But new home builders are having to lower prices on their homes in order to get people to buy them because mortgage rates are high. So at this point, there's kind of a trade-off there. And then you could also see more people in the goods sector this month, but that's been back and forth between services. Services was the area of shortages. And so the Fed also has another jobs report before their next meeting, so they'll probably look past today and wait and see what happens.
They'll definitely do that. They'll certainly wait for more data. But if you fold in the wage number into the union story as well, isn't there an argument to be made that this wage story is becoming stickier? And that is just going to make it that much harder for the Fed to get inflation down to 2%. Is today's wage number, consistent with 2% inflation?
No, it's not. And I don't know if the control room can get this up, but we have a chart that shows basically what we're looking at here is the year-over-year number at 4.4% is running above the level that the Fed thinks is sustainable for 2% inflation, which is 3 to 3.5%. So that's what you have to close. That gap is what you have to close before you're going to get the Fed to think that that things are going okay. That blue line has to go down into that green area. And so that's what the Fed's going to be watching for. The question with the labor pattern agreements is, does that spur a lot of additional spending in areas that will then see shortages because there's not enough supply to meet demand, and then that pushes inflation up. It is something for the Fed to watch and be concerned about, but it's also something that it's going to be hard for them to do something about.
Well, and Ira, as we talk about what the Fed wants to do something about, we know that they want to stay on that path to a soft landing. It seems like the narrative is building that the landing will indeed be soft. The Fed's own staff is saying that a recession isn't going to happen this year, changing its view. But I just wonder if the inflation fight can be won if the landing
increasing the unemployment. And the job market does need to get into balance. We have been in spots where it's been out of balance so hot that it's not stable. But we're doing that over these past couple of months. You see the quit rate, you see the vacancy rate relative to how many unemployed there are, and you see the jobs numbers pulling more into balance.
Walk that line.
Walk
Johnny
that
Cash.
line.
There you
That's
go.
what it is.
Okay, Austin Goolsbee, thank you so much. He is the president, of course, of the Chicago Fed. Now back to you.
Our thanks to Johnny Cash, Austin Goolsbee. Thank you very much indeed, David Weston. Fantastic interview. Very much enjoyed that. Some analysis, some instant analysis, you could argue, on what is happening with the payroll number and the Fed's reaction to it. Fantastic to have that with David Weston. And there's some great coverage still to come out of the Aspen Economic Strategy Group. Very much looking forward to the conversations that are going to be happening throughout the day. Look at that. You've got Larry Summers. You've got all kinds of things coming up that we're going to be wanting to focus in on a little bit later. It is now 24, let's call it 24 minutes past 7 on the West Coast. That is what San Francisco looks like this morning. It's time we turned our attention to what is happening in the Bay Area and beyond. Silicon Valley very much starting its morning, and it has a lot to think about. Ed Ludlow. Let's talk about the compare and contrast between the reaction to Apple and Amazon.
Yeah, look, the story this season for earnings is investors rewarding companies whose legacy businesses do well and punishing those where there is not a strong or there is a worrying outlook. And that's been the story of Amazon and Apple. Amazon beat across the board. Its e-commerce business continues to grow at the top line. Overall growth 12%. AWS is still the cash cow. More worrying for Apple is that revenue did beat in the quarter, but it was still a year-on-year decline. 3 straight quarters of year-on-year declines for sales. You have to go back to 2016 for Apple to experience that kind of growth slowdown. And then the iPhone was weak in the quarter. We knew that would be the case because there was no new handset model this quarter. The iPhone 15 comes out at some point in the next 3 to 4 months. Services was a bright spot, but the big picture is that Apple is not immune to the macro picture. It suffers the woes of inflation just like everyone else. Amazon demonstrated that they've been able to get around that more nimbly. I think that's the compare and contrast.
Well, and Amazon, it's also about spending, right? Jassy's reining that in, and investors seem to like it.
Yeah, so, I mean, capital expenses this year will be $50 billion, down from $59 billion last year. This is a company that got rid of 27,000 employees. But there's just a bigger picture story. Andy Jassy's been the CEO for almost 2 years now. He came in with Amazon having invested billions of dollars in a pandemic era where we were all at home and we wanted fulfillment for our packages to be there as quickly as possible. But they didn't need that scale now, so they've come out of it with discipline, but they are continuing to grow.
All right, Amazon up about 10%, Apple down about 3% at this point in the session. Thank you very much to Bloomberg's Ed Ludlow. And of course, you can catch Ed on Bloomberg Technology in around 90 minutes time. But first, more coming up here on Bloomberg Markets, so stick with us. This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We're about an hour into the U.S. trading session on this Jobs Friday. Bloomberg's Abigail Doolittle is tracking the move. So, Abigail, how are we digesting the data and the earnings out there?
Well, Kaylee, overall, not too much of a reaction. A bit of a mixed reaction, but mainly to the upside at this moment. The S&P 500 up 0.3%. The NASDAQ up a little bit less. You can see that the SOX is down about off of its lows, and the Russell 2000, which had been earlier lower, it's now up slightly. So it'll be interesting to see how this day, of course, plays out. But let's take a look at the two big stocks that you both were just talking about with Ed. We have Amazon absolutely soaring, up 9.7%. Its best day going back to November of 2022. So basically the best day of the year. While Apple down 3.2%, the worst day since January, and heading to its worst week since November of 2022. So a real split here. Amazon, of course, beat and raised. Apple, the concern around the slowing sales growth that we've been talking about in recent days. Investors really feeling it. Now, Apple reminds me to some degree of Microsoft. Now, Microsoft actually put up a roughly 8% sales growth, but it was considered to be a little bit light, especially since the composition of it with the cloud. Well, on that, Microsoft dipped below its 50-day moving average. Today, Microsoft is higher because relative to Apple, its 8% revenue growth looks a lot better than down 1.4%. But you can see Apple, we looked at the breakdown yesterday, it is breaking down more now, really firmly below that 50-day moving average, suggesting more selling may be ahead. As for some of the other big movers on the day, if we take a look at what is happening, Microsoft, again, looks a little bit better relative to Apple, up 1.4%. Booking Holdings up 8.9%. Great quarter there. Fortinet, take a look at this. The worst day ever going back to its trading history since 2009. Their guidance, the bookings and billings guidance, not great. The company's talking about macro uncertainty. It's unclear, given the fact that not so many other management teams are talking about that, why this cybersecurity company is seeing that, but clearly down. And then ResMed down 15.7%, the worst day since March of 2020. They have put up an earnings miss guide, weak margins. So a real divergence here between the haves and the have-nots on this Friday.
We're going to be talking about booking a little bit later on. Looking forward to that conversation. A little bit more on what is happening with this huge travel demand that we're seeing right now. Abigail, great stuff. Thank you very much indeed. Let's get back to the macro picture. A few moments ago, Chicago Fed President Austin Goolsbee joined this program from the Aspen Economic Strategy Group's annual meeting. Here was his reaction to the jobs data.
The job market is cooling a little to kind of a balanced level, but it's still extremely strong. That's the strongest part of the economy by far. When we see what's happening to wages today, this is kind of an amalgam of a bunch of stuff that already occurred. I think if you want to know if you're beating inflation, go watch the inflation, the price series, and especially the new months of inflation in the core.
Yep. And we're going to get some more data on that front next week with the CPI print, so look forward to that. So does today really change anything? The bit that really stood out in so many ways from today was the hot wage number, and that takes us to our question of the day. If wages keep growing, will yields keep going? We've seen a big move higher in yields this week. Today, obviously, we're seeing a bid coming back into the bond market, particularly front-end yields coming off. But is that a trend we can rely on, or are all kinds of factors going to come together to produce higher yields? And if so, what does that mean for investors? Anna Rathburn, CBIZ Investment Advisory Services CIO, joining us now to try and answer that question. Anna, we've got higher wages. I appreciate it's a lagging indicator with the relationship to inflation, but nevertheless, the Fed's going to keep an eye on what is happening here. Do you expect higher yields from here, or do you think actually we've seen bond yields peaking?
I do expect to see higher yields. I think today is a reaction, perhaps an overreaction to some of the softness in the labor market, which we can get into. But to answer that question about wage growth, I think you have to look at it in conjunction with the productivity numbers. Now, if you look at the past 4 quarters of productivity, total productivity, it averages around 1.33%-ish. Right? And today's year-over-year hourly earnings is at 4.4%. In order to look at real inflation, you get about 3% inflation, which seems to be in line with the headline CPI number, but is certainly lower than the core. Right? So I'm not sure that we can say that wages are going to be fueling inflation. But the reason why I think yields may have overdone it today is because the Fed is stuck on that 2% inflation target. Whether or not 2% is the right number is a different kind of a debate. But as long as they're stuck on that number, the inflationary figures as well as the wage growth figures, it's not going to be good enough for them. So we may still be looking at either a September rate hike or another rate hike before the end of the year.
All right, Anna, I have a few things to say, one being excellent jacket choice color, first of all. Second of all, I really take your point on the 2% inflation target. I feel like I've been asking that question for a while now. At what point will the Fed have to abandon it, even if it doesn't say it out loud? But if we're operating under the assumption that they still do want to get to that target, and to your point, that may mean a move in September, that rates may have to go higher, stay there for longer. How does that on the rate side then feed into the equity side, considering we are seeing the multiples that we are at the same time that we are still talking about much higher borrowing costs?
Yes. So one of the things is that the rate hikes really have not made their way all the way through the main street, right? So one of the things that that you can look at is what we experience every day, which is in the residential real estate market. The fact that there's a dearth of homes for sale because people want to sit on their historically low mortgage rates tells you everything about how much people are rebelling against actually experiencing the rate hikes and how much the rate hikes actually have not made their way through Main Street economy. And a lot of these companies have borrowed when the rates were super low, and at some point they're going to have to roll over that debt. So all of this will have an impact on cash flow, future cash flow. And remember, inflation coming down also means that there's less pricing power for a lot of these companies. And also there's some news of worker hoarding because it is so difficult to find skilled workers. If you're keeping workers on payroll, even though they cannot fill a full work week, like we saw today, the work week dropping, then all of these things are pressure for margins. And so this spectacular year-to-date run-up we've had in the equity markets, we may be in for a completely different type of an environment in the second half of the year.
So you'd be a seller of stocks right now?
I don't know about seller of stocks because, again, I don't want to bet my farm on just one thing. But I think it would be very prudent to be rebalancing and taking some of those gains off of the table.
Are we talking about tech here, Anna, considering the mixed results we got from Apple and Amazon overnight? And Apple clearly is getting punished for it to a certain degree this morning, but it also is one of those stocks that had run up incredibly far so far this year.
Yeah, so I think tech is, there are two different things here. There's earnings, which is the fundamentals, and Apple really is selling products, right? And these goods are going to feel some pressure because of the inflationary pressures. And there's no running away from it. There's no hiding it, right? But then there's also the run up because of the AI component. AI is a real thing. It's not happening today. It's not happening tomorrow. It is coming down the line. And you do see companies talking about putting some investments into AI. So I think the hype, which is essentially the essence of growth stocks, the valuations may be justified somewhat over the AI excitement, but certainly on a fundamental level, there's definitely headwind.
Do you not need to see in the near term, Anna, some sort of catch-up? Multiples have expanded really rapidly. Earnings haven't. And I appreciate that there is the AI kind of narrative that needs to be folded into this. But at some point, doesn't that gap between multiples and earnings need to close one way or the other?
Yes. I mean, it is a little scary to see the third quarter of year-over-year earnings decline in the S&P 500 and also see it soar in terms of price. And this is purely a multiple expansion. History tells us that this will catch up with us, if anything, temporarily, right? Even if AI is something to be excited about, it's not going to be a reality in terms of productivity for the next year or two. So this is something that is definitely further along the line. And in the meantime, we're probably due for some level of volatility.
All right, Anna Rathbun of CBIZ Investment Advisory Services, thank you so much for joining us on this Friday, and have a great weekend. Now, coming up, whether you're traveling for the weekend or traveling in general, demand is looking pretty strong for Booking Holdings. We're going to speak to its president, Glenn Fogel, next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Next.
It was going to keep rating World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the market.
booking shares are up 8.7% at this point in the session after reporting second quarter results that beat estimates. The owner of brands like Kayak, Priceline, and OpenTable pointed to strong demand trends. Joining us now is President and CEO of Booking, Glenn Fogel. So, Glenn, obviously things are looking pretty good right now in terms of travel demand. I just wonder how long you expect it to last.
Well, thanks for having me. And of course, one never knows what's going to happen in the future. We've experienced that over the last few years for sure. But one thing I do know that in the long run, people are always going to want to travel. And you can basically make a guesstimate that travel is going to increase faster than GDP. So in the long run, we're going to have more travel over the long run that's going to help businesses that are in travel like us. And our job is to make sure that we are participating and gaining share, producing better services, better ways that we can help the traveler so they'll come to us versus our competitors. That's the job.
I want to come back and talk about that in just a moment, particularly the AI thing that you're doing, Glenn. Good morning, it's Guy. Can we just talk a little bit about what's happening in the here and now, though? Right now, the picture seems to be, particularly in the United States, that we are seeing a boom in international travel. But then I look at the numbers that Robin Hayes and others are reporting for US airlines, JetBlue talking about it, others talking about it as well. They're having to cut prices because domestic demand is not as strong as was anticipated. Is that the picture right now? Boom in international, but domestic slowing. And does domestic then ultimately bleed into international? That slows as well. Can you just talk me through how you think the next 6 to 12 months are going to evolve?
Yeah, and one always has to be very careful about what you're comparing to. So certainly some of the domestic airlines in the U.S. have indicated that they're having less business than they did in the past because they are saying that Americans are traveling abroad now. And that is absolutely correct. But look where they came from. A year ago, second quarter numbers were out of just fantastic for everybody because so many people in the U.S. were traveling and it's primarily domestic. So it has to be a comparison. Now, you do point out the correct thing. The way we look at the world, and we're very global, we look and we say, well, Asia, fantastic second quarter for us, up 40% year over year. But if you recall, Asia was a little slow coming out of COVID. So we're comping against an easy comp, whereas in the US, we're comping against a harder comp. Long term, I'm not going to concern myself too much. Obviously, a lot of bumpy things right now. I know in a year or two, things will normalize and we'll get back to what I said originally.
Well, Glenn, when we talk about the demand rebound after the pandemic, it seems that people were just completely insensitive to price because everybody had all these built-up savings from staying at home for so long. They hadn't traveled in a while. They were willing to pay up in order to do so. Are you seeing price sensitivity, though, starting to come back in?
No, we're really not. Talked about it last night on the earnings call, where ADRs for us, that's the average daily rate at a hotel globally, it's up. Now, there are always going to be some areas where there's some variation. Some things are going to go down a little bit because a year ago, demand for that particular local area was just out of control. So prices were very high. And now as people are able to travel to other areas, there's less demand. So prices could drop in those very local areas. But we look at things on a very broad basis, and we're looking globally. Yeah. ADRs are up.
Glenn, do you think the market should rate you as an AI company?
Well, I'm not sure how people should decide how much weight should you give for AI. AI is extremely important to us. It has been for over a dozen years. You know, a lot of people all excited about generative AI, which came out first in the fall, but we've been dealing with things with machine learning for over a dozen years. That drives our company. We have a tremendous number of people, AI experts, data analysts. That's how this business is run. We are an AI first type company and have been for a long time. Now we've come out with the new Gen AI product. We have one thing for our Booking.com company, which we call our AI Trip Planner. It's at the top of the funnel. People can use it to plan their travel. We have another thing at the bottom of the funnel, which comes out from our Priceline brand. It's called Penny. It will help answer questions a traveler may have about a particular product, a particular hotel they're staying at. And then we have our ChatGPT plugins for OpenTable and from Kayak. And the last thing is, at Agoda, we're working how to use AI to be more efficient internally using different types of co-pilots to help make your coding more efficient. All different areas. We got a lot of emphasis on that. And I really think over several years, this will really be a game changer.
Glenn, can I ask you about another potential game changer? And that is the weather. We are seeing extreme weather in parts of Europe this year. Many people are being put off traveling to certain areas. We've seen the evacuations from places like Corfu and more notably Rhodes. Talk to me about how you think this will impact long-term travel. Are you already starting to see potentially an impact on long-term travel? Are people going to be going to the mountains? Are they going to be traveling in the spring? How does this change? How does this shift in the weather pattern start to change the travel business?
Well, I think it will over time, but it's going to be one of those slow changing things. People have historically thought, well, I'm going to do my travel in the summer, that being the northern hemisphere summer, and people think I'm going to go to the places that I want to see, not recognizing those places may be very, very warm or even dangerous, as you pointed out, what's going on in Corfu and Rhodes. Very, very tragic about those things. So I think there will be change, but it's going to take some time. But we see reports that say certain areas that are cooler right now, like Scandinavia, or even the place where you're from, Wales, there's going to be more travel to those types of places. But it's going to take some time. Our job is, again, making sure that there's availability and great prices no matter where somebody wants to travel to.
Yeah, not from Wales, but remember going on holiday to Wales as a child, to my grandparents' caravan. The sound of rain on that roof will stick with me forever. So the weather probably needs to improve quite a lot. Glenn, great to see you. Fantastic numbers. Congratulations on the market reaction that we're seeing today. Glenn Fogel, Booking Holdings CEO. Coming up, cracks in the bond market. Wall Street piled into cheap debt created by the banking crisis. We're going to look at the fallout in today's Wall Street beat. That's next. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Time now for Wall Street Beat, where we look at what is buzzing on Wall Street in the world of banking and finance. And we want to talk about the bond market. It's been feeling the pains of uncertainty this week, and Bloomberg's Sonali Basak has been looking at the cracks that have started to show up. Sonali, of course, this week brought a lot of surprises for many of us, including the Fitch downgrade of the U.S. credit rating, but they also downgraded Fannie and Freddie, and I feel like none of us paid that much attention to that.
Yeah, and it's worth paying attention to now for a couple of reasons. You see these long-dated maturities when you look at Treasury markets blowing out pretty significantly, but when you look also at the mortgage market, it is pretty interesting. Remember, this market, agency-backed mortgages, are a place where PIMCO, TCW. Soros Fund Management even went to Bloomberg Invest and said it was one of the best trades this year, really facing a lot of pressures, first during the banking crisis, and now you have Fannie and Freddie also facing a downgrade, and you're seeing those strains start to hit the mortgage market as well for agency mortgages. This is interesting for a couple reasons, not only because of the big liquid bond fund managers plowing into this trade that has faced some significant movements in the last couple of months, pressures even. You also have private credit giants, guys, moving into non-agency mortgages. That has been a move that you've seen for the last several years. Think Apollo Athene, but I think it poses a very interesting question now on the risk reward you're getting for non-agency versus agency mortgages.
How big an effect could there be? Everybody's dismissed this as a non-event, Shonali.
Well, you know, it's interesting. It's a slow bleeding one, isn't it? Because first you're seeing the movement in the 30-year. The other place I was looking was at high yield spreads, which have widened out a little bit this week on the heels of all of this, but not meaningfully. And when you talk to folks about this, there's a long-term tightening of financial conditions embedded in what's happening here. And Guy, if you look at the next couple of months, it actually kind of gets a little bit scarier because you have October, you have the budget discussions. When we spoke earlier this week to Signum Global, they thought this would be another kind of catalyst here, particularly to the Treasury market when you're thinking about the government infighting and what it means for the bond market. The ripple effects are really what we're looking at here. Mortgages is just one hot spot on Wall Street. When you look at high yield as well, I think I wonder over there how much left there is to crack, given we haven't seen maturity walls really being hit in a meaningful way yet. So what's the trade? I think that is still something I've asked a bunch of bond fund managers today, how they play this. I think it's still unclear because I think it's going to take a while to shake out rather than sharp movements here.
Okay, so Shonali, that's in bond land. In equity land, I have my eye on one stock in particular this morning. Icahn Enterprises down 27%. They cut their quarterly payout in half. Is this just a blame Hindenburg situation?
Something interesting about this here is kind of the mea culpa you see from Carl Icahn, this letter to shareholders that he put out. This idea that they want to go focus more heavily on activism. The stock price is responding here to the dividend cut. And really, that is one of the short sellers' central claims here, that dividend was unsustainable. So you did have this dividend cut, plus a very big move here to the return of Icahn's central competency, which is activism. And he had really gotten into a lot of other areas, and we can see him kind of going back to his roots now.
Back to your roots. Shonali, thank you very much indeed. What a fantastic week of coverage from Shonali Basak. It's going to be interesting to see Carl Icahn do that and how successful he will be post all of this. Shonali Basak, thank you very much. Indeed, great stuff. Let's talk about where we are with the markets right now. Europe is kind of coming to the end of a week. It's been a painful week for European equities. We're up by 0.3%, but on the week, the stock 600 is down by 2.5%. This is where we are right now, just sub 460. We were up at 470. There's some key technical levels around this point, which is really worth watching out for. Solid German factory data out a little bit earlier on. Pay attention to that. Was it an anomaly? We are now seeing a bid back into the German 10-year. I think that's being driven largely by what is happening out of the US and the reaction to what we're seeing with the payroll number. And AP Müller-Merz, this is an interesting story. This was the darling during the pandemic. Freight rates went sharply higher. Now they've come down. They're having to react as a result of that. What is interesting coming out of AP Müller-Merz, though, is that they see slower growth but not a recession. And I think that's kind of telling. That seems to be kind of where most people are at the moment. And the fact that one of the world's biggest shippers is saying that, I think is really instructive. 4.81% is, though, the stock drop that we are seeing today. Coming up in the next hour, Barna Buasia, UBS's chief strategist, is going to be joining us. Looking forward to that chat. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Friday, the 4th of August, European stocks up on the day, but definitely down on the week. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Whip you through the price action. Stock 600 up by 0.3%, but down 2.5% on the week. It has been a tough week for European equities, with a number of strategists turning negative on the European space. Credit Agricole out with some really solid numbers today. The numbers in the bank itself look pretty good. They're also making a further move into wealth management. The market likes it. The stock up by 6.8%. DraftKings numbers really strong, feeding through into Europe really quite nicely. Entain, one of its competitors, benefiting from that. That stock up by 1.4%, Kaylee.
All right, well, we got some big stock movers here in the U.S., Guy. Two tech giants moving in two very different directions. Amazon, the big leader today, up about 11% at this point in the session. You had a strong revenue figure. AWS, the cash cow, doing really well. Plus, Andy Jassy is successfully slowing the pace of spending. So all of that adding up to a really good day for that stock, but it's not a great day for Apple. It is down about 3% after another quarterly revenue decline, the third in a row. The iPhone, a point of weakness. The outlook not really fostering confidence either, and so that stock is feeling the pressure. But remember, it had run up substantially into the print. It was up about 48% year to date. Before yesterday, I believe. Then the other story is in the bond market because, of course, it's jobs day here in the U.S. You did have a downside surprise on payrolls, but unemployment rate at 3.5% and wage growth was hotter than expected. What that all adds up to today is downward pressure on Treasury yields. The 10-year yield down about 7 basis points. We're at 4.10, but remember, 2 weeks ago, we were at 3.83, so we still are up much higher than we were, and the 2-year yield down about 6 basis points at 4.82, Guy.
Kaylee, I want to carry on that conversation about what's happening with the wage narrative. Clearly, the payroll number contains some interesting data on that. Take a look at what is happening with the Teamsters. Take a look at what is happening with the UAW story as well. Unions are flexing their muscles. They want significantly more money. Today, the Unite Union in the UK got it. Around 24,000 British Airways employees, remember British Airways, owned by IAG. They're going to be getting a pay rise of just over, I think it's 13.1%, 13.1% over an 18-month period, Kaylee. And that just speaks to the fact that particularly at the lower end of the wage spectrum, you are seeing some really big pickups in wage settlements. And you do wonder whether ultimately this becomes stickier and stickier and stickier. Certainly, that is a concern here in the UK. The Bank of England was talking about how some of that is certainly beginning to crystallize.
All right, Guy, I don't know if you can hear the fact that they're drilling in the studio or above my head right now, but we do want to listen to something else that isn't the sound of drilling noises, because earlier today, Bloomberg caught up with the acting Labor Secretary, Julie Su, who was talking about what we're seeing in both wages and employment here in the U.S. Here's what she had to say.
This is steady, stable growth. It's what we would want in the economy, right? We had record levels of recovery from the global pandemic and its ensuing economic catastrophe. And now we are seeing what steady, stable growth looks like. 187,000 jobs created, bringing the total since President Biden came into office to 13.4 million, at the same time that we continue to see record low unemployment rates.
Takes us to our question of the day, which basically relates around what is happening with the wage story and whether or not that's going to lead to higher yields. Austin Goolsbee pulling a little bit of cold water on this, but here's our question. If wages keep growing, will yields keep going? It has been a huge week for the bond market. Such turbulence, a number of factors coming together. But the wage story is really interesting. Is it a lagging indicator? At some point, maybe it isn't. That's when you get into the wage price spiral, and that's the concern, certainly here in the UK. Let's debate this now. Bloomberg's MLive Simon White, Liz McCormick joining us to kick things around. Simon, it's been a huge week for the bond market. So let's just start there and try and understand what is happening here. I've heard all kinds of different theories this week as to why we've seen this big spike higher in yields. Some are saying it's about issuance from the government, and certainly there's an element of that. BOJ is another factor. Maybe the downgrade, maybe that's a little bit questionable. And then you come to the macro data and you look at the wage story. Maybe that's something else you can fold into it. Is the wage story, though, a reason to think that we're going to continue to see inflation going higher? I've been talking to you all week about this whole idea that the bond market's beginning to sniff out higher inflation. What role do wages play in that?
So I think people are kind of coloured by the previous episode. So the 70s is the sort of go-to episode of high inflation. And back then, definitely the vector or the main vector of inflation was wages. So you actually had a reasonably positive correlation between yields and wages back then. But since then, it's basically been on average zero. And I think this time round, it will not be the same. You don't have, you mentioned some of the union stuff there, but you just don't have the same level of unionization.
Yep.
So you are going to see, for sure, some feed through, but you've got other aspects here. We've been running this in the US anyway, and in other countries, huge fiscal deficits outside of recessions, that have lingered on after the pandemic. And that's been a huge boost for corporate profits, right? The more that one sector is saving, is spending essentially, the other sectors benefit from that. So that's really been a big part of corporates' pricing power and margins that we've seen. And that's been feeding into inflation. So I think that is probably even, so far that's been more influential than wages. So I think going forward, it's going to be a combination of different things. I just don't think wages are going to play quite the same role as they did as in the 1970s.
Okay, so Liz, if it isn't wages per se, but just broader reads on inflation, which is what the Fed is trying to do, is get whatever those reads are down to target. They're looking for 2%. I just wonder if the bond market action we have seen maybe today aside is a reflection that fight for the Fed is going to be harder than we all maybe had been complacent thinking about in recent weeks.
Yeah, so I agree with Simon. It's less a wage thing, and I think actually, what happened in the bond markets this week was the mix of things like I laid out, and I don't think it was the markets getting ginned up on inflation worry, because you didn't see inflation expectations rise. We've really seen real rates go much higher, so it's really been a real rates driven thing, which that means it's about the outlook for the economy. Remember, the soft landing got a little ginned up more this week with some of the data, and the supply coming is bad for nominal rates typically. And then, the outlook for, what happens with the Fed. So I really don't think it's been people afraid of wages. And like we said, Goolsbee, a known dove, he kind of tamped that down today. We did have rates fall a little today, even though the wages were strong. So I think the bond market, and, we've seen a lot of curve steepening, so it's more like people buying, maybe the Fed can be on hold, and that there's these other forces, more term premium, BOJ letting an anchor go on long rates that is going to kind of drift the curve to a continued steeper stance.
Simon, Liz says this isn't about inflation. Liz says this, you can see that because of what is happening with real rates, that it's a bunch of other factors. It's a supply side story. It's the BOJ. What do you say to that?
I mean, inflation's always going to be the lingering in the background. I mean, what we've seen this week, so we have the eyes were on, as you said, the Fitch thing itself probably wasn't a big deal, but it refocused on the massive fiscal profligacy that we've seen in the US.
Yep.
And that obviously then related, if they're having to borrow so much, if they're having to spend so much, that means they're going to have to borrow so much. And we saw that in the refunding announcement.
Huge.
It's huge. And the net impact, if you have governments running persistently large fiscal deficits, inflation is a byproduct of that. So whether it's like, are they looking at inflation right now? Maybe, maybe not. CPI has come down to 3%, but it's like a symptom of the reasons, right? So that it's impossible for the market to swallow that huge supply without extracting some extra premium, because that has, liquidity implications. If you look at demand, foreigners have been jettisoning US debt. They're $5 trillion less since 2021. It's 10% of the total. US banks have been jettisoning US treasuries and agency debt. And the only sector that's adding to its treasury positions is the household sector. So they're taking on that duration risk. And obviously the Fed is running down its portfolio as well.
Right.
So this has liquidity implications, right? So therefore it makes sense for the market to try and extract extra premium to take account of that extra risk.
Liz, is this another case of us thinking so much about the Fed's rate hikes and not enough about the Fed's quantitative tightening, about QT and its impacts? Have we really started to see the full effects of that borne out yet?
Yeah, I mean, I'm a bit of a bond nerd, so I can never not think about the Fed's QT, but I think that's a good point because people are saying, hey, QT is going on as well, right? And the Fed, Chairman Powell in his recent press conference and some others made it seem like, oh, even there's possible, which people never thought, when the Fed starts cutting rates, QT could continue on. So you have that lever, which is, again, puts a bias towards a steeper curve because that weighs more heavily on the long end. So, yeah, QT is churning along, and it's now at full force. So I think you're right. That's another thing we maybe should not forget to talk about, that is ongoing, that is tightening. And, again, even if things start to go better, Fed says kind of we're done for now, that's still plowing along.
All right, note to self, ask more questions about QT. Bloomberg's Liz McCormick and Bloomberg MLive's Simon White. Thank you both so much for joining us. Now, coming up, we're going to talk more about our question of the day. If wages keep growing, will yields keep going? Bono Bueja, UBS chief strategist, joins next with his answer. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
a job report that has something for everybody. If you're in the softer landing camp, you will take comfort from a payroll gain of 187,000 below the 200,000 forecast and lower hourly worked. If you're in the harder landing, you will worry about the 4.4% wage increase driven by 0.4 month on month, and you'll also worry about the low unemployment rate. The marketplace favors at the margin the softer landing interpretation as of now.
Mohammed speaking to us a little bit earlier on, talking to John. Mohammed Al-Eri, University of Cambridge, Queen's College president, a Bloomberg opinion columnist, talking to Bloomberg Television. Takes us back to our question of the day. If wages keep growing, will yields keep going? Barnum Awaja, UBS's chief strategist, joins us now. I want to widen the lens. We've been talking about this purely through the kind of the prism of the US economy. Let's widen it out and fold the UK and Europe into this story as well. IAG today, British Airways, paying union workers 13.1%. It's just there is more and more of this kind of narrative developing, and it feels more real here to be talking about a wage price spiral. You need to differentiate economies. Is that what we need to do here when we think about that wage story and the relationship to yields? How are you thinking about it?
Yeah, I don't know about a spiral, but certainly there is wage price memory in Europe. I mean, you've got to remember that in Europe, real wages declined much more than they did in the US because inflation hit was so much higher. So workers were hard done by for a much longer time. So real wages were deeply negative, like -10, -11% per year, whereas in the US, real wage growth was about -3, -4%, right? So there's more to make up for. And labor market, even in a place like the UK, where supply curve has moved in for both goods and labor, even in a place like the UK, labor is still tight in the UK. So I think wage bargaining power in Europe is stronger than it has historically been. So I think wage price memory, and you see this in core inflation in Europe. Wage price memory is going to be a bigger factor, I think, in Europe than it is in the US. So in the US, of course, we had the payrolls data today, and we saw average hourly earnings also going up. But you saw that in last July as well. So there is a possibility that there is a calendar effect, and in August we see some give back of that. Sure. So I'm less worried about inflation in the US. I think the fact that, you were speaking about this in the segment just before this, a lot of the inflation came from used car prices. It came from OER. Because of that, core PC is coming down. Core CPI is coming down, and it's probably going to average something like 17 to 20 basis points over the coming 6 to 12 months. Wages, I think, will be okay in the US, less so in Europe. And I really think we need to make this differentiation across.
Okay, so let's think about that, how we turn that into an investment thesis.
Yep.
What does that mean for the US 2-year, and what does that mean for the UK 2-year and the German 2-year?
So the German 2-year is not done, right? That's the first point. Because this wage price spiral or memory, I should call it, not spiral, because this is not the 1970s. The magnitudes are different. I think bonds in Europe are still rich. I think you can still see further move in Ester curve. You can see still further move on the bond yields moving higher. Number one. Number two, if you're right that in the US, inflation is coming down, where we've clearly sort of gone over the hump of inflation, and inflation is coming down, and we're not going to see that wage price memory, then real yields at these levels, at 180, when the US economy is beginning to roll over, there's greater evidence of data that says it's beginning to roll over. You don't need to talk about recession, but rolling over of data. Even in the forward space, 5 years forward, 10 years forward, you're talking about 2% real rates. I don't think the US economy can take it. That's a buy. So buying tips or buying bonds in the US, tips, mainly tips, because it's a real yield call. By the way, inflation break-evens are not going through the roof. So this is, to the extent that this is nominals look attractive at 415, it's because real is attractive at 180. So that's the component of bonds that is attractive. The real yield at 180 is attractive in the US, not so in Europe. So I think that spread between US versus Europe should come down. UK is quite interesting because it has characteristics of Europe, but that's priced. Right? The market's already expecting, Sonia is already at 5.75 to 6%, so the market's already expecting that, and therefore I would think of receiving that rather than paying that, both in terms of the front end and also in terms of the long, and I think gilts at these levels are attractive.
Banu, if I could come back to what you were saying about the U.S. and how we don't need to talk about a recession, is that you saying that there is a soft landing scenario that looks like it's playing out here? And then second to that, if we get a soft landing now, does that actually mean that the soft landing sticks, or could it turn into a hard landing if it means that demand doesn't come down enough to really win the inflation fight and the Fed has to redouble down?
Yeah, that's a great point. So let me start with your latter point. If we don't get a hard landing, if we don't get a recession, Ironically, that could be more negative for the markets because the Fed will have to do much more than is being priced. And earnings is a problem, but valuations is a bigger problem. So if the Fed goes much harder, then that actually would mean that the market needs to come down even more than it would if there was a gentle soft landing. But your earlier point about whether we need to talk about a recession or not, let's be clear on this. There is no asset that is talking about a recession. We are talking about a recession. Investors are talking about the recession. The media is talking about the recession. Nothing in financial markets says recession, right? High yield spreads 388. 10-year real yields 180. Euro dollar, Aussie dollar, the cyclical currencies, reasonably well behaved. So there's no real asset class that is saying things are dire, with the possible exception of some China-linked commodities. Nothing else is saying recession. So a recession is not priced. My point out here is that if you don't get a recession in the next 2 quarters, you can still see equities coming under pressure. You can still see U.S. bonds getting a bid because earnings come from a high level, $240 to $245 per share for next year in the S&P, to a less high level, even if it's not recessionary. Just for the record, we do expect a recession late Q1, in Q1 of next year. We think by that time, the tightening will come through. We have to remember that although the Fed has tightened a lot, it has tightened after 10 years of extraordinarily loose monetary policy, and which means that the marginal yield that you see on the screen is not the average coupon that companies or consumers are paying. It takes time for that average coupon to rise towards the marginal, and I think that is going to happen in 2024. So we will see a recession, a mild recession. We will see a recession, but the key point is I don't think you need to, that's not a necessary condition for the market to come down. It may be sufficient. I don't think it's necessary.
Okay, so if that's what you see out on the horizon, given the run-up we already have seen in risk assets, is it time yet to sell?
I think in equities it is, although this could have been said earlier as well. I think in equities, particularly in the US and also in Europe, in Europe we've had some abysmal data, and despite that the market has done well. Not as well as it has done in the S&P, but it has done quite well. So both in US and Europe, I think equities are trading very rich. The more difficult call is North Asia, because again, you had a pretty decent run in Japan, but the numbers are still looking good. Inflation expectations are still reasonable, and the BOJ, all said and done, is not hiking tremendously. Yes, they're tweaking at the margin, the YCC, but real yields are going to remain reasonably low out there, quite negative in Japan as of now. And China is just about getting started. So I think we are in one of those times where North Asia, I think, can buck the trend of global equities coming a little bit lower from out here. So our preferences would be very much number 1, North Asia, number 2, Europe, and number 3, US on the tactical horizon. That's not sort of the 5-year view, but that certainly is the 3-month view.
You bring up Japan. I want to come at that story from a different angle. We've seen a bear steepening this week. I guess just peculiar. And I'm still trying to get my sort of arms around understanding why. The downgrade feels like a really weird example, a weird reason for it. Japan maybe a little bit more. I can understand the supply story sort of allied with the fact that maybe the Japanese aren't going to be buying as much. That kind of makes a little bit more sense. Term premium. You're pulling a face. I can't put any of it together logically to produce a bear steepening of the magnitude that I've seen.
Yeah, I mean, look, it seems like lazy analysis, but when most things fail, most people attribute it to positioning. But in this case, it may actually be positioning, and I'll tell you why. Because I agree with you, the term premium story or the downgrade story probably doesn't make a lot of sense because you don't see it reflected in other asset classes. Vol is reasonably cheap. The dollar is not selling off. CDS is not moving in the US. IG spreads are reasonably well behaved. So everything seems pretty well behaved. It doesn't look like people are running out of the US because they think this is not the risk-free rate. Gold is down. Gold is not up. So it doesn't look like people are running into other assets, selling the dollar in a big way and saying, we're never going to go to the US and it's not the risk-free rate. Doesn't look like it. Japan, the reason I was pulling a face was because the Japanese have not bought global equities or global bonds for a long time. I mean, for the last 2-3 years, their purchases of global bonds have been de minimis because they always hedge their fixed income purchases. And net of hedging, it's a very, very low rate that they're getting in the US or in both. So they've not been buying for some time. So I'm not sure that
So it's just positioning.
I think what's happened is, first thing this year, we saw a short squeeze in equities, and equities moved up. People were still long bonds and short equities at that time. Equities moved up. I think this is some people giving up on bonds and going into equities, I think at the wrong time. Because I think the equity risk premium, which is the valuation of bonds relative to equities in the US, is extremely low. China is on the other end of the spectrum, right? So US equities, very rich, US bonds quite cheap, in my humble opinion. China equities reasonably cheap, and China bonds in the near term quite rich. So I think they're completely on opposite ends of that spectrum in terms of the equity risk premium.
I could genuinely talk to you for hours. Thank you for stopping by and sharing a few minutes with us. It's been great to speak with you. Bana Buweja, of UBS. Thank you very much indeed. Let's get back to some of the news that we've been following elsewhere. The banking reporting season continues in Europe. Crédit Agricole having a pretty solid day today. Shares up. The company reporting a surge in second quarter profit. They've also made an acquisition in wealth. Here's what the deputy CEO told Bloomberg a little earlier.
Making M&A transactions in the field of wealth management is not a new strategy, but we conceive these operations, as always, as simply a complement to the capacity of growing organically. And our wealth management business, Indosuez Wealth Management, is growing organically quite significantly, and we thought that this opportunity of acquiring the group Peter Carn would be a nice complement.
Andre Janse van Vuren joining us now to talk about what is happening here. There's a bunch of things to pick apart. Let's start off with the basic sort of underlying performance of the bank. European banks still appear to have a tailwind from net interest income. The numbers that they've been producing today at Crédit Agricole and at Commerzbank look fairly favourable. How much longer can this continue for?
Well, Guy, there seems to be still some tailwind to be had, especially for the case of French banks like with Crédit Agricole. A lot of that pass-through hasn't yet happened. That's under a quirk under French law and the way they pass through rates. So there still seems to be a lot of tailwind there. Earnings in the case of Crédit Agricole, it blew out all expectations, up 25%. And that was about a third more than any estimates out there.
Okay, so when we talk about some of the strengths of these different businesses, wealth management obviously is what they're doubling down in with taking this stake. How is that performing to this point, and how much realistically is this move seeing building that up?
Well, I would say first of all, this deal will give them, I think, a very good foothold in a regional market in Belgium. This is an established manager there, so that's where this is a good acquisition that they will be looking to build further on. I think for the time being, they will still look at the regional banking, and to the extent that to the tailwind from interest rates and how that will further build their earnings.
Do you expect? So you're saying you do expect further deals to come? Wealth management seems to be where banks want to be at the moment. You can understand why. Low capital requirements, stable earnings. Are we going to see more and more deals like this?
Guys, I would say it's a favorable environment where we are now. I think banks think that assets out there to some extent are still attractively priced, and I think to the extent that people will see value out there is how you will see deals happening from here.
Andre, great stuff. Thank you very much indeed. Andre Janse van Vuren joining us on what is happening with the French banking story. We are counting you down to the European close. In terms of what we're seeing today, it is a bounce back for European equities. Crédit Agricole is one of those stocks that is having a relatively good day. There are a few 52-week lows out there. It's been obviously a tough week this week, and there are a few names that have had a tough day. But these are the figures that you're looking at. We'll come back with the European close in just a moment. This is Bloomberg.
I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
We finally made it to Friday. Wow, what a bumpy week it has been, particularly for the bond market, but equities as well have not escaped. We are definitely down on the week. Up on the session for European equities, but down on the week. I'll show you the week in just a moment. CAC Iran's up by 0.8%. IBEX bouncing back. DAX a little flat, as is the FTSE 100, only up by around 0.5%. But nevertheless, positive performance being posted. You can't say that for the whole week. Let me just show you the chart for the 5 days. We're down by 2.5%. That's 2.4%. Let's call it that. And as you can see, it's been reasonably it's been reasonably straightforward, just on the down every day, and then kind of bouncing along the bottom. We started off kind of north of 470. We were touching up against some really key levels at the top end. Now we're kind of, according to the charts, it's beginning to test some of the resistance at the bottom end. There's some really interesting charts out there. So just keep an eye on this one. It's going to be really interesting to see what happens next week. The CPI prints out of the States, obviously front and center. In terms of some of the stock stories I want to mention, WPP, the advertising giant, down pretty hard today, 3.5%. It's firmed a little bit off the earlier lows. What I think is interesting about this company is it's talking about the fact that actually ad spend from big tech has gone down. And I think that's an interesting story given what we've just seen from Amazon and in particular from Apple. AP Møller-Mærsk, in need of a stock split, but I keep saying that. The stock is down by nearly 5% today. This was a darling during the pandemic as freight rates were high. Those have now collapsed. But what I think is interesting about AP Møller-Mærsk is it's not predicting kind of global recession. It's just talking about significantly slower growth, and it's having to adapt to that. And then we bring in Crédit Agricole, making an acquisition today in the wealth business, but all the other metrics looking really solid at the moment. This is a company that's going to come out with a new strategy going forward fairly shortly. I just wonder, given today's numbers, actually whether they need to do that, because so far, judging by today's figures, things are working out pretty well. So that was the week that was. Let's talk about the week that is coming. We continue with the earnings narrative that we're going to be watching carefully throughout next week. There's a few macro things that we need to fold in. Clearly, US CPI is going to be one of those. Siemens Energy is out with numbers on Monday. On Sunday, Francine Lacroix is going to be talking to Benjamin Netanyahu. I can't wait to hear what he has to say. Such turbulence about the judicial system in Israel right now. But fold that in again to the geopolitical story as well. I think it's going to be fascinating to what he has to say. Tuesday, we get Glencore. Wednesday, we get E.ON. We got Vestas. I think Vestas are coming on the show to talk to us about what their earnings are looking like. Thursday, you get the big insurance companies out. Munich Re, Zurich is going to be out with numbers as well. And Friday, we're back to the macro data. There's a whole load of data kind of underlying all this, but we're still in earnings next week. UK industrial and manufacturing production, plus a whole load of other data. Big number next week is definitely going to be the CPI. Today we get the jobs data. It's Is CPI really going to be actually the real litmus test for how the US economy is performing? Austin Goolsbee, Kaylee, earlier on talking about the fact you want to not look at the lagging indicators. He said wages were a lagging indicator. He talked about the CPI maybe being a more forward-looking indicator that we need to watch for.
Yeah, it's one of the really key data points the Fed is going to get before it makes the decision in September whether it wants to go again or stay on pause. And I do wonder, Guy, to your point, how much the wage data today is really going to inform that at all. And with that, let's get back to our question of the day, which is if wages keep growing, will yields keep growing? Obviously, this week we have seen a massive move upward in Treasury yields. We're seeing that reverse today off the back of the jobs data. But where exactly are we going to go from here? Let's bring in Marilyn Watson, global head of global fundamental fixed income strategy at BlackRock. So Marilyn, just help me parse through the action we are seeing in the bond market. What does today's move lower after such a big and quick run-up signal to you?
So I think today we've seen almost a bit of relief in the market. We had a very strange week where we had obviously a large increase in the debt issuance from the Treasury. I think that had an impact certainly on yields. We also had the news from the Bank of Japan and other things. But I think today the data that we saw coming out of the labour market and payrolls really is showing that the US economy remains incredibly resilient, that it is moderating in terms of the labour market, but average hourly earnings remain pretty robust. The labour market is still tight. Unemployment rate is 3.5%. So I think overall today, the market's just really assessing and sort of digesting the news that the US economy remains in a very, very decent, healthy position overall.
Are you still worried about inflation? Or do you think inflation is something that is past its peak, is going to come down, and generating real yields, therefore, is going to become easier and easier?
So I don't think that we can say that for definite we shouldn't be worried about inflation, and I think the Fed is also, trying to communicate the same thing. We do think inflation is coming down, we think it's moderating, and we think it will continue to do so. That being said, there are risks, certainly, as you say, look at CPI next week. When you look at the previous inflation data, whether it's the PCE deflator or whether it's CPI, it's moderated, but inflation is still high, it's still well above the Fed's target of 2%. And there are a lot of uncertainties and a lot of risk around that. So I think it's too early to say that we shouldn't be worried about inflation anymore. But I do think at its current trajectory, then we will continue to see it moderate from here.
If it's too early to say that we've won the fight against inflation, is it also too early to say whether or not we realistically can avoid a recession? And especially looking at it through the lens of the yield curve, Guy and I have been talking about all morning the bear steepening we have seen this week. It still remains deeply inverted by 73 basis points at the moment. If we do get the soft landing, could we no longer consider the yield curve a reliable signal on recession?
So the curve is obviously deeply inverted. But that being said, we have seen obviously some significant moves this week. And I think overall the market, when you look further out, is pricing in a range of things. First of all, where is demand coming in the long end? I think also when you look at the increased supply that we're seeing coming through, and we'll continue to see a lot more of that as well. I think looking forward, the market, and when you look at the bond market in particular, is pricing in a range of things. It's not necessarily pricing in a recession, and it wasn't necessarily pricing that in before. It's pricing in the fact that the economy has been growing incredibly strongly. It was very hot after we came out of COVID, and we saw, the opening of the economy, and we've continued to see it grow from there when we saw the shift from the manufacturing sector to the services sector. The services sector still, in many areas, remains very, very well supported. And so I think we're just continuing to see this shift in the economy. We are seeing the economy come down from, very, very high levels of growth. And I think that the market overall is pricing in the fact that inflation is coming down as well. So it's not necessarily pricing in the fact that there's definitely going to be a recession, but it has been pricing in the fact that the economy is slowing and inflation is expected to come down. And certainly with all of the measures that the Fed have put in so far, in terms of the very aggressive rate hikes that it's implemented over the past year or more, then we are starting to see the effects of this, particularly in some sectors such as, commercial real estate and parts of the banking sector. And we will continue to see the impact of these rate hikes, I think, as we go forward, because it does take time for them to feed through into the economy.
Let's just think about this week. Let's say I'm positioned at the front end.
Yeah.
And I was thinking about buying duration, because maybe we're coming to that point. Did this week's bear steepening frighten me off that? Is there any reason to get out of the front end?
So at the moment, we like being in the front end still because we don't need to take the duration risk. you get very high levels of carry at the front end, higher than, further out the curve in most cases at the moment as well. We do think that there will be a time when you will want to lock in the extra duration, when we will start to see the Fed not only necessarily pause, but will start to price in cuts as well. And so there will be a point.
Do you think we're still?
We see the market?
Do you think we're still at the point though where the risk is that actually we price out cuts rather than price more in?
It's a possibility. So I think, and we've seen it shift. We've seen expectations shift, and they've been, they've pushed further and further out in terms of the time horizon. So now, next year it is likely that we will start to see cuts, but they're being pushed further and further out, and particularly when we continue to get just such solid data coming out of the US.
As we think about the solid data and the building chorus of the landing potentially being soft, I wonder how appropriately priced credit looks to you, how appropriately tight spreads are.
So spreads are, relatively tight. That being said, all-in yields are quite attractive. But what we're really looking for are where you can get very liquid, very decent sources of carry. And so that isn't necessarily taking a lot of risk in terms of going down the credit spectrum. It's not necessarily taking risk in terms of duration. It's really looking at the front end, looking at commercial paper, looking at high quality investment grade, whether it's in the US or in the Euro area as well. You can get some very decent yield on European investment grade bonds, and then if you hedge them back to dollars as well, you get a nice pickup. So there are a lot of different areas, and you don't need to necessarily take a lot of risk at the moment, particularly, as I say, when we still do have a lot of uncertainty. And looking elsewhere as well, we like Spanish duration at the moment. We think you get a nice bit of carry there. There are other trades we have on where we're sort of short JGBs, for example. So there are a lot of different trades we can put on, also in local currency, emerging markets. It's just finding those areas where we do like the carry, we like the return we're getting, and we're not taking too much risk, and where we do feel that we really understand the risk in terms of liquidity, in terms of volatility, and in terms of the trajectory here, in terms of the Fed and the other central banks as well.
So when you're talking about the risk that you're deciding whether or not to take, I just wonder how great you think the risks really are now, because I feel like we've been talking about what this default cycle will look like, and yet we haven't really seen that much of a pickup, have we?
That's right, we haven't, and I think that's because it takes time for the increased rate rises to actually push through. So we will eventually see different companies that have borrowed, that are leveraged, when they do have to refinance, when those roll over, when they mature, we will start to see that have an incremental impact. We will start to see more of an impact in the housing market and elsewhere as well. But it's been a much softer cycle and a much softer few months than a lot of people expected in terms of it just being overall supported by the economy. And we haven't seen, I think, anywhere near as many of the risks or catalysts that could be a cause for recession that many people anticipated.
Is it easier to understand the US market than the European market? Is it easier to understand what's happening in the States rather than the UK, and in particular what's happening in the Eurozone in terms of kind of where you want to be and what the inflationary trajectory looks like?
I think in large part it is, because when you look at the euro area and when you look at the different economies within it, then we're seeing very, very different dynamics. When you look at Germany, for example, it's doing not very well at all. We're seeing a decline in manufacturing. We're seeing contraction in GDP. But when you look at the euro area as a whole, then actually other areas are actually doing pretty well, and as a whole it's actually still growing and has positive GDP growth. I think when you look at also the dynamics in terms of energy and other sources of inflation in the Eurozone as well, then it's very, very difficult. It's not really one economy at all. It's many economies. So I think it's harder to piece together. I think likewise when you look at the UK, when you look at the inflation profile, which is still incredibly high, we've obviously seen it come down quite a lot, but it's still running at what CPI is at 7.9% on an annualized basis, which is incredibly high. The labour market is tight, and I think we do need to focus on wage growth, but GDP is very lackluster. It's almost flatlined. So I think in a way, the US is in a way easier to understand and to look at than the Eurozone or the UK or even Japan as well, where the dynamics at the moment are just a bit harder to tell. It's possible it's because the Eurozone, for example, is later in the cycle in terms of the ECB and the action it's taken, but I think there are just more nuances, and the fact that you have so many different dynamics going on, it's tricky.
Why take the risk? It's very nice to see you in the studio. Normally to be found in Florida. Fantastic to see you back in London. We'll look forward to it. If you're coming back anytime soon, you're more than welcome to come back. Marilyn Watson, the head of Global Fundamental Fixed Income Strategy at BlackRock. I apologize for the weather. Compared with Florida, I suspect it's not so good here. Let's take a look at where European stocks have settled. We're heading into the break right now. This is what the final numbers look like. A positive session, Kaylee, for European equities, but a very negative week.
All right, well, it's definitely a positive session at this point here in the U.S., Guy. Amazon has a lot to do with that, with an 11% move higher. So with tech seeing such a strong run to the start of the year, we'll take a look at how much that's really warranted, the impact of AI, especially on that strong performance. Kim Forrest, Boca Capital Partners CIO, will join us next. This is Bloomberg.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt and local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth, and countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States, and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
I think that the business has grown to be pretty large already, and I still think we only have a fraction of the features that we need. I don't think we're close to being done growing there, and that is a very strong area of focus for our stores team and for our senior leadership team as well.
That was Amazon CEO Andy Jassy speaking on yesterday's earnings call. Tech has been on a tear this year. The NASDAQ 100 up about 40% so far. So could this continue to hold? Amazon maybe would suggest yes, with an 11% move higher today. But let's get some insight into this. Kim Forrest, Boca Capital's partner, CIO, joins us now. So, Kim, as I suggested, we've come really far fairly quickly. We're going even farther now in the case of Amazon. Is it warranted?
I think so. If you remember, it's hard to remember last December because the market just kept falling and falling, and maybe we've blanked that out. But part of the reason why a lot of tech companies have rebounded and maybe even eclipsed their value last year is because we sold off so hard at the end of last year. And, January had us buying. But now here we sit in the kind of middle of the third quarter, and things are still going strong. And we ask ourselves why. And I think it's because of future demand. We're always buying into the future, regardless of what stock we're buying. Tech really is all about the future. And it looks like AI is a big theme. And the infrastructure needed for AI, which that's what AWS is. And I think that is going to be a trend for the next several years. And investors are saying that by buying shares of some tech names.
Kim, that's fine. And I think you can understand why people are folding that into the narrative. But you've seen such massive multiple expansion for some of these tech names of late. Yes. Aren't we at the point where we now need to see earnings at least justifying some of that?
Well, isn't it funny that Amazon actually talked about making money? Like, I can't remember when that happened ever. I'm being sarcastic. Yeah. But this is something that they were uninterested in, at least in past management. And it's refreshing, kind of like when Ruth Porat came into Google, that they somehow got the religion of making money. And that is unbelievably refreshing to somebody like me.
Okay, so if we talk about the fact that profitability does matter now, I look at Apple, for example, which, yes, they're seeing revenue growth slowing down. Maybe the outlook doesn't look that great. The iPhone, for now, is struggling. But it's also Apple. Until today, this was a $3 trillion company. It's incredibly profitable. It has a huge cash cushion. So how would you think about a stock like that, where it's likely going to continue to generate cash? It's just a question of how much you're willing to pay for that.
Exactly. Well, I think Apple is one of those things that even I say you should have owned for a while now. I have been a big Apple naysayer because in the past I've focused my tech investing on business-oriented companies for many reasons, mostly because business-oriented companies aren't fickle. They don't go to the next coolest thing, usually. But Apple is sort of like the gravitational pull of our sun, the center of our stock market. So, I really think you need to own it. If you don't, I would certainly wait for a pullback. It always happens. And I think people are fretting about, is the iPhone enough for this company? It's a great question, and it's one you should always hold in your mind because it is the thing that drives Apple, the iPhone.
If we see higher rates, if we see long duration bonds yields going higher, does that undermine the case?
Sure. But what are you going to do instead? Buy bonds? The reason why it undermines the case is this, to be perfectly frank, is everybody out there who is buying stocks or bonds uses probably the U.S. 10-year to discount those cash flows back to decide what the multiple is and is it worth it. So if bond yields keep rising, we keep having to give a haircut to that valuation. That being said, what are you going to replace it with? It's an honest answer. What? Or honest question. What are you going to replace it?
I'm not sure I've got a particularly strong and clear answer, but we'll wait and watch and see what the market does. Kim, great to catch up. Thank you very much indeed. Kim Forrest, Boca Capital Partners, joining us on what you do next with tech after that big sell-off we're seeing in Apple today. As she says, though, this is the sun around which much of the financial universe seems to orbit. This is Bloomberg.
think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Stocks are up, yields are down. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, what else do you see out there?
Well, some volatility here, at least on an intraday basis, Kaylee. These are this is the S&P 500 E-mini futures, and steady as she goes into the jobs report. Then a little bit of a dip, and then kind of all over the map. But net, to your point, up 0.6%. The first up day for the S&P 500 in several. In fact, let's take a look at stocks on the week, because we do have stocks down. We had been looking into today at the worst week going back to March, but because of today's bit of a rally, we have the S&P 500 down only 1.1%, the NASDAQ 100 down more. You can see the SOX down even more, considerably down 3.1%. Russell 2000 and the Dow not on this board down the least, really pointing to the breadth that we've seen as some of the non-tech sectors start to perform a little bit better. But nonetheless, there is some selling here. As for some of the big tech names over the last 2 weeks, we have Microsoft and Apple both down. Both of these companies, the revenue growth not so great. Amazon, take a look at this, up 10% on a great quarter. The outlook, the growth that Andy Jassy is talking about. So the real divergence here between these big tech names. As for some other big movers on the week, well, starting out with some of the winners, Arista Networks, the cloud company, soaring up 21%, a great quarter, a great outlook. Atlassian also up 16.4% on a very good quarter, and their cloud outlook helping out. To the downside, though, PayPal down 14%. Those operating margins, transaction margins under scrutiny. And then Fortinet today, guys, you know, having the worst day ever since 2009. The forecast and billings, just not what investors want.
No, that's secure. Abigail, great stuff. Thank you very much indeed. That stock's certainly getting dinged up pretty badly today. Abigail Doolittle, what's happening with the markets? What have we got coming up for you? David Gandler, Fubo TV CEO and co-founder, joining Bloomberg Technology with Ed Ludlow. Looking forward to that conversation a little bit later. I'm done for the week. Kaylee's not quite done for the week, but have a great weekend, everybody. Next week is going to be absolutely packed. The CPI number is going to be front and center. But from Kaylee and from me, thanks for watching. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we can do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow in San Francisco. Caroline Hyde's off today. This is Bloomberg Technology. Our top stories, full earnings coverage ahead as Apple loses its $3 trillion market cap crown amid tepid demand for iPhone. Plus, Amazon seeing strong revenue growth even as the e-commerce giant reins in that spending under CEO Andy Jassy. And Nikola replacing its CEO after less than a year of running the electric truck maker. We'll bring you the details on why and a new familiar face taking the wheel. It is our top story. Apple and Amazon reporting quarterly earnings. You look at the investor response, Apple down 3%. That means its market cap is now below $3 trillion US. It has lost that $3 trillion market cap crown. The other end of the scale, Amazon up 11% on an intraday basis, on track for its biggest jump since November, a beat across the board. We're going to dive deep into the earnings of both companies, but I want to start with Apple because this is a really big change of picture. Softness for iPhone in the fiscal third quarter just gone. Overall revenue beat expectations, but it still fell 1% year on year. That makes it the third consecutive quarter that Apple has seen a year-on-year sales decline. You see that on the far left-hand side of the chart. That is the biggest run of declines or sales drops since 2016. But you go back 20 years, all the way over here, if we get another year-on-year quarterly sales decline for a fourth consecutive quarter, that's the biggest rate of sales drops that Apple's had in more than 2 decades. The story here is about executives talking iPhone acceleration into the fiscal fourth quarter, ending in September, services continuing to be strong, but double-digit declines in wearables and iPad. The story? Is it technology and a lack of upgrades or new generation platforms in the quarter gone? Are we waiting for iPhone 15? Let's get right to Apple and bring in Julie Ask, principal analyst at Forrester. Tim Cook's talking about weakness in the smartphone market in the US, but strength in India and China. What were the main stories for you out of this quarter's earnings?
So specific to the smartphone, the main stories is that Apple did well in China. They did well in new markets that are traditionally dominated by Android, and they had a record for the number of people who switched from Android to iOS. The challenge with the smartphone market is just as you said, it is a mature market. When you look at U.S. online adults, 95% of them own a smartphone. The devices are very expensive. The devices are amazing. The upgrade cycles are slower. It's not like 10 years ago where we all bought a new phone every 2 years. It's just these phones are serving consumers now like PCs for 3, 4, and even 5 years at a time. So it's going to be tough. I don't think it's a surprise, but it's going to be like this because the market's mature unless you go out and find new customers and break into some new markets.
Julie, I'd like to do some mental arithmetic with you. Are you open to doing that with me? Okay.
I'm going to try.
Let's try. Apple said it has an installed base of 2 billion devices globally. They also said they had 1 billion paid subscribers now. But clearly there is a big pocket of Apple device users around the world that are not paying for an Apple service. They're using what's available for free. Are you able to work out, therefore, the path forward? How Apple and how many of those users Apple can convert to paying for a service?
investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000, 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Time now for today's For What It's Worth. How about 39%? That data point is tied to Coinbase. It's the percentage of transaction revenue for Coinbase that comes from Bitcoin, at least in the latest quarter. Coinbase benefiting from a rebound in crypto prices in the first half of the year as Shonali also navigates these choppy regulatory waters.
Absolutely, and today Coinbase asked a judge to dismiss an SEC lawsuit against it, pointing to a recent decision by another judge who ruled that Ripple Labs' XRP was not a security when it was sold on exchanges. Last night, I spoke to Coinbase CFO's Alicia Haas about the regulation's impact on the business.
There was a flight to quality. There was a flight towards Bitcoin and Ethereum. We are definitely seeing the impact on some of the longer tail of crypto assets at this time because of the regulatory headwinds. However, we will work through that, and I think that we are excited to share with the market tomorrow our motion to dismiss on the case that the SEC has brought against us, and really share why we think these assets can be traded in the U.S.
I'd like to tell you, John, that market doesn't know how to feel about the uncertainty around Coinbase, but even with the volatility today, it's still up 154% this year.
And the industry looking for clarity. That seemed to be the message from Coinbase, right? We'll keep watching. For Shonali Basak, I'm John Ehrlichman. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action
to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
A big jobs report and a big reversal in Treasury yields prompting a big rally in equities. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off the closing bell here in the U.S., you take a look at the equity market right now with about 2 hours to go. We're looking at a little bit of a rally. The S&P 500 had been lower for 3 straight days. Not the case on this Friday, up by 0.4% after that jobs report. The headline figure coming in below expectations. That seems to be sparking a little bit of a relief rally, both in stocks and in bonds. You can see big tech rallying as well. The NASDAQ 100 up 0.6%, had also been nursing 3 straight days of losses. You take a look at the bond market, and that's been where all the action is. We had seen a pretty violent rise in yields this week. You take a look at what's going on this Friday, though. 10-year Treasury yields off by about 11 basis points. So definitely a relief rally in that market. You take a look at the 2s-10s curve. The re-steepening has been very dramatic this week, but today lower a little bit, but still nowhere near the depths that we've seen on that 2s-10s curve.
Yeah, put a pin in that thought, Katie, because we're going to talk a lot about that today. But let's go back to some of the risk sentiment out there in markets, bolstered today by that drop that we've seen in yields. But the dispersion there is kind of mixed. Strong inflows into global equity funds with a strong tilt toward tech this week. That's according to the latest read of private clients over at Bank of America. However, that same data is showing strong inflows into bond funds and cash, and strong outflows from consumer stocks. Strategist Michael Hartnett and his team saying clients on a net basis, they're shifting back to risk-off mode amid perceptions that an economic contraction still looms. Atlanta Fed President Raphael Bostic addressing this topic a little bit earlier today. A sit-down with David Weston, this on the heels of that monthly jobs report this morning. He says there is a clear, in his eyes, welcome slowdown in the economy right now, a downshift that's orderly enough to avert recession.
I've expected the economy to slow down in a fairly orderly way, and this number, the 187, comes in continuing that pace. But I'm comfortable. I'm not expecting this to be over in a short period of time.
The Atlanta Fed president there, Raphael Bostic, no relation, adding that the Fed is on a trajectory right now to get back to that 2% inflation target and can actually get there by holding rates at the current level for a long period of time. Katie Greifeld, I just got back from Birmingham, Alabama. All the talk on the streets of Birmingham right now is what the swaps market is pricing in for the next Fed move.
Well, there's not much to talk about because if you look at it right now, it seems like the market is only pricing in about 40% or so that we do get another hike. You can see right now the Fed funds upper bound is at 5.50. What's being priced in terms of the terminal rate, 5.58%. And that pricing really didn't change after that jobs report that we got today. So we'll see as we continue to hear from Fed speakers whether this moved the needle at all. Of course, we have another jobs report before we get to that September decision, not to mention some CPI releases as well. And because of that really no pricing movement, maybe that's why you've seen the short end really calm down relative to the long end. If you take a look at 10-year and 30-year Treasury yields right now, they're coming down a bit today, but we saw a really dramatic repricing over the past several days, currently hovering near the highest level since November, even with the big rally that we're seeing right now, Romaine, in the wake of that jobs report.
All right. We're going to talk a little bit more about that jobs report and economic conditions. But first, some breaking news. This involving Alphabet, then specifically Google, apparently going to face a slimmed down antitrust suit over its search business. Now, this is according to reporting by Bloomberg, saying that a federal judge has thrown out some allegations by the state's attorneys generals who had brought this case here. This ruling was unsealed just a little while ago here, and we're now learning that while Google still faces this lawsuit, it will be much more scaled back than what was originally put out there. We're going to try to get you some details on this for a trial, of course, scheduled to start in a few weeks' time in mid-September. Meanwhile, we go back to the big story of the day, which was that monthly jobs report that we got this morning, 8:30 a.m. Washington time, a surprise to the downside. But for some, it's a welcome surprise, an orderly decline in economic conditions, one that at least some folks think might help us avert recession. Tiffany Wilding joining us right now, PIMCO's chief economist and managing director there. And looking through these numbers, Tiffany, I mean, with always that sort of asterisk by this, that in any other environment, 187,000 jobs created would actually be considered a relatively good report. Did you find a lot of good in this report?
Yeah, I mean, you're absolutely right. 187 jobs, just taking a step back, is where we were prior to the pandemic. It's a pretty solid pace of job gains. Now, of course, everything's relative, and coming down off of, plus 700,000 job gains when we were really recovering from the pandemic, this is actually down quite a bit. I think when we look at, just kind of the broader trends in the labor market, I think what stands out to us is a couple of things. The first is the labor market is slowing. You are seeing payroll growth that is slowing, and that should continue, as we have just the broader economy, which is slowing. I think the other thing, though, is that wage inflationary pressures, although they've come down, more recently they've kind of been stuck, according to average hourly earnings, which is the wage data that's reported with the labor market report. So I think the key question here is still, how much labor market softening do we really need to get wages that are back down with more central bank mandate consistent levels? And unfortunately, this report didn't give us a lot of information on that.
Well, what do you make of some of the comments that we heard today? David Weston had a chance to catch up with the Atlanta Fed president as well as the Chicago Fed president. And both of them kind of saying the same thing here, though, that they're seeing the disinflation, but they're seeing it in a much more, I guess, orderly fashion that, at least in their eyes, they think maybe gets us to that soft landing, though I should point out they didn't use that phrase.
Yeah, well, so I think you have to be a little bit careful. So the way that we're thinking about this is that, there were myriad factors post-pandemic that resulted in, what we call a one-off price level adjustment. Whether they were fiscal factors, which were exacerbated by supply bottlenecks and factors, but that adjustment has basically, we think that's more or less happened. So that means that basically inflation should be coming down as those pandemic-related effects fade. Now, there's another kind of underlying issue here, though, which is that wage inflation or wage levels have not caught up to that increase in price level since we've seen since the pandemic. So people, from a real basis, are still down relative to where they're. So they want to continue to catch up. And obviously, we're seeing this with the strikes that are coming out. The UAW obviously just coming out with a pretty demanding list.
Yeah.
The United Auto Workers, and so there's still, with tight labor markets, it looks like there's a bit of labor bargaining power out there. And so the question is, does that keep wages and wage inflation more sticky? In which case, you could have a situation where, price level inflation starts to really moderate in the back half of this year, but eventually kind of accelerates back up because wages aren't moderating.
Tiffany, I'm hoping you can solve a little bit of a mystery for me, because when we think about the data that we got this week, of course, we got ADP absolutely crushing it at about 325,000 jobs. And then you look at what we got from NFP, 187,000. And there's been a lot of talk about how there's usually a disconnect between those two data sets. Feels particularly pronounced in this last month. How do you think about the relationship between those two numbers?
Yeah, I mean, I think that the ADP numbers, quite frankly, are really, really hard to interpret. We look at other data from a company called Paychex, which looks, they have a sample of small companies that they service, and the
data that's coming out of their database is suggesting also opposite trends as to what we saw in the ADP report for small businesses. It basically suggested that some of the re-acceleration in ADP payrolls was, small and mid-sized businesses within the leisure and hospitality sector, in particular like areas in New York, where these other data sources, effectively are putting small businesses on a pretty decent downward trend. So it's really hard to read the ADP data. In general, we really try to focus on the NFP data. And I think there, again, what the story that comes out of that, is that you are seeing labor market slowing. Now, I don't want to get too wonky, but there are other things, other kind of source data that the government uses that actually suggests that payrolls actually might be overstating what's actually happening in the economy. So, if you look at, on a lag, if you look at unemployment insurance records and things like that, it suggests maybe the labor markets aren't as hot as what the labor market report suggests. Tiffany, I'm hearing what you're saying, and it sounds like I can ignore ADP going forward, so I like that. We don't have much time left, but I do want to push ahead to next week when we do get the July inflation numbers. And if you look at CPI, what's expected on a year-over-year basis, expected to see a little bit of a re-acceleration from 3% to 3.3%. I know a lot of that comes back to base effects, but is that a dynamic you expect to see continued re-acceleration? Well, as I said before, I do think you will see in the year-over-year rates, I think core is the one that everybody should really focus on here because, as you said, we had a lot of volatility in energy prices last year, and that's resulting in volatility in how the year-over-year rate moves now because those prints are falling out of the calculation window. But core, you don't have as much noise, so really focus on core here. And we do think core inflation can decelerate down. CPI core inflation can decelerate down to 3 or 3.5 by the end of this year.
Yeah.
Now, but again, some of the things that are causing that, they're a little bit one-off in the sense that you are having used car prices that are falling now, and falling pretty fast, but that's not going to happen forever. At some point, used car prices will stop falling, and that downward pressure on core inflation will subside. So, we do think you can see some re-acceleration in core inflation next year, but again, and that's going to depend on wage inflation, but that's a next year story.
All right, Tiffany, always great to catch up with you. Have a wonderful weekend. PIMCO's economist Tiffany Wilding there helping to kick off today's program here. A lot more coming up, including a discussion about economic conditions with Glenn Humbert, of course, a former Council of Economic Advisors chair, and Mark Duggan, who also served on that council under President Obama.
Plus, we'll talk with the CEO of freight transportation company XPO as the company's latest adjusted earnings beat estimates, an overall soft environment for the sector.
And more pain for Carl Icahn. Shares of Icahn Enterprises having their worst day on record after the company slashes its quarterly payouts in half. Icahn blaming Hindenburg for the latest struggles. A conversation and so much more coming up in a bit. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited
We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Well, shares of two of the S&P 500's biggest companies, we're talking about Apple and Amazon, they're moving in opposite directions today after delivering their latest results. Abigail Doolittle has the latest.
Yeah, Katie, a tale of two earnings stories here with Amazon soaring, Apple down sharply. The worst day for Apple since January of this year. And on the week, the worst week since November of last year. So Amazon, of course, beat and raised. The outlook is rosy in terms of growth. Apple, the fourth quarter of a decline for sales. Let's take a look at that, in fact, because you can see here it's actually going in the right direction. The declines are becoming smaller, and it's estimated in the September quarter to become even smaller. December, if the iPhone sales cycle can kick in, we could be looking at growth, but that's a big if because they're talking about the idea that there's less demand for these smartphones. As for the year, now this is a pretty busy chart, but the point that it's making is if we play it forward to NVIDIA up 209%, Meta doing quite well after its earnings report, 11% growth. Here's the rest of the pack. Amazon trying to join these two high flyers, Romaine, but clearly lots of pressure on NVIDIA. Will it go the way of Amazon or Apple? Well, we'll find it out toward the closer to the end of the month.
All right, well, let's get some perspective out of our next guest, Kara Murphy, joining us right now, CIO over at Kestra Investment Management. And actually, let's just start there, Kara, because we talk about this idea of just how dominant those big tech stocks have been, that magnificent seven, if you will. And a lot of questions, not so much just about how expensive those stocks gotten, but do you think people are actually willing and able to buy anything other than those seven stocks?
Well, at some point, I hope so, because there's only so much money that can go into just a very small handful of stocks. And if you think back to the beginning of the year, I mean, there was this really like gush of momentum into those names. As number one, the economy was stronger than expected. We had excitement over AI. We had evidence that technology, the sector in general, earnings were bottoming in the first quarter. So there were some good, really fundamental reasons to kind of pour money into those names. But from here, in order to have a really healthy rebound in the market, you have to have them share the love a little bit. And that's our bet from here. The market's at a bit of a fork in the road. We have to decide, do we just keep playing that same old tune and pouring money into those names, or do we see this rally really broaden out? And we think, with it looks like corporate earnings are likely to bottom in the second half.
Yeah.
We think that the Fed is close to the end. So again, there are a lot of reasons to start to be a little bit more fundamentally optimistic about the rest of the market.
And we should point out, just for our viewers, the Russell 2000, the small cap index, actually outperforming the S&P for a fourth straight week here, Kara, although we should point out they are down on the week. But that outperformance seems to be indicative of a shift in sentiment that we've seen over the last few weeks, where people, I guess, have a little bit more confidence about the economy, and then as a result, some of those cyclical stocks and some of those small caps.
Absolutely. And in fact, the Russell 2000 started to outperform the NASDAQ at the end of May. It's kind of hard to remember that. A lot of people gloss over that fact, but we now have a couple of months of the small cap starting to pick up that slack. And when you look at some of the valuation differentials between the smallest names in the market and the largest names, those have grown to wides that we haven't seen in quite some time. So you also have valuation support for those smaller names.
And from your perch as CIO, I'm curious to get your thoughts on the bond market right now, because it has been a wild week, particularly at the long end of the curve. When you think about some of the volatility that we've seen in 10-year, 30-year treasuries, how does that fit in how you're thinking about them in your portfolios?
So, I mean, think back to 2022, and I call that the existential crisis for bonds in general, where really, like, a lot of investors had left fixed income for dead. Now we have yields that are much more attractive than the beginning of 2022. You have a lot of the Fed rate tightening behind us. So there are a lot of those kind of fundamental things that are very supportive of the fixed income market. Now, you point the long end of the curve in particular has had an extraordinary amount of volatility. And that's where a lot of these questions about long-term growth and inflation of the U.S. economy and the creditworthiness of the U.S. government really come into play. And that's where the battle royale happens, the long end of the market. So we're a little bit more comfortable playing the middle part of the curve, where it seems clear as the yield curve starts to sort of revert to a more normal shape and you have some pretty nice healthy yields, that feels like a more comfortable place to be than out in the middle of the battle on the long end of the curve.
Kara, we only have about 30 seconds left, but at what point would you step into the long end? At what point has the sell-off gone on long enough?
I think as we start to get more clarity on terms of where inflation is going to be, so right now the bet is that inflation stays a little bit more sticky than where it is. So as we have more confidence that that's going to reliably kind of calm down, I think that becomes a little bit more attractive. And then also as we see the Fed really back off.
All right, Kara, have a great weekend. That is Kara Murphy. She is CIO over at Kestra Investment Management. Now, coming up, we'll get insight on the freight shipping sector from the CEO of XPO as the company releases its latest results. That's next. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
All right, a look right now at the supply chain, a look right now at the trucking industry. XPO out with results. The shares higher on the day for a second straight day. Shipment growth coming in the month of July at about 9% plus, and adjusted EBITDA for the full quarter topping expectations on Wall Street. Pleased to say that joining us right now for a conversation is the CEO of XPO, Mario Herrick. Mario, great to have you here on the program. Let's talk a little bit about the results in the most recent quarter and what actually drove that growth. Where is that growth coming from?
First, Romain, thanks so much for having me on. We reported a solid second quarter here, and the results we just posted this morning, where we beat expectations on EPS, we beat expectations on EBITDA as well, and margin expansion in our less than truckload business here in North America. Now, importantly, we grew our shipment count 2% in the quarter in a backdrop of an industry where shipments were down in the high single-digit range across the industry. Now, the reason why we're gaining those market shares, they are driven by improvements that we are doing in the service quality that we're offering our customers. And it's across multiple segments is where we're seeing those wins coming in.
I know that this probably isn't going to have been reflected in the second quarter earnings, but as you know, one of your competitors in the less than truckload business, Yellow, effectively shut down. Have you seen any sort of material increase in business as a result of that?
First, my thoughts go to everybody who has been impacted by the issues at that competitor. When we look at the quarter, as you said, the second quarter was not impacted by it, but we've seen that impact here in the month of July with that disruption happening. we've seen a big uptick in demand with freight going to other carriers. Historically, the less than truckload industry has been tight on capacity. There's not enough trucking terminals or service centers in the industry to handle the volume. And when you have 10% of that capacity that has gone out of the market, we've seen that get distributed. And for us specifically, we've seen a big acceleration in volumes. Our shipment count was up 9% in the month of July. And we would see that demand to continue to be strong here as we head into the third quarter, given the industry disruption.
Would you expect to have to raise prices given that capacity is a little tough here?
Yeah, we do expect that. I mean, our customers understand that when you take out 10% of the capacity, it's going to cost carriers more to be able to move the shipments. And we always want to charge a fair price for the service that we are offering. And our service product over the last couple of years has improved tremendously. And our customers see value in that service that we offer, and then paying a higher price for it is something that they accept with us. We do see that the pricing in the industry, though, is going to firm up, given the fact that you have taken out 10% of the capacity, which was already, again, a tight industry when it comes to capacity.
So like you say, customers understand the dynamics here. Are you able to quantify, though, how much you might have to raise prices coming out of this?
Yeah, so we have seen an acceleration, and we call it yield or revenue per hundredweight of freight that we are moving. We have seen an acceleration of our pricing in the second quarter to begin with, and that we expect that to further accelerate here in the third quarter and fourth quarter. Now, the magnitude of it will depend. Usually in our industry, in a soft macroeconomic environment, we see pricing improve in the low single digit on a year-over-year basis. And in a tight market environment, we see that being more in the high single digit on a year basis. And we expect here with this industry disruption to see a move from the low to mid single digit price increases on a year basis to head more towards the high single digit territory.
All right, Mario, going to have to leave it there. Appreciate you taking time for us. Mario Herrick there, he's XPO's CEO there. A look here at the trucking industry. Those shares higher for a second day here on a Friday afternoon where markets across the board are higher, at least for one day, not necessarily enough to compensate for the losses that we saw in the previous 3 days. And actually, I just need to correct myself here, Katie. Actually, since the show started, we've actually slipped into the red here, seeing a pretty significant drawdown actually coming across the board here. Keep in mind, most of the indices here in the U.S. were up roughly about a 0.5 percentage point or so here, but over the last 20 minutes or so now, dipping into the red.
Yeah, pretty dramatic. You look at the S&P 500 flipping into the red, down 0.2%. Had been higher by as much as 0.9%. Could be interesting to try to figure out what led it there. But you look at the biggest points contributor to the downside remain. Probably no surprise that it's Apple. Shares currently off 4%.
Stick with us. We're going to get you some answers here on the big market moves as we count you down to the close. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Markets to close, almost 2:30 here in New York. An eye on the broader market and an eye on commodities as we close out the week right now with crude oil up for a sixth straight week. Abigail Doolittle standing by with our commodities close.
Yeah, indeed, Romaine. We have crude oil higher, but we have other commodities higher too, really in contrast to what stocks are doing today and on the week. Although on the week, commodities down despite the rally for crude oil. Today up 1.5%. And of course, the strength having a lot to do with the inventory number that came out on Wednesday, plus the Saudis and Russia extending their cuts. Gold up ever so slightly. We do have the Bloomberg Dollar Index down about 0.4% today. That's going to help out commodities, just provide a tailwind. Wheat snapping a long losing streak today, up 1.3%. And orange juice up 0.7%. It's not entirely clear what's behind that strength. Earlier today had been up more than 1%. Let's just take a quick look at wheat, because into yesterday we did have wheat down 7 days in a row. Again, today higher, but net over that time period down 16%. Romaine, this is one of the worst losing streaks that we've seen for wheat for some time. There are some reasons to think it could decline more. A lot of this having to do with the idea that there could be more supply out there from Ukraine than had been previously thought.
All right, Abigail Doolittle there with a nice roundup of what's going on in the commodities space. Let's turn back to equities and a look at Icon Enterprises. IEP down 26% or so here on the day, having its worst day on record, a stock that's been battered around for quite some time. This after the short seller Hindenburg accused Icon and the company's practice of Ponzi-like behavior. Crystal C joining us right now to talk a little bit more about that. The market moved today, not necessarily because of that report, but more importantly, I guess the reaction to the fallout from that report, a big cut in the dividend.
That's right. They're cutting dividend by 50%. It's now $1 per unit rather than $2 per unit. Icon had always give out a dividend, so for him to signal that it's coming down gave the market a sense that he's giving in to the Hindenburg report. And Hindenburg actually responded on Twitter, or X as we call it now, that they had predicted this in May that that will happen.
And that's what's interesting here, because of course Icon has vehemently pushed back against the report, but the dividend was part of it. It was one of the key characteristics of that report.
Yeah, so there are a couple of criticism in the Hindenburg report, and Icon so-called enriching himself through these dividends is one of the criticism. And some of the other things include how the net asset value of IEP, which has mostly public company equity holdings, it's also another question. So this interesting, move for him to draw down the report also follow another move where he pegged his personal loan against assets.
But that seemed to be the crux of the report, as well as some other criticisms of IEP. I mean, there are a lot of people that were kind of wondering why this is even a public company. But it's very clear that a lot of this was a way, effectively, to provide payouts for himself and for the people affiliated with the company, which is perfectly legal. But it raised a lot of questions about I guess ethics, if you will, to put it mildly here. Does this resolve that?
So the payout, like you said, Carl Icahn himself is the majority owner of IEP public holding. So whenever he gives out a payout, he's getting majority of it.
That's nice.
And so it's a corporate governance issues for sure. And as an activist himself, he's really always attacking companies with corporate governance issues. So this is when Icon get Icon, where Hindenburg is calling him out using some of his own tactics.
You said he got iconed.
He got iconed.
Okay. You should trademark that.
Yeah, well, we heard from Carl Icahn, of course, in that letter saying that they're going to stick to our knitting. What exactly is that knitting?
So he has said that activism is the most important strategy in IEP. He's going to go back to his roots, focus on activism. Not that he's ever left. If you remember, he had a very interesting board fight with Illumina, which resulted in him winning one board seat. So he's saying that he may be tweaking some of the short strategies, but his long strategy remains the same, and he will still be an activist.
Okay, it'll be interesting. But a real activist, not just like picking fights with his rivals and other people like that, like actually fundamental activism.
Well, he's not gone away, so we'll see.
I mean, this was all the talk in Birmingham.
This was all the talk. Yeah. Not going away. It's going to be fascinating to watch. I'm sure you'll be all over that. Our thanks to Bloomberg's Crystal C. Still ahead, it's been one downgrade after another for Southwest after posting weak results last week. Jefferies, just the latest to cut its rating on the stock. We'll talk to that analyst next. This is Bloomberg.
Names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges. Britain's next.
It was going to keep running
World Cup. This is a three. As the economic picture does. The OK is getting ready to make a decision.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Let's go at a view from the sell side with our top calls, the big movers on the back of analyst recommendations. Let's start with Amazon. Rosenblatt lifting the stock to a buy. This after the company reported second quarter results that beat expectations across the board. The analysts there saying that Amazon's move to focus on retail and AI for its cloud computing unit opens the door to higher multiple consumer growth stories. Shares having a phenomenal day, up 9%. Let's take a look at Shake Shack, getting an upgrade today as well. This to outperform over at Raymond James. The analyst citing, well, Shake Shack's second quarter results and says annual unit growth of more than 20%. Not only could that create significant shareholder value, but it will do so particularly if they can use that as a way to boost margins. Shake Shack up 5% on the day. Meanwhile, CSX not having a great day at all. Cut to neutral over at Bank of America, the firm's first neutral rating on the transport company since 2016. A lot of concerns right now about the railroad's performance, particularly following the exit of its COO and then the appointment of a new CEO that's really being heralded over at rival Union Pacific. CSX down 4% on the day, and those are our top calls. We're going to stay in the sell side space right now and take a look at Southwest. There was a downgrade there just a little while ago in the wake of weak earnings results. Jefferies analyst Sheila Kahyaoglu cut her rating for the budget airline to underperform from hold. She also trimmed her price target down to $25. Sheila joins us right now to talk a little bit more about what's ailing some of these airlines, Sheila. And is this all about domestic travel right now?
Yeah, thanks so much, Romaine. I do think it's about domestic travel slowing down, and that's one takeaway from earnings. We got to see the big network carriers report earnings like Delta, United, and they were really good. And that was on their international offering and premium offering, which are over 50% of sales. And then as we got to see Southwest and the low-cost carriers report, we saw a softening in the U.S. consumer become more apparent, and that's why we decided to cut our rating to an underperform. It's the only underperform on the street, and we're about 40% below consensus for 2024 numbers.
Is there a cost story here, Sheila? I mean, if you assume that there might be some material weakness in bookings and maybe even pricing, is there a cost story there that Southwest can actually sort of turn to preserve some sort of value?
Not only are we negative on the revenues, which we could get to, but on the cost side, management discussed about $1 billion of cost savings as the fleet was the capacity was optimized this year. Now they're talking about $500 million of net savings from the network being optimized next year that starts in Q2 of 2024. However, Southwest has to restructure its network a bit because post-COVID, their network isn't as aligned to customer needs, and that's where they're seeing the most softening of pricing. So that's the cost element that they're talking about, but we just don't believe it just yet because clearly they have to reorganize their network a bit. And at the same time, they cut numbers on 2023 for higher costs because they're seeing higher labor accruals. So obviously salaries are going up for pilots, and of course jet fuel, as we just discussed, is also up.
And Sheila, to your point that, when it comes to these domestic airlines, maybe the U.S. consumer weakening a little bit, that would hurt the likes of Southwest. What would that mean for an American, for example, which also really relies on the domestic market?
We think it's the most immune to this will be Delta and probably United, just given their international exposure. Based on JetBlue's commentary, you could see some softness at American as well. But primarily, Southwest is sort of stuck in the middle. Because they're between the low-cost carriers and the network carriers, they're getting squeezed the most. Additionally, while pricing is going down, Southwest is adding capacity. So we expect them to add about 8% capacity. They're taking 70 Boeing 737 MAXs this year, another 100 next year. So in Q1 of 2024, their capacity, their flight schedules are increasing about 14 to 16%. So that's not helping them either. So they have that fleet dynamic, and also the low-cost carriers are adding more capacity at the same time.
Adding more capacity. Do you expect those decisions maybe to be reversed at this stage if this dynamic, this backdrop continues?
I think it'll be hard for airlines to step away from aircraft that they're expected to receive in the next 6 months to a year. They're contractual, so that's unlikely. And they actually exercised options this quarter, so I don't think so. They'll probably look to optimize the fleet. And the good news for Boeing and the rest of the aerospace supply chain is other carriers we're hearing from are not necessarily talking about price declines. If you listen to Lufthansa yesterday, they saw pricing up, yields up 25%. So they're seeing good stuff in Europe over there. So I think with Southwest, with the fleet, they might have to rejigger it a little bit, but for the near-term aircraft that they're slated to receive, they're unlikely to get out of those.
I want to end here, Sheila, with a question just about the strategy the Southwest is taking. I mean, we sort of think of them as a discount carrier. And for years, we know that there was a certain simplicity to their business model that I think endeared a lot of customers to them. But anyone that's flown Southwest over the last few years knows that they're nickel and diming customers the same way that the other airlines are, in fairness here. Do you see any sort of chance that maybe they will try to differentiate themselves in some way rather than just going down the same road that the other airlines have taken?
I mean, they still have good customer service aside from the blips we've seen over the last year, but the issue is really their network, and they've kind of gotten too big. So where they're adding capacity is the 300th flights out of Denver or Baltimore isn't really helping them and is hurting their price. And as we talked about, like the dynamics of where the work from home is post-pandemic has changed and has really hurt their network. So it's not so much about the customer and the brand, although people think that given their recent issues. We think it's more about the network.
All right, it's great to talk to you, Sheila. Have a wonderful weekend. Sheila there, Jefferies analyst covering the airline sector. A look at Southwest Airlines. Meanwhile, some breaking news back in the trucking sector. This involving Yellow, the company, of course, that is set to go through bankruptcy. Learning through that bankruptcy filing that it is mulling an asset sale here. We don't have a lot of details here about exactly what exactly will be sold here, but we do know that this Chapter 11 process for the company could actually lead to some degree of liquidation. So a lot of discussions right now about the removal of a big player in the less than truckload market, whether that benefits companies like XPO and more importantly, where those assets end up. All right, meanwhile, we do want to go back to the broader economy here because discussion coming up after the break between two major players in economic policy. David Weston out at the Aspen Economic Strategy Group, a sit down with Glenn Hubbard, who used to head the Council of Economic Advisors under President Bush, and Mark Duggan, who actually served on the Council of Economic Advisors under President Obama. That conversation coming up after the break. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Time now for our Wall Street Week Daily segment with the host of Wall Street Week, David Weston, on location at the Aspen Economic Forum, sitting down right now, a conversation with two key players in economic policy. David.
Yes, Romaine, we're back in Aspen, Colorado right now, and the
subject this year has been building a more resilient U.S. economy. You can't do that without talking about the debt and the deficit. Can't talk about that without talking about where we are with Social Security. So we're delighted to be joined by now an expert on that subject. He's a professor of economics at Stanford. He's Mark Duggan. And also a regular guest of ours, I'm delighted to say, is here. He is Glenn Hubbard. He's from the Columbia Business School, where he was the dean for many years. Before that, he ran the Council of Economic Advisors for President George W. Bush. So, gentlemen, thanks so much for being here. Mark, let's start with you because you're really working on this project.
Right.
You're going to have a paper coming out in the fall. Tell us what the problem is from your perspective on Social Security right now.
Right. Well, Social Security is America's largest and most important government program. It provides benefits to 1 in 5 Americans, and right now it's starting to run a deficit that is growing each year, and it is drawing down a trust fund that if policymakers don't act in a pretty aggressive way in the near future, all Social Security recipients will face an immediate 23% cut in their benefits, which would have huge economic impacts.
When does that come?
2033, so 10 years from right now.
So 10 years from now. And is there any alternative? Is there any other alternative to really cutting people 23%?
Yeah, if there are changes made to the program before 2033, then we can avoid that large benefit cut. But those changes need to happen sooner rather than later.
Normally in business, the way you address something like that is both by raising revenue and cutting costs. Is that possible here?
That's pretty much what needs to be done. There's no way to pull a rabbit out of a hat with this, and there's a combination of ways, either increasing revenues to the program or reducing the growth rate of benefits for the program.
So, Glenn, you've been studying this, following it for many, many years. What is the right approach, and why haven't we taken it?
Well, I think Mark's right. If we want to make changes in Social Security, we do have to get incremental revenue and cut costs. But I would widen it. I fear another door politicians will reach for is just using general revenues. That is not covering the deficit and adding further to our problems. I think what we need to do is almost like the Greenspan Commission, form another commission to tell the public what this is, what the trade-offs are, and then make changes to the program that modernize it. Maybe we need to raise minimum benefits. Maybe we need to make the affluent get a little bit less generous treatment from Social Security. Mark teed up a lot of this in his important work, and I think we've got to get on this. But communication with the public is essential.
Well, the Greenspan Commission, I think got around some of the politics of it, right?
Absolutely.
Explain exactly how that worked and why it let some of the politicians off the hook, if I can put it that way.
Right. No, it's fair to say, fair to put it that way. It was 40 years ago, and it was a bipartisan compromise, and it was a little bit messy, and it was unclear up until the 11th hour if it would actually happen. But it was a combination of a gradual increase in the tax rate for the program from 10.6% to 12.4%, and an increase in the full retirement age that was phased in only gradually. So there was no change in benefits for existing Social Security recipients, and there was no reduction in the growth rate of benefits for anyone for another 15, 20 years. So it gave people plenty of time to prepare, and ultimately that was a reform that lengthened the life of the Social Security program. But here we are 40 years later, and we've got to come back to it now.
So, Glenn, one of the problems, as I understand it, is we've pretty much, since that 40 years ago, kept the rate of the taxation basically where it is. Even as incomes went up, you only pay up to a certain level, right, of your FICA tax, and then it cuts out.
Well, that's right. And I think Mark's paper proposes ways to get at that, either incremental increases in the payroll tax rate, changes in the payroll tax base, or a supplemental tax perhaps on high earners. But, a couple of things have changed in these 40 years. One is the scope of demographics. We now, it used to be 40 years ago, you can say, well, we're not going to touch the retired or nearly retired. Well, that's a little bit harder to do now. And our politics are much uglier. The kind of commission approach is going to have to be really artful.
Yeah, one of the things that your work has pointed out, Mark, actually, is the benefits have actually increased in the sense that we live a lot longer.
Yes,
so the total amount of money that we get is actually a lot more than it was 40, 50 years ago.
Much, much, much greater. Yeah, our life expectancies since those amendments 40 years ago have grown very significantly. And so the effective value of Social Security to today's taxpayer, today's worker, is much greater than it was then.
Glenn, also strikes me that one of the issues here is the money, there's only so much money to go around, presumably. And if you're spending it on Social Security and things, you're not spending on maybe some other social programs that we need to do for the country.
Well, and this is why I think a commission is going to be important. It's no doubt we need to spend more on national defense. I think both parties are in agreement on that. We want to make further investments in preparing workers for the modern economy. We have infrastructure needs. We have all of these things. We have health care. we really have to talk about trade-offs and costs, because I think we can't raise taxes enough to cover all of the financing needs of our social insurance program.
So, Mark, you spent time in Washington. You have some sense of the practicality. Even in the work you're doing, you're trying to make it practical. You're not trying to be too radical. Are you getting much uptake on some of the things you're talking about? Are policymakers in Washington at least open to talking about this?
I think they are open to talking about it, and they recognize that this is a really important issue, and they can't kick the can down the road for much longer. So I think that there's a conversation, and everyone has their preferred approach, but there's no simple, easy way to do it. And I think getting people to the table, talking about potential compromises is something we can do. I hear a lot of concern that things are too polarized and things are not in D.C. as friendly now as they were 40 years ago, but I believe that in this country we can come together and solve this challenge.
Glenn, give us some hope here, because some of us outside of Washington feel like Washington doesn't do anything hard until they have no other choice. They come to a crisis point. Are we going to have to get there here?
I don't think we're going to have to wait until 2031. I think Mark's right. I think if we bring together a number of fiscal challenges, use something like a commission structure, we can get people to start talking about this now.
The other thing I'd point out, Mark, that I got from some of your work is who really depends upon Social Security critically. There really is a breakdown demographically.
Absolutely. So it is definitely true that people with lower incomes depend much more on Social Security. So a large fraction of people, let's say below the median income, derive most of their income from Social Security. And it also is true that older elderly people, let's say people who are 80 and up, this is their primary source of income. It's a larger source of income for underrepresented minorities, for women. So it really, a 23% across the board cut would really hit some groups extremely hard.
Well, and your work pointed out that there are some groups that get as much as 90% of their income actually off of Social Security. So you take 23% away from that, that is a big haircut.
A huge haircut. And there's no, I think we know how to do this. 40 years ago, I wouldn't say that the approach then is necessarily the optimal one then, but we showed that we can do this together. And I think I'm very optimistic that we can come together and solve this.
Glenn, are you optimistic? Do you have hope? What do you say?
I am, because we have to. You know, in Washington, sometimes math drives the train, not economics, not politics. So I think we have to, and we will.
Where else should we be spending money, Glenn?
Well, again, I think defense is going to be an imperative for the nation. I think investments in training, in research, but all of these things cost money, and so we really have to make trade-offs.
Okay, guys, thanks so much. Really great to have you here. That's Glenn Hubbard of Columbia Business School and Mark Duggan of Stanford. Back to you, Romain.
All right, our thanks there to David Weston. You can catch David every day, of course, as the host of Wall Street Week, which airs 6 p.m. New York time here. Full coverage from the Aspen Economic Forum, conversations with Austin Goolsbee, Raphael Bostic, Cecilia Rouse, as well as Larry Summers. Meanwhile, let's check back in on what's been going on here in the markets. Katie Greifeld, just about an hour ago when we kicked you off to the close here, all the major indices in the U.S. were in the green. As of right now, all the major indices in the red, a sharp downdraft just in the past 30 minutes of trading.
And a lot of that coming from Apple. Looks like shares took another leg lower. They had already been under pressure after last night's earnings report and currently off by 4.7%. And continuing to fall. If that holds, Romain, that will be the worst daily performance since December 2022. Interesting
to see the push and pull between two big heavyweights in that index, the big rally that you're seeing in Amazon, the big sell-off that you're seeing in Apple. At least for right now, we know who's winning that tug of war. The moves that we've seen in the yield space, that still persists, lower by about 13 basis points on your 5-year yield, 11 to 12 basis points on the 10-year. The VIX elevated here on this day, and well, the only real bright spot in the commodity space right now, that belongs to crude oil, up about 1% on the day, heading for what's going to be its 6th straight weekly gain. Rounding out into the final hour of trading, Romain Bostic alongside Katie Greifeld. We're counting you down to the close. This is Bloomberg.
emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth. And countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is the countdown to the close. I'm Romain Bostic.
And I'm Katie Greifeld.
Let's take a quick look at the markets here, Katie, because we came into the start of this show about 1 hour ago with all the major indices in the green on the day. All the major indices right now flipping into the red on the day, firmly in the red on a weekly basis. And I don't know if we have a quick intraday chart we could put up of Apple, but that appears to be the catalyst for the downdraft we've seen over the past 30 minutes or so.
Yeah, pretty dramatic move in Apple just in the last hour. Maybe some funky things happening into the close of trading on a Friday. Interesting, it's breathing some life into the VIX, above 17, Romain, the end of days.
And by life, you mean it's getting worse. There's Apple there. And you look at that downdraft here. I mean, keep in mind, at 4.5%, this is going to be its worst day of the year should these losses hold. And remember, it's down for a fourth straight day. Of course, this is a stock that has had a phenomenal run on a year-to-date basis, but given its heavy weighting in the S&P and the NASDAQ, a 4 to 5% drop on that is going to be the counterbalance to the big updraft that we've seen in names like Amazon. I'll flip up the board real quickly, I do want to take a look at the 30-year yield, and really across the yield curve, we're seeing those yields drop. That was actually a big part of the reason, or actually, I'm sorry, let's take a look at the jobs report here that we're seeing right now. This was an interesting print here because it was weak, I guess, but I don't know. Do you remember the old halcyon days when 187,000 jobs created in a month was actually a good thing?
I honestly cannot. Yeah. I feel like that part of my life is over.
Part of your life is over. I know you've been taking a look at some other individual movers, Katie, so it's not just Apple to the downside and Amazon to the upside, some other names in there as well.
Yeah, let's talk about Block. It's having a hideous day, over 13% lower. On some metrics, this was a beat and raise quarter, but it was July's gross profit growth forecast that's really weighing on shares. 21% year over year expected. That's actually slightly above consensus, but as a Jefferies analyst phrased it, that figure's likely below buy-side expectations. You can see that in the shares. Should we also talk about Nikola? Probably.
Nikola?
Yeah.
Is that still trading?
Nikola,
okay.
yeah. I'm assuming that's how you pronounce it. Shares off by 16%, some shakeup at the top. Steve Gursky is going to become CEO effective immediately. He is Nikola's chairman. Of course, the current CEO stepping down due to a family health matter. But Nikola obviously dealing with a lot of different things right now. And so maybe the C-suite's shakeup, if you will, also hitting sentiment. Let's also talk about Amazon because it's the flip side of that Apple story. Amazon having having a fantastic day, up over 9%, able to generate strong revenue growth in e-commerce while also cutting the pace of spending.
Yeah, absolutely. But again, we talk about just the weight of Apple, of course, the highest weight in the S&P 500. That's contributing to a big part of the decline here. Amazon, the third highest weighted, but frankly, a 9% gain on Amazon, 4% drop on Apple. Well, unfortunately, Apple wins out the day. We're rounding up into the final hour of trading here on a Friday afternoon, less than 1 hour away from those closing bells. Our cross-platform coverage right now, as we count you down to the close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick here alongside Katie Greifeld. We're joined right now by our colleagues, Tim Senovic and Madison Mills. Welcome to our audiences across Bloomberg Television, Radio, Originals, and those folks streaming on YouTube. A down day here for the markets, a down week as well.
Yeah, first, is it
What a segue.
to come in? It turns out another study is out talking about productivity in the workplace, working from home versus those folks who go into the office. Economists at MIT and UCLA, they found that workers randomly assigned to work from home full-time are 18% less productive than those who are in the office. Now, there are a lot of caveats to this.
Who sponsored this study?
Office.
Big office. Yeah, exactly.
Well, and overall, as you guys
study
can
brought to you by
see,
Court Furniture Rental.
oh, there you go, there you go. But as you guys can see right now, overall productivity is up. And when you look at this study, it is, to your point, I know we're joking around, but it is about new hires specifically. And I don't know about you guys, but I feel like I'm not exactly my most productive my first couple months in a new job.
No.
You're kind of getting your feet wet. You know what I mean, Katie? So
yeah, that's not fair at all.
Yeah.
But in any case, also, I don't know. I feel like I'm less productive at the office because my friends are here. I spend all day.
You just hang out? You just getting coffee all the time?
I'm up on 6. I'm getting coffee. It's ridiculous.
Well, I mean, it's interesting. Yeah, too. I mean, look, there'll be a lot of people parsing whether we're more productive at home or in the office here. But I thought those productivity numbers that we did get, what was it, yesterday, those quarterly numbers, and remember, I mean, there hasn't been a productivity story in this country now for quite a few years here. So to see that sort of quarterly uptick for, what was it, fourth or fifth straight quarter, certainly something to be encouraged by.
Well, sticking kind of with the labor market, a story that caught my eye is that we know for a lot of the tech giants, we went through that layoff cycle a few months ago. It was all we were talking about. But what's interesting now, after we saw those layoffs earlier in the year, now the tech giants are cutting back on their marketing budgets. And you can see that if you take a look at some of the earnings reports of large advertising companies that reported a sharp cutback in spending from U.S. tech and telecom companies. We heard from WPP, so this is a UK-based advertising group. It cut its revenue guidance for the full year, and it was citing lower sales in the U.S. specifically from their tech clients.
Yeah, well, and I like this too. I mean, this was kind of the old school indicator, right? Was like whenever you were sort of looking for that economic cyclicality to the downside, you just look at the advertising space. In the old days, of course, it was all newspapers and magazines, but it's the tech ad space right now. And if that weakness is there, what does that tell you?
Yeah, and then you see a lot more of this weakness even when you look at earnings for Pinterest and Snap, really relying on those ad sales numbers. And it was very clear in those earnings reports that we've gotten that ad sales are down so far this year, Tim. So it makes you wonder whether these CMO budgets are just getting completely squeezed across the U.S. and what that's going to kind of look like moving forward.
Listen, we've been talking about Apple all day since they reported results yesterday, but you have to ask if they need to actually spend more money on marketing to actually get more people to buy iPhones, because that was pretty disappointing to a lot of analysts and one of the reasons why we're seeing shares fall today. Guys, thanks for coming in today.
Yeah.
Don't go anywhere, because we're going to be back in a little under an hour, live on TV, radio, and YouTube, also on Bloomberg Originals, 4 p.m. Beyond the Bell, our coverage when we take you through today's market close.
Our coverage coverage continues here on Bloomberg Television, counting you down to the close, a little less than 50, more than 50 minutes to go until we get there. Interesting note out by Michael Hartnett and the strategist over at Bank of America saying private clients fleeing stocks, actually, shifting back to risk-off mode, adding that a hard landing, still a risk, at least their perception of it, still a risk there for the second half, and they see higher bond yields and tighter financial conditions. Let's get some perspective out of our next guest. Ellen Hazen joining us right now, principal and chief market strategist over at FL Putnam. FL Putnam has about $5 billion in assets under management here. I thought this was a kind of interesting note because there really does seem to be a difference of opinion here, not so much as to whether we're headed for some sort of economic downturn, but I guess when it happens. Is it sooner or later?
Thanks, Romaine, and thanks for having me. Right now, it looks like it's going to be later rather than sooner. You look at the jobs numbers that came out today, and while they were a little bit light versus consensus, still very strong. Unemployment at 3.5%. And the strong labor market, as well as the consumer excess savings that's still on the balance sheets from the COVID checks, means that the economy continues to hum along. And you saw good numbers out of Amazon and some others as well to support that. So yes, there's a slowdown. Is it a recession this year? I think it's very unlikely. I think, though, that the biggest reason for caution is just the year-to-date returns in the market, right? You could have an economy that's just fine, but if you've already seen the S&P up 18%, how much more can there be to go? So I think valuations are actually a bigger risk than the underlying economy.
Well, let's talk about some of those valuations. Obviously, there's been so much talk about that magnificent seven of stocks here, and we know those valuations are elevated well above historical standards, whether you're talking about Apple or an Amazon or Microsoft. The question really becomes, can you find value on a multiple basis out there beyond those stocks?
The fact is, Romaine, if you look almost anywhere else, you find value. In financials, the banks are trading pretty cheap, even after the run they've had the last few weeks. If you look at small cap stocks, they're trading at a 6-point multiple gap to large cap stocks. If you look at international stocks, those are pretty cheap. Look at value stocks, those are pretty cheap. So almost anywhere you look that's outside that magnificent seven, you can find pretty good value. We're still focused in a slowing economy on high quality. That means high free cash flow conversion, high return on invested capital, top line revenue growth, et cetera. But you can find a lot of those companies for very reasonable values. It's just the index overall, the market cap weighted index, that's so high.
In terms of high valuations maybe leading to the downdraft that we're seeing in the indexes right now, for some of those value names that you mentioned, those cheaper, less expensive names, what will be the valuation for, or rather the catalyst for investors and traders to look at those valuations and say, I should rotate maybe into some of those names? Because it feels like we haven't seen that yet.
Well, it's interesting. It depends on where you look, Katie. But to be fair, you have begun to see small cap stocks and value stocks outperform since the end of May. So if you look through the end of May, that was really the peak of those largest companies dominating index performance. But you've already seen some of the banks begin to outperform. You've seen some value stocks begin to outperform. So it's hard to say what any individual catalyst might be. It could be a lot of different things, but it's happening under the surface. The S&P is sort of staying roughly the same, a little up, a little down, but you are seeing this rotation under the surface as people are paying attention.
And Ellen, a narrative that emerged this week was that as you saw Treasury yields really rocket higher, especially at the long end of the curve, that was hitting some of these big benchmark names, some of the big cap tech names. And now maybe as that reverses, maybe there will be a little bit of relief there. You're not seeing that today, though. What is the bigger driver for the stock market at this point? Is it maybe those macro factors, the cross-asset correlations there, or do you think that this is a fundamentally driven, stock market rather?
Well, I think that if long rates continue to go up, right, which from a technical perspective, if you look at 20, 30, 40-year charts on long rates, they've clearly broken the downtrend and are headed nowhere but higher. So certainly from a technical perspective, you can see that. And you might also believe that based on the downgrade that we saw this week from Fitch and based on the deficit and debt to GDP. So you can argue a lot of fundamental reasons why long-term rates will go higher. And you're absolutely right that will cause valuation compression in the growthiest names. But that's not the only thing that matters. I think fundamentals really do matter in this market. We're looking at companies that are still growing and trading at cheap multiples. So you look at, for example, at some of the home builders or housing-related retailers, very inexpensive stocks. And so I think fundamental bottoms-up analysis is beginning to work in this market in a way that it really didn't work at all for the first 5 months.
Is that message getting across to other folks? So, Ellen, we've heard that from some folks, but we know clients and for that matter, not just at the retail level, but even at the institutional level, can sometimes be in denial about just how times have shifted.
You can't try to predict exactly what the market is going to do. What you can do is look around and observe what's actually happening and position your portfolio and your clients' portfolios to take advantage of that. And right now what we see are longer long rates. We see rotation under the surface. We see some of the big stocks beginning to stumble. And I think that that makes sense. Could it change tomorrow? Absolutely, it could. But right now, if you observe what's actually happening, we're seeing the rotation away. And so eventually everyone is going to begin to observe that and see that it's happening.
All right, Ellen, got to leave it there. Really appreciate your time on this Friday. That is Ellen Hazen. She is Chief Market Strategist over at FL Putnam. Now, coming up, as we count you down to those closing bells, we'll get insight on the markets from Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management.
All right, plus a look at the ratings companies and how they're struggling to understand the risk around climate change and global warming, how that affects borrowing costs for cities, countries, and companies. That discussion coming up in a bit.
And shares of Tupperware soaring after the food storage container company reaches an agreement with its lenders to restructure its existing debt obligations. All that and more coming up. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
All right, welcome back. It's time now for our Muni Moment. And today we're taking a look at the impact of climate change. Researchers studying how global warming may actually increase borrowing costs for cities as well as countries and companies worldwide. Whether that's actually being factored in by the ratings agencies, the ratings companies, that remains to be seen. Bloomberg ESG editor Gautam Naik joining us right now to talk a little bit more about this. And there was a great story a couple days ago that kind of address this topic, that I guess the ratings companies are certainly aware of this, but at least for right now, they don't see any meaningful reason to actually factor this into the downside.
That's true. One of the problems with climate change is that it's sort of a nebulous risk that's slow moving, and ratings agencies, essentially trying to figure out what's the likelihood that an entity, a company or a municipality or sovereign would repay its debt. Well, they tend to have a 1 to 3, maybe sometimes a 5-year outlook. And the trouble with climate change is, of course, it is a much longer term risk. So that is the crux of the problem. It's a question of time. And I think the credit rating agencies are really struggling to figure out how to incorporate this longer term risk into a methodology they've used for years that's more tuned to the short term.
I feel like Miami is a great example of this because, I don't know, at least in my circles, the joke is that Miami is going to sink into the sea eventually. But then you look at how it's being treated by these credit companies, and recently had an upgrade from S&P, and it feels like they made a nod towards some of the environmental issues around the city, but upgraded it nonetheless.
Yeah, I think Miami is one of the most exposed coastal cities anywhere in the world. They're exposed to rising sea levels, to hurricanes, of course, but also very high heat. They had 46 years of consecutive 100-degree temperatures this summer. So the problem for the rating agency is that they have to incorporate some of that risk. And in their upgrade of S&P in May, they said, look, we do see these risks coming in the longer term, but right now the tax base is so strong and the economy is doing so well that we're not too concerned. Plus, the city has put in place certain efforts to sort of mitigate against future climate risks. So we think that's all balanced out. There are a lot of critics and detractors, of course, who say they think that's really underplaying it.
Well, let's kind of thread that needle, because it certainly makes sense. And I mean, we'll give credit where credit is due with regards to the rationale as to why they feel like these mitigation efforts might sort of means they don't necessarily need to do a downgrade now. But this also comes against the backdrop, Gautam, as I'm sure you know, of insurance companies pulling out of markets in Florida as well as in other coastal areas. And it's like, if they're at a level already, at a place already where they feel like this isn't worth insuring, then how can the ratings agent companies just stand by and say, well, we don't really see a problem just yet?
Yeah, well, that's the question on everyone's mind, that at least the critics of the ratings agencies. So, you have the European Central Bank and the Fed, which have both looked at this, and they seem to say, in just, summarizing, that the way that the climate risk is incorporated in the methodology by ratings agencies is very non-transparent. They need to have a better sense of it. But the rating agencies say, hey, we do look at climate risk. And also, when you actually look at the number of downgrades that have resulted from this climate risk being incorporated, they're very few. So essentially, there's disjointed sense that even though you look out the window or you look at the data, there's a clear sign of climate risk impinging more and more on financial results, and yet the credit rating agencies, with their shorter-term view, aren't really reflecting that.
And purely from the ratings perspective, when it comes to this issue, who ultimately is affected by this? Is this the muni debt holders, or who stands to really be the most impacted?
So if you're a Caribbean country, say, you are very much in the line of fire of hurricanes. And one of the studies I cite in my paper from a Fed economist looked at 7 Caribbean countries. It's a bit of a vicious cycle, because if they get hit very hard by a storm, then their GDP falls. Their GDP falls, they get a lower rating. They get a lower rating, it's harder for them to borrow money, more expensive, to shore up their defenses against the next storm. So it becomes a vicious cycle. If you're an ordinary investor, an everyday investor with a 401k plan or a pension fund, well, you are, if you're following, say, a 60-40 portfolio with 40% in bonds, well, either you or your pension fund are picking, which bonds to put in, and they usually tend to be held for the long term. If that climate risk is not incorporated into the ratings that these pension funds usually use as part of their way to select which bonds to go for, well, then you're more exposed as an everyday investor.
All right, Gautam, got to leave it there. Our thanks to Bloomberg ESG editor Gautam Nayak. Taking a look at the S&P 500, now down about 0.5% on the week. The S&P 500 is off by 2.2%. If that holds, it'll be the worst week since the week of March 6th, obviously, when that regional banking crisis really came to the forefront. Will be interesting to see what happens over the next 40 minutes or so. From New York, this is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside? All right, Romaine, next week, the world's largest wind turbine will go up near Martha's Vineyard, and it's the first offshore power substation in the United States. Its name is Vineyard Wind. It is the nation's first commercial-scale offshore wind farm. It's expected to start delivering electricity by October, and by 2024, project is expected to generate enough electricity to power 400,000 homes.
Yeah, this is interesting. So there are wind farms out there, right?
But this one's really big.
This one's big, which I'm sure the people in Martha's Vineyard are pretty pleased about. Can you actually see this from your home? Like if you're on your porch, you're vacationing in Martha's Vineyard, can you look out and see this
That's a great question. There's a photo in the story that shows it. It just sort of rises up from the Atlantic Ocean. Whether you can see that from the shore, I'm not exactly sure. We should go up and check it out, maybe.
And so this is going to be a harbinger of things to come, sort of harnessing alternative energy in a way that we don't have to rely just on, those single sources of fuel anymore.
Potentially, and that doesn't sound like such a bad thing right now. You can't get too upset about that. We'll see how this one goes.
Well, as someone who is not an expert at all on wind turbines, and I have to tell you, nobody in Birmingham was talking about this, but I am curious about just the environmental impact, if that's been weighed. I'm sure it must have been weighed at some point, but and if these things are going to just proliferate.
We'll see, and we'll see if it meets its lofty goals. Will be fun to follow. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we can do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is the countdown to the close. About 30 minutes left to go here in the trading day and the week. A down day and a down week as well, Katie.
A down week and then some. Currently, the S&P 500 on track for its worst week since the second week of March. Quite a size and scope there. You look at the sector level, you do have some green. Consumer discretionary up by over more than 2% today. A lot of that, of course, coming from Amazon. Energy also hanging in there as well. But then you go down the list, and it is a sea of red. Right there at the bottom, you have real estate, you have tech, of course, a lot of that coming from Apple, and you also have utilities, interestingly, off by 1.4%, Romaine.
Yeah, interesting kind of too how differentiated this market is. You have signs of resiliency out there. She just mentioned Amazon having a phenomenal day, up 9%. Continue to see growth there, not only on the AWS side, but on the retail side as well. Booking Holdings up 8% on the day as we continue to see resiliency in the travel sector. But there are a lot of other pockets of this economy out there that are showing a little bit of stress. You saw that in the results, and more importantly, the guidance that we got out of WW, the company formerly known as Weight Watchers, down more than 20% on the day. And Open Door and Redfin also reporting today. And well, similar story here. The softness that we're starting to see in that space really rattling some investors, particularly for some of the stocks that have had a pretty good run over the past few months. But if you're looking at economic conditions and looking for some bright spot out there, we got one yesterday when we got the latest productivity numbers for the most recent quarter. A significant uptick in productivity, adding to what has been, well, 3 quarters in the past 4 where we started to see that uptick. You factor out the anomaly that we had back there in 2021, and for the first time in quite some time, you're finally starting to see a material and, more importantly, a persistent pickup in productivity that could bode well for an economy, Katie, as you know, that's been struggling for years, if not decades, to boost productivity.
So maybe some good news there. You're not seeing a lot of good news in the market right now. And let's get into that now with Andrew Slimman. He is Morgan Stanley Investment Management Senior Portfolio Manager. And Andrew, it's great to have you with us. And of course, 1 week alone does not make a trend. But you look at what the S&P 500 is doing this week, off by 2.2%. Of course, the worst week since we saw the outbreak of that banking crisis, if you will, in March. Is anything that we learned this week changing your outlook? Did something change this week that would justify the kind of losses that we're seeing in the market right now?
Well, hi, Katie. I certainly did anticipate a debt downgrade, so I guess that's the big thing that changed. But I did expect weakness for the market because coming into August, we'd had a very good July. Speculative stocks had done extremely well. High beta had done extremely well. And we're coming into a period where there's a vacuum of kind of corporate fundamental news. And that's why this period from now until kind of second week of September is always dicey. It just, it makes my back shiver, thinking about this time, because inevitably without corporate fundamental news, we pivot to geopolitics, and that creates anxiety in markets. So it's seasonally a tough time for stocks. It doesn't surprise me that the market is weak. The other surprise that I would note, however, on the positive side, is earnings estimates for the S&P for this year actually went up this week, and it's the second week in a row where estimates have gone up, and that tells me that second quarter earnings actually were pretty good. So this kind of the bears argument of earnings are way too high, they're going to collapse, that is not working. And the reason why that is so key is that next year earnings estimates are expected to accelerate to plus 12% or $246. And when you go from negative earnings growth this year to positive next year, that tends to be warmly received by the market.
And given that point that we've actually seen earnings estimates come up here, which should be good news, when you think about the losses that we've seen in the equity market this week, how does positioning factor in?
Well, I think it's a great, wonderful time to go through your portfolio and figure out what companies are continuing to be optimistic, raise guidance. And I think if I have to look back to the beginning of this year, and I was pretty optimistic on the markets to start the year, not only because I thought people were way too negatively positioned, but every time we turned around and we talked to companies, they would say things like, well, our business is pretty good, but we're being told by Wall Street that a recession's coming. And I think that's the big surprise. So positioning-wise, I would just go through your portfolio and which companies are continuing to, beat numbers, raise numbers, and are reasonable. And I think one of the misleading is the market is expensive comment. That's a misleading comment because, yes, the S&P it might be expensive because of the mega caps, but equal weighted is actually cheaper than normal. So there are plenty of stocks out there. I think the industrials, financials, they report great company numbers, and these stocks trade at very, very reasonable multiples. So there's plenty of areas to choose from.
Yeah, I am curious about that. I mean, we know that some of the reticence to embrace some of those names that maybe have more attractive valuations was this idea of where you thought we were in the economic cycle. And if people are now at a stage, Andrew, where they really are starting to materially upgrade their outlook for the economy, as we've seen several big Wall Street strategists do, when do you anticipate that maybe we'll see sentiment shift more materially towards some of those names?
Yeah, I think it's Romaine. I think it's already happening. If you look at the last 2 weeks, value, and even today, value stocks are working. Look at the oils today. They're up. Some of the industrials are up today. So I think that there is a shift going on by the market, the recognition that maybe inflation is going to be more persistent on the high side, although I do think next week's CPI number is going to be another lower number. But I think, that's what's going on really, is that you're starting to see some of the sectors that have lagged are starting to catch up. Value is starting to outperform. But to be clear, I am not negative on the tech area. I'm not negative on growth because I don't think these stocks are extremely expensive. The area that I'm negative on are the defensives. Yeah. Because coming into this year, you had two things happen at the last year. Number one is growth stocks got creamed. So if I look at the big boys, the mega caps, yes, everyone talks about how much they're up this year, but what they forget is they got creamed last year. Many of these large mega cap stocks, they're actually flat or down from where they were at the end of 2021. So I'm not negative on those stocks. The area that people crowded into after a bad year was really defensive, and those are the ones that got expensive. Dividend yielding, consumer staples, and that's what's really lagged this year. And the fact that they continue lag is a very bullish sign for stocks. Although, just to be clear, I don't think we're out of the woods on the short term in terms of August.
All right, Andrew, got to leave it there. Hope to have you back soon. Have a great weekend. That is Andrew Slimman of Morgan Stanley Investment Management. Now, coming up, Tupperware stock is soaring today as the food storage container company agrees. Well, it was soaring, then it was not. Now it's soaring again, reaching an agreement to restructure its debt. We're going to get into the details in our Stock of the Hour up next. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg.
Time now for our Stock of the Hour, a look at Tupperware. The food storage container company soaring today after announcing that it had reached an agreement with its lenders to restructure its debt obligations. Joining us right now for more on the moves today is Bailey Lipschultz, who covers this for us here at Bloomberg News. And Bailey, this is a stock that's probably been one of the more volatile stocks over the last few weeks here, up something like 600 or 700% just in the past 2.5 weeks here. Was this all sort of a prelude to what we got today, what we learned today with regards to the debt deal?
I think you could argue, Romaine, that people were trying to get in ahead of a potential restructuring that has been in the works for quite some time. Again, this is a company that back in April warned about, had a going concern warning, had delayed quarterly and annual filings. But when you look at the activity that we saw over the last 2 weeks, whether you want to credit retail traders or Wall Street pros trying to bid up some of these penny stocks, it does seem like it's capturing and taking advantage of this rally, at least with this going on. But obviously, when you're restructuring debt, that's not driven by the equity share price. So a bit of mania happening. We've seen a number of these beaten down, potentially distressed companies rallying, and that seems to be what caught up Tupperware over the last few days.
And always a question I ask when I see these types of moves, particularly on these so-called meme stocks, Bailey, is this really about conviction behind the name, or is this more of a short squeeze?
I don't know if it's a short squeeze or not. Again, 30% of the shares were shorted going into the last week and a half's rally. There still are shorts lining up to bet against the stock, so it doesn't really seem like many people are getting quite squeezed out just yet, just looking at those numbers. But it does seem like the characteristics of some of these, whether it's a Revlon or a Hertz, where just a little bit of buying power can trigger upward momentum, and whether people are chasing the FOMO or potential rally that could be playing out, or shorts are actually getting squeezed, kind of is up for debate. But when you look at a stock up 5, 6, 700% over a few days, it does raise a lot of questions across both Wall Street and Main Street.
And Bill, you mentioned some of those other names there, and it's interesting. In the case of Tupperware, again, it feels like any mention or hint or whisper of bankruptcy is like a green flag in some of these situations when it comes to that retail crowd.
Yeah, it seems, Katie, almost like you took a soda and shook it up and opened it. You don't actually know how much soda is going to come out and how that will react, how the market will react to that. You look at a company like the trucker Yellow with another triple-digit rally, or some of those beaten down stocks, the Nicolas and the Carvanas of the world. There's not really a rhyme or reason to a lot of these rallies. But again, if shorts are getting squeezed and having to buy back shares, that obviously can help trigger a move higher. But again, it doesn't really take a lot of buying power to send some of these frenzies going, and it really becomes a question of when the music stops. And it seemed like that was going to happen earlier in the week, and then, as you mentioned, today we had this news that Howard shares back up again, still below Tuesday's highs, but it is going to be interesting to see how this plays out in the coming days and weeks.
What's interesting in the case of Tupperware is that, as you mentioned, you are actually seeing some more shorts line up here. That short interest is increasing. Am I incorrect in thinking that usually you don't see that tug of war to this extent?
It really depends on a case-by-case basis almost, Katie, because sometimes we saw this happening with GameStop and AMC, where there was so much conviction from the short side that earlier shorts were getting squeezed out, but later shorts were lining up to replace them. Right now, the cost to short right now is still about 100%, so it's very expensive to bet against the stock. But as you mentioned, we are seeing that short interest as a percentage of float ticking higher. So there are people on Wall Street who have conviction that the top is in. But again, with short selling, you never really know when that's going to play out.
All right, Bailey, always great to talk to you. Always smart. Have a wonderful weekend. Bailey Lipschultz there with a look at our stock of the hour. Tupperware shares are one of the biggest volume movers and percentage gainers on the day. Paul Christopher, Wells Fargo Investment Institute Head of Global Investment Strategy. He's joining us in just a second as we count you down to the close. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs
door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
as they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
insight,
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture down.
The BOK is getting ready to make a decision.
This is the countdown to the close. I'm Romaine Bostic. Joining me now to march us to those closing bells is Scarlett Fu. And Scarlett, I got a riddle for you here.
Go for it.
What happens when the third highest weighted company in the S&P 500 rallies 9% on the day, but the highest weighted company in S&P 500 falls 5% on the
You've
day?
got a battle of big tech,
Yeah.
and right now it looks like Apple is winning insofar as the S&P 500 is down 0.6%. You know, for those who really believed in the soft landing camp, that idea, the long-awaited jobs report totally delivered, but the price action is all dictated by these big tech stocks.
Yeah, and it's interesting, too. We should point out that when we kicked off the close at 2 p.m. Eastern time here, most of the major indices were in the green solidly on the day, and that changed pretty dramatically, primarily because of a downdraft in Apple that dragged the rest of the space down.
Well, it's a pretty big down drag, right? It's the behemoth in the market. We're also, of course, looking at energy stocks because those are still up, albeit they've given back some of their gains as oil prices extend their gains. And of course, we do look ahead to next week's earnings as well. Everything from UPS to Tyson Foods. The big one for me will be Disney and what it says about its streaming operations. Duke Energy and Eli Lilly also reporting.
A lot to parse here as we move closer to the closing bells here on this Friday afternoon. Paul Christopher joining us right now, Wells Fargo Investment Institute Head of Global Investment Strategy. And Paul, let's start off with economic conditions, that jobs report that we got this morning, and some interesting commentary by at least two Fed members, Raphael Bostic and Austin Goolsbee, who seem to be talking about this idea that maybe that soft landing, in their view, in their eyes, is still a possibility.
Well, yeah, a possibility, but just let's keep in mind that before each of the last three recessions, 90, 2007, 2008, and 2020, people were talking about a soft landing. And it's just entirely possible that that could be wishful thinking. What we're seeing is something very different. Even if you look at that employment report today, looking below the surface, there's some concerning things that we see there.
Okay, well, let's talk about this idea here, then what is actually driving the sentiment in markets right now. Is it more on the inflation side? Is it more on the labor market? Or is it not about the economy at all?
Well, it is a lot about the economy. This whole rally started off with some artificial intelligence enthusiasm, but it's about the economy and it's a lot about liquidity. Think about very tight credit spreads that allow very cheap borrowing to go into these markets and to chase. There's really no earnings to speak of, no earnings growth for the last 3 quarters. So this is a purely sentiment-driven rally. So you have to ask, well, where are the fundamentals? And as we look at this, the liquidity still looks positive, but the economy looks to us more and more like it's trending weaker. And I can't tell you exactly when a recession is going to start, but it does look to us like if you just disregard that top-line optimism that you get from a report like this morning's, what you start to see is things like, hey, wait a second, hours worked are falling. Overtime is falling. That means that labor demand and supply are rebalancing. So when you put that aside for a moment and then look at the consumer and see that the consumer is finding increased difficulty in getting credit card applications approved, delinquencies are increasing, auto delinquencies are increasing, bankruptcies are increasing for small businesses, and you start to say, well, wait, what happens if the consumer has to stop spending? And then all of a sudden that balanced labor market becomes a market in which employers have fewer qualms, let's say, about laying off. So all of a sudden, what looks like a gradual slowing in the economy could become much more accelerated.
Right, gradually and then suddenly. It's interesting that you see signs of the economy trending weaker right as the narrative on the economy has shifted towards a soft landing and away from recession. Given all of that, Paul, how do you want to therefore be positioned? I'm guessing defensive, but what does defensive in equities look like right now? Is it hiding out in big tech?
We've been defensive for a while and would not be chasing this rally. Doesn't mean we don't like stocks, but we are overweight the large caps. But here's what we would say is, look, we've liked energy for a while. We thought the pullback in energy was a great buying opportunity. Looks like that might be coming to pass. We like healthcare. It's suffered a little bit here. We think that rebounds also. And we like materials right now. And those are 3 sectors that we think look underpriced to us. And for a long-term investor, that's going to generate, we think, cash in those sectors that pay dividends. So going forward, if you're looking for income and you want to get in on a long-term bet, we would stick with quality for right now and wait for a pullback to see what happens next.
What does being defensive in fixed income look like then?
Well, we've been underweight high yield. That hasn't worked out real well for us so far. Again, those spreads are very tight. But again, we think that reflects an optimism that's not really well-founded in a soft landing. We think spreads will widen, and so we would stay away from below investment grade. That means below investment grade in munis and in corporates. We like U.S. Treasuries here. We like quality long-term investment grade corporates, and we like very much investment grade munis.
Is this, are we still kind of having that debate right now, or maybe it's not a debate, Paul, this idea of sort of getting returns in safer assets like treasuries and even high-grade corporate credit versus taking on the risk and maybe getting something more in the equity market?
Yeah, that's right. I mean, look, we also like short-term fixed income here. If you're afraid of maybe some volatility, and we are coming into some seasonally weak months, right? September and October have been rocky months, generally speaking, for equity markets. Take some protection here in some short-term fixed income. You're seeing yields rise. It's a great time to be putting some money there, or a long-term investor, put some money into those long-term fixed income that I was just talking about, and really lock in those yields for yourself longer term. Get some diversification, stick with the quality sectors and stocks, and let's wait for this rally to become a little bit more reasonable, right? Pull back so that the multiples come down.
All right, you say wait for the rally to become a little bit more reasonable. What are you looking at in terms of technical levels for the different indexes?
Well, I'll stick with the S&P 500. That's the main one that we watch. And really, 4,300, if we could see a pullback to 4,300, we might start to get interested in some more cyclicals. Much depends upon how long it takes for the recession that we're expecting to get here. But 4,300 might be an interesting level. And we've been talking about this all year, right? At the top level of the market, you want to be taking profits. At the bottom of the level of the market, you want to be putting that cash back to work. So 4,300 would be one level. If we were to fall below that, we might be even more aggressive. But let's wait and see what happens here. We do agree with others who say that we might be near a top here.
Paul, always great to talk to you. Paul Christopher there over at the Wells Fargo Investment Institute. We'll catch up with him again soon, I'm sure. Meanwhile, on this Friday afternoon, a look at the broader markets here, right around session lows here on the day. A big flip-flop from where we were just a couple hours ago, Scarlett.
Yeah, and Paul was talking about 4,300. That would take us back to, I'd say, the second week of June. So erasing all of this summer's gains, which wasn't really fueled by AI anymore.
And he's not alone in that. I mean, there are people that actually are now putting even a lower price target than what he has, saying that we are going to see some sort of retracement as we move closer to the closing bells here on this Friday afternoon. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Madison Mills and Tim Stenovic. Welcome to our audiences across Bloomberg Television, Radio Originals, and our partnership on YouTube. A big flip-flop over the last couple of hours, Tim, Maddie, in the markets, where we've gone from green to red across the board here on what's going to end up being another down week.
Yeah, obviously with Apple being the biggest component of the S&P 500 and falling by over 4.7%, that turns into a big loss for the index and kind of drags down the entire sector. I'm curious, too, whether we're going to see sort of dragging down in the overall AI space, given that that's such a key part of this rally that we've seen, Tim, so far this year.
Well, I want to bring in our comments from Leo Kelly, the founder and CEO of Verdance Capital Advisors. He just joined us. And he said that there's this razor-thin line of perfection that's getting tighter and tighter because the S&P 500 and the NASDAQ are just priced for perfection right now. And the issue yesterday that's leading to the sell-off today was Apple missing on those iPhone numbers. Just that one little thing because of Apple's size, Maddie, and because of the way the market's priced for perfection, that sends everything lower.
Yeah, absolutely. And it's interesting, Scar, when we think about, too, this jobs data that we got this morning and what that tells us about the consumer as well.
Yeah, well, the labor market is cooling. That's what the jobs report showed us, but it is in an orderly way. And if you certainly compare it to the pre-pandemic times, it's still fairly strong. What's interesting here is you would think on a day like today, Friday afternoon, after some of the biggest companies reported their earnings, that volume would be below average. It's not. It's above the 10-day average.
Yeah, we can see that uptick on the volume on a day where you get the stocks moving to the downside here. Well, look out below here. Maybe some concerns going forward as we head into the next week. The Dow Jones Industrial average down about 150 points roughly on the day, right around that 35,000 level, down about 0.4% here on the day. The S&P 500 lower for a fourth straight day, lower on the week as well. On the day, it's a 0.5% decline. Similar story for the NASDAQ, down for a fourth day by about 0.4% here on this Friday. And let's take a quick look at the Russell 2000, also down for a fourth straight day, only by about 0.2%, but across the board, we're in the red on a weekly basis.
Yeah, there's something for everyone when you look at some of the news and data that we got this week. You have the Atlanta Fed GDP now jumping at 3.9% this week for the third quarter. Then you have productivity up to 3.7%. That's the highest level since the third quarter of 2020. And then today, you've got Bank of America and then today JP Morgan, both taking recession calls off the table here. And then you've got the jobs report, a mixed bag, but still seeing some good news both for the Fed and for consumer, Scar.
And it initially lifted the market, but as the afternoon wore on, we saw Apple drag everything lower. I'm taking a look at the group ranked returns for the S&P 500. If you split it up into 2 dozen groups and look at the retailers at the very top there, up by 4.3%. That is Amazon. And then you look at consumer durables and apparel. That, of course, is some of the VF Corp and home builders. And then you move on and you look at the very bottom, tech, hardware, and equipment, all of that is Apple. Apple dragging that group down by more than 4%.
Yeah, well, Scar, I want to go back to the positives here and look at some of our gainers, starting with Warner Brothers Discovery announcing that they're close to offering an expanded slate of live sports to Max, formerly HBO Max, of course. This gives them a chance to offer consumers another more expensive subscription offering that could be, a boon for them in terms of revenue, but also they're going to have a lot of competition in the space. Also today, a Bank of America note on Warner Brothers saying that this could be a dividend play, particularly because of their robust cash flow. And then, of course, I've got to talk about Amazon, obviously the huge gainer of the day, driving better margins from decreased costs, getting quicker, more effective, and cheaper cardboard box deliveries, as Tom Keene likes to call them. Definitely back to pre-pandemic levels for the brand. Also, a lot of potential revenue streams, as we were talking about earlier today, Scarlett, with The Summer I Turned Pretty on Amazon Prime. Everyone's got to watch it this weekend. So a lot of potential revenue streams there for Amazon. And then I want to end on Arista Networks because this was the best performer of the week, coming off its lowest lows ever. Arista sells those switches that speed up communications among racks of computer servers that are packed into internet data centers. So they've got great earnings. This is an AI name, and their biggest customers, Tim, are Meta and Microsoft. So good for those names as well.
All right, you got the gainers, I got the decliners. I want to start with Apple. We've been talking about the results all day. The worst day for the company stocks in September of 2022, down 4.8%. On a points basis, the biggest decliner in the S&P 500. Of course, a mixed quarter for the company. iPhone sales revenue disappointment. Services revenue setting a record for the June quarter. The company also giving an outlook for the current quarter. It worried analysts that demand for iPods and Macs will be sluggish. The company said, hey, tough comps with a year ago when everybody was buying, but still analysts were disappointed. Fortinet, the worst performer in the S&P 500 on a percentage basis, down 25% today. The biggest decline on record, cut its revenue and billings guidance for the year. It's a cybersecurity firm. The big question from analysts, is this the start of a more prolonged slowdown when it comes to demand for these services? And then Nikola falling 26%, losses accelerating later in the day. This is after the electric truck maker named Stephen Gursey as its new CEO. We should note this year through Thursday, the stock was up more than 57%, but giving back a good bit of those gains on today's tumble.
Of course, a lot of the moves that we saw today and this week were directly correlated with what we saw in the Treasury space here. Some interesting moves here, particularly in the belly of the curve. A 5-year yield was up about, something like 14, 15 basis points on the day here. So interesting to see a re-embrace here in the Treasury space, despite the sell-off that we had seen to start the week. Your 10-year yield up about 13 basis points here on the day, and even out on the longer end of the curve here, I should say down on the day, and your 30-year yield down 9 basis points on the day, Scarlett.
Yeah, and one thing to keep in mind is we have a lot of Treasury supply next week as well, so that's going to add to the rate volatility that we've already seen this week, which has been pretty mammoth moves, especially if you look at like the 10-year yesterday.
Yeah, well, and Scarlett, it's interesting when you talk about today because we keep saying that there was a little something for everyone, right? And I kind of feel the same way about the big tech names because you had Amazon beating expectations with record Prime Day sales, for example, but iPhone sales down. So I have to wonder when I'm thinking about where to kind of place the consumer in terms of spending, it just feels like you can pick data points on either side for all of these questions, Tim.
But you go back to some of the earnings, and I mean, particularly some of the secondary ones, because we were kind of talking a little bit earlier on the TV program. Was it WW, the company formerly as Weight Watchers? There were a couple other kind of consumer-facing companies here that clearly were struggling there when we talk about, at least in terms of the results, some of the real estate companies like Open Door and Redfin. So there's pockets of this economy, and particularly when it comes to consumer spending, that really isn't holding up. So I don't know where you get the picture of that softish landing. I guess if you look only at the labor market, yeah, it's there. But if you look elsewhere, I don't know. You can make a case that maybe this could be hard.
Yeah, that's a really good point. It brings us back to the conversation that we had with Poonam Goyal at Bloomberg Intelligence yesterday in the wake of Amazon earnings. She said that customers here in the U.S., they're not strapped. What they are doing is they're discerning. Mm-hmm. They're choosing very carefully what they buy. They're not necessarily trading down, but they're just very careful about what they're buying right now. Look, we get a slew of economic data next week. We get a couple more earnings next week, Scarlett, with Disney and other SoftBank as well. So we'll get, different sort of reads in different areas of the economy and a little bit of entertainment and where people are spending their money. It'll be interesting to hear if we get, how the numbers at Parks and Entertainment Division are as a result of if people are spending their money there.
Well, we've already heard that Disney, I think it was the 4th of July, saw very little traffic parks in California and in Florida. So that's an indication that all the price increases that they've implemented after the pandemic is starting to not scare people away, but put people off a little bit.
Yeah, it'll be interesting to see. But I don't know. It's if we're trying to sort of read this just through the lens of the economy, meaning trying to extrapolate what's going on with corporations, or you want to do the reversal of that here, is what we're talking about, or what we're seeing, I should say, is that really accurate? An accurate picture, I should say.
Well, I feel like, Romaine, you probably got a good read on the economy when you were in Alabama for about 24 hours for NABJ. Did you notice anything?
I was there for 36 hours, and you want to know what all the talk was?
What was it?
Oh my gosh, all the talk.
The weather? It was hot?
Alabama football.
Oh,
yeah. Nobody cares about the economy here. Nobody cares about anything down there. It's like just football and more football and more football.
So there's plenty of spending on the football program there, right?
Yeah, well, football is doing great. I mean, if you're looking for a bright spot in our economy, Alabama football is on the fire.
Hey, experience
Can you invest? Can you invest in the Crimson Tide? Because that might be a good bet based on what I saw down there. In all seriousness, though, too, I mean, just anytime you go traveling, you kind of get a good read, too, of kind of what's going on here. And look, this is just anecdotal, but the airports are full. I came off the airport today, a Friday morning, and it was packed at the New York airports here. People looking to go wherever they're going.
Every airport I've been to over the last 2 years just feels like it's too small for the area that it's in.
Oh, well, you certainly haven't been to the Birmingham airport.
Was it not crowded at all?
I'm saying it's small.
Okay, well, everything. No, that's what I'm saying. Everything is too tiny.
They did have a Chick-fil-A.
People everywhere.
That's
not seats.
Tim Stenovic has
There's this
feedback
imbalance
for our transportation.
There's still an imbalance going on, guys. We're not back to the norm yet.
Still an imbalance there. And don't forget, Bloomberg News reporting that U.S. domestic trips, the flights, getting a little bit cheaper, you guys. So
where's
get those flights
I thought
now,
she'd
you
be
guys.
back by now.
No,
she's back for you next week. Don't worry.
Cheaper domestic fares. How about that?
Don't worry. Carol's going to be back with you here next week. But guys, that is going to do it.
I wasn't asking for her to come back. I just wanted to know where she was.
Oh, I understand. Well, she's on vacation. We have to go. That does it for our coverage. Reminder that Bloomberg Business Week, it's now on Bloomberg Originals. We're going to see you next week, you guys. Have a great weekend.
All right, as we bid adieu to our radio colleagues for the weekend here, a lot more coverage coming up here on the big program. A look at the factors that move the market here